Welcome to your channel name, where we uncover the hidden marvels of our planet. Today, we embark on an extraordinary journey to explore some of the most fascinating and remote corners of the Earth. From the icy expanses of the Arctic to the lush depths of the Amazon rainforest and the fiery realms of active volcanoes, we will delve into the secrets that these incredible places hold. Here, the wonders of nature come to life, revealing secrets millions of years in the making. Each ecosystem, with its unique characteristics, tells a story of adaptation, survival, and the intricate balance of life. In the Arctic, life has evolved to survive Earth's harshest conditions. Polar bears and Arctic foxes thrive in freezing temperatures. The Arctic is a land of extremes, where the sun doesn't set for months in the summer and doesn't rise for months in the winter. Despite these challenges, a diverse array of wildlife has adapted to this environment, showcasing the resilience of life. Deep within the Amazon, complex weather life thrives in vibrant green silence, producing a significant portion of the world's oxygen. The Amazon rainforest, often referred to as the lungs of the earth, is a vast and mysterious place. Its dense canopy sustains countless species, from insects to mammals, each playing a crucial role in maintaining the delicate balance of this ecosystem. Its dense canopy sustains countless species, from insects to mammals. The Amazon is not just a forest, it's a living, breathing entity that supports incredible diversity. The interplay between the flora and fauna here is a testament to the complexity and beauty of nature. Volcanoes reshape the earth with fire and ash, creating and destroying landscapes over centuries. These fiery giants are a reminder of the Earth's dynamic nature. The molten lava that flows from their roots can obliterate everything in its path, but it also gives birth to new land, fertile soil, and unique ecosystems. Witness the raw power of nature as it inspires sculptures. The process of volcanic activity is both destructive and creative, illustrating the real nature of our planet. Subscribe to explore more wonders and discover nature's incredible stories. Join us as we continue to uncover the mysteries of our planet, one breathtaking adventure at a time. See you next time. In the depths of the ocean, mysterious creatures lurk in the darkness, adapting to extreme pressures and lack of light. From bioluminescent jellyfish to giant squids, the ocean's depths are a frontier of discovery. The deep sea is one of the least explored places on our planet, a realm where sunlight never penetrates and the pressure is immense. Here, life has evolved in extraordinary ways, revealing some of the most fascinating adaptations in the natural world. Imagine a place where creatures create their own light, a phenomenon known as bioluminescence. This magical glow is used for communication, hunting, and even camouflage. Among these luminescent wonders are jellyfish that light up like stars in the night sky, and anglerfish that use their glowing lures to attract unsuspecting prey. The deep ocean is also home to the elusive giant squid, a creature of legend that can grow up to 43 feet long. With eyes the size of dinner plates, these squids navigate the dark depths with ease, capturing their prey with powerful tentacles. The abyss is a testament to life's resilience and ingenuity, showcasing how organisms can thrive in the most extreme conditions. Thank you for joining us on this underwater adventure. Make sure to subscribe for more explorations into the hidden corners of our world. Until next time, keep wondering, keep exploring. High in the mountains, life clings to the rocky slopes. Mountain goats and snow leopards navigate the treacherous terrain, showcasing nature's resilience. But beyond these familiar faces, the mountains hold secrets of their own. In these towering heights, the air is thin, temperatures plummet, and the landscape can change in an instant. Yet life finds a way. Tiny alpine flowers bloom in the crevices of rocks, painting the rugged landscape with bursts of color. These hardy plants have adapted to withstand the harshest conditions, their roots anchoring them firmly against the relentless winds. Among the peaks we find the elusive snow leopard, a master of stealth and agility. These magnificent creatures are perfectly adapted to their environment, with thick fur to keep them warm and powerful limbs to scale steep cliffs with ease. Their keen eyesight and camouflage coat make them nearly invisible against the snowy backdrop. Mountain goats, with their incredible climbing skills, defy gravity as they traverse sheer cliffs in search of food. Their specialized hooves provide a firm grip on the rocky surface, allowing them to navigate the mountains with astonishing agility. The mountains are not just a home for these remarkable animals, they also play a crucial role in our planet's ecosystem. They act as water towers, capturing moisture from the air and providing fresh water to rivers and valleys below. The delicate balance of life in the mountains is a testament to nature's ability to adapt and thrive in the most challenging environments. Thank you for joining us on this journey to the heights of the mountains. Make sure to subscribe for more explorations into the hidden corners of our world. Until next time, keep wondering, keep exploring. Deserts, though seemingly barren, are teeming with life. From the vast expanse of the Sahara to the rugged terrain of the Mojave, these arid landscapes are a testament to nature's ingenuity. Creatures here have evolved remarkable adaptations to survive with minimal water and extreme temperatures. Take the camel, often referred to as the ship of the desert. These resilient animals can travel for days without water, storing fat in their humps to sustain them during long journeys. Their thick eyelashes and nostrils that close protect them from sandstorms, while their wide, padded feet allow them to traverse the hot, shifting sands with ease. Beneath the sand, scorpions lie in wait, emerging under the cover of darkness to hunt. These nocturnal predators have adapted to the harsh desert environment with a tough exoskeleton that minimizes water loss and specialized pincers to capture prey. Despite their fearsome reputation, scorpions play a vital role in the desert ecosystem, controlling insect populations. Then there are the cacti, the silent sentinels of the desert. These plants have mastered the art of water conservation, storing it within their thick, fleshy stems. Their spines not only deter herbivores but also provide shade, reducing water loss through evaporation. Cacti bloom with vibrant flowers, attracting pollinators and adding bursts of color to the arid landscape. The desert's extreme conditions have given rise to some of nature's most extraordinary adaptations, proving that life can thrive even in the harshest environments. These resilient creatures remind us of the incredible diversity and adaptability of life on Earth. Thank you for joining us on this journey through the secrets of the desert. Make sure to subscribe for more explorations into the hidden corners of our world. Until next time, keep wondering, keep exploring. In the vast savannas, the circle of life is on full display. Predators and prey engage in a timeless dance, from the majestic lions to the swift gazelles. The savanna is a testament to nature's balance and beauty, but beyond the iconic images of the hunt, there's a delicate ecosystem at work. The tall grasses sway gently in the breeze, providing both food and shelter for countless species. Elephants roam these plains, their massive size balanced by their gentle nature. Using their trunks, they pull down branches and uproot grasses, playing a crucial role in shaping the landscape. Nearby, a group of giraffes grazes on the acacia trees, their long necks reaching for the tender leaves that other herbivores can't access. Their presence ensures the trees don't grow too tall, maintaining the savanna's characteristic open canopy. As the sun sets, the savanna comes alive with the sounds of the night. Hyenas laugh in the distance, while the deep, resonant calls of the lions echo across the plains. Nocturnal creatures like the aardvark and the bush baby emerge, each playing their part in this intricate web of life. The savanna is more than just a stage for dramatic chases and battles. It's a living, breathing entity where each species, no matter how big or small, contributes to the harmony of the whole. It's a reminder of the delicate balance that sustains life on Earth and the beauty that arises from it. Thank you for joining us on this journey through the wonders of the savannah. Make sure to subscribe for more explorations into the hidden corners of our world. Until next time, keep wondering, keep exploring.
They fail to realize that they didn't need any of the stuff that was below the price. All they really need is the price. Some people may not believe me when I say that, and that's what I'm hoping that we can accomplish by showing this session. So this session will be on reversal patterns, and next week I intend to do continuation or trend trading patterns. So let's get started. I'm just going to reset that chart with 1,000,000 things on it and load my regular. There we go. And here's my regular. Left side is daily chart, right side is the 15-minute chart. I'll just put that away for a minute. Okay. So let's start with different types of trading patterns, reversal patterns. The first one is a single bottom or single top. I have a touch screen, so hopefully you guys can see this in real time and it'll look good. We're gonna just make sure we have our pen here. Use red. What does a single bottom look like? That is what a single bottom looks like. You got a bottom here. Draw that a little bit like that. You see that single bottom. What happens on single bottoms? Well, most people think, oh, I've got a bottom, therefore I can buy here, and it's, it's just going to shoot up to the moon. The reality is that is not the case. What will usually happen is this. Right? And if I was to draw a single top, do it like this, and it keeps going. Okay, so single bottoms fail 64% of the time. Now, throughout this little series that I've done, I will relate some statistics. Those of you who are trading single bottoms, if you're looking at the price, if you're looking at the price only, or even if you're combining it with some sort of indicator, 64% of the time, it's going to do this. It's going to fail. We need to understand that, because what you're really saying is 2/3 of the time, I'm going to lose. If you went to Las Vegas and you sat up on a table, whatever card table or whatever game you wanted to choose, and the person said, welcome. By the way, you're going to lose 2 times out of every 3. How long would you stay? Maybe you might stay a little bit more than most people would probably not stay at all. They would leave and say, look, the odds are not in my favor for me to win. I'm not going to do this, and therefore I'm leaving. That is exactly what you do when you buy a single bottom on a price chart. You're literally saying, I'm willing to fail 2/3 of the time. That's what I'm going to do. And when I buy a single top and I short it and I buy puts at a single top, 2/3 of the time, 64%, I'm going to lose. So, what does that mean then for all of you? Is that hopefully after this, you guys will never, ever, 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 ever buy a single bottom. You will never, ever buy a single top. If you at least look for some sort of price pattern, and this includes even those who are doing trend trading or continuation trading, if you at least look for some sort of pattern, doesn't include a single bottom, you guys have a much better chance of success. So, if that's the case, and a single bottom fails, well, it works. So we'll go and clear this. You know, a lot of people will say, okay, I'm waiting for a double bottom. That's the next major thing. Then I see what ends up happening is this. So you get the price coming down, it does a bottom, and then it comes up, and then it comes down, and they go, oh yeah, look, I have a single bottom. Isn't that awesome? Look at that little dinky little thing that's just peaked above, and yeah, I got a single bottom. I rule, and away we go. This is going to fail. Okay? If you're looking for some sort of bottom and you're doing this and you're waiting and you just buy that little peak up, there's a strong chance you are going to fail on that trade, because more than likely what will happen, again, odds say it will more likely do this. That little stop, that little drop went up, will do that. Similarly, I'll make sure that you guys have it on both ways. If I'm doing a top and I got a top and it comes down and it does another top, and then, oh, if you buy there, right where it is, you have a strong chance that it's going to just do this and keep going, and you're going to be at a loss. But we don't want to do that. So what is the qualifications then for a double top or a double bottom? Well, first thing you want to do is you need to make sure you have a top. Okay, so there's a top. Or if I'm doing a bottom, I have a bottom. Then I need a peak up, and I need another peak down. Okay. First thing I want to do, draw a line across here. Let's draw a line across there. First thing you're going to need is for it to go above this level. In this case, below this level. That is when you truly have in this case, a double top on the left and a single bottom or double bottom on the right. You need that price. So again, I'll just draw that to make it a little clearer. Maybe I should use a different pen. So you have green coming up, it comes down, it comes back up, it comes down, and let's just use blue. It goes below. That's the first criteria for making sure you have a double top. Likewise, you have a falling, it makes a single bottom, comes back down, goes back up, goes above that peak, you now have a double bottom. There's another thing that's to make sure it qualifies really truly for a double top or double bottom, and that is it closes. You need it not only to go below, in the case of a double top, or go above, in the case of a double bottom, you need it to actually close. And what does that mean? You don't mean necessarily closing in a daily chart, because you could be on a 15-minute chart. You need that 15-minute bar to close below on a double top and close above the blue line on a double bottom. It could be a 5-minute chart. It could be a 1-minute chart. It could be an hour chart. It could be a daily chart. It could be a weekly chart, a monthly chart. It doesn't really matter. If you want to have the pattern confirmed, okay, this is what we're talking about. Confirmed. Okay? Sure, it may look like a double top. It may look like a double bottom. But for it to be confirmed, it needs to, 1, go above the blue line. So break the blue line. 2, close. Close above the blue line in the case of the double bottom. Close below the blue line in the case of a double top. That is when you truly have a confirmed pattern. So the little guys that you see that just bounce a little bit off and say, oh, that must be a double bottom or a double top, those are not truly confirmed patterns. So that what that really then means is a lot of times we have to wait. We have to be patient. That's usually the biggest or one of the hardest things for traders to learn is patience. Because they jump in and they go, okay, I've got that double top. I'm gonna be awesome. I'm gonna short it here. I'm gonna buy puts, and they didn't wait. They weren't patient, and it turns on them, and it goes the other way, and then they end up losing their entire trade if they're buying options usually. Okay, so there's your two criteria that you need in order to ensure you have a double bottom or double top. Now, some statistics that you might want to be interested in. You know that, and it goes above on a double bottom. Use a different pen. I'll use blue. 89% of the time, when it goes above, it keeps going. You know what? Let me just clear this, do it again, just so that we're clear. So, double bottom, 89% of the time, it keeps going. This is why this pattern is very, very good. Because if you wait and are patient to make sure that you actually got a confirmed double bottom, 89% of the time, you're going to make money, some form of money, because it's going to keep on going. A strong statistic that you should know and be aware of. Now, what about double tops? Oh, double tops, again, do this. 93% of the time, it keeps going. So in fact, a double top is stronger than a double bottom. Now, it's not that much of a difference, because when you take 89, you take 93, you get an average of 91% of the time. 91% of the time, a breakout of a double top or double bottom in the direction that you want it will go your way. This is why price then becomes very, very powerful, because if all you're doing is you're waiting, you say, well, if I only use a single bottom, I'm going to lose 64% of the time. If I wait for a double bottom or a double top, I'm going to win 91% of the time. Why the hell would I not do that? Even if I have some fancy indicator and whatever, it doesn't really matter. At least wait for the price to confirm, have the patience to wait for that. Miss out on maybe on some of the move, Perhaps you don't get as big of a move as you wanted to, but at least you have a strong chance of winning. Now there is one caveat. There's one caveat, and I will draw that for you so that you can see. What happens when you get one of these? So the price comes down and it does one of these. Or price, whatever, pick green. This comes up and it does one of these. These are likely to fail. These are tall double bottoms. Yep, it's a double bottom. You know, Big T said it's a double bottom 91% of the time, or 89% of the time. It's going to be successful when it breaks above here. The reality is, where the price came from, there's only this small little amount here for it to go. Hey, this little amount there is all you can get out of the trade because it's done this massive double bottom or double top. Same way on this one here. So came from here, right? And from there, it did this double top up here. Now moved down and did this massive double top. Now you only have this little bit of space for the price to move because you've got support down here. Right? This massive double bottom and double top is not a trade you should take. You shouldn't take this one because very minimal profit to be made, and more than likely it's going to reverse, come right back up. Does that make sense? I hope so. So as far as question and answers go, I thought I would go through a couple of these, and then before we get into any questions, I did mention they'd probably do questions at the end. Let's just do a couple more, and then maybe I will open up to questions, and then I'll do the next set specifically on them. So the next version, so just so let's go to here. So here's the different bottoms, the reversal patterns we're going to touch. And I mentioned, first of all, the single bottom and top fails 64% of the time. The key here to understand is the more touches you get, the stronger the pattern. Therefore, a double top or double bottom has multiple touches. It is likely to be a stronger pattern, and it is a stronger pattern than a single bottom. Also, if it goes if these bottoms are in the same direction, it's also going to be a stronger pattern. And you will see that as we go through the various patterns that I'm going to go through. There's 10 of them there that I mentioned. So just looking at, again, double bottom, double top, I have a little picture. You guys, when you're watching this video, if you want to rewatch it, you can be able to pause it on there and take some notes. But the lines are drawn basically in the same spot that I was drawing them. You need to break that blue line. And when you break that blue line, that is when you have confirmation of a double bottom and double top. Next one on the list, you go back, is what we call a 1, 2, 3 double bottom, double top. So what is a 1, 2, 3 double bottom or double top? So let's draw that. Back to here. I also have a picture, by the way. So in case you don't want to draw what I'm drawing, you can see the picture and stop the recording as well. So a 1, 2, 3 bottom is this. It comes down, it does a bottom. It bounces up. So far, looks like a double bottom potentially could be made. Then it comes down. It doesn't go all the way. It does one of these. Most of the time when that happens, you see this sort of pattern. And you'll hear people talk about it in the Discord. Look, it's got rising bottoms and rising tops. Okay. That is the 1, 2, 3 pattern. And you have the same in reverse for tops. Canvas, use red. tops, comes up, comes down, goes slightly, not as much, not as much. Okay. This is the 1, 2, 3 top pattern. Where do you buy and where do you confirm? Again, similar to a double bottom, the confirmation is on the line. Okay, we can draw that a different color just to make it clear. This is the this here is the 1 point, here is the 2 point, here is the 3 point. In order to have a confirmation of a double bottom or double top, you need it to break 2 point. Similarly, I will draw a double bottom down here. This is 3, this is 2, this is 1. Use a different color. It needs to break the green line, and then you have a double bottom, 1, 2, 3 double bottom breakout. You have confirmation. Because, as we said before, and we'll just re-emphasize it for everyone, you can end up doing this, thinking, oh, I got 1, 2, 3, right? That's what we think on a double bottom, potentially, this little tick up. Oh, I got a 1, 2, 3 forming, everything's good. And then what ends up happening, this is what ends up happening. Okay? That is why you need to have it above. That is how you have confirmed it. Without that, you don't have confirmation. You could end up having this scenario where it slightly moves up and then tanks on you. The same in reverse. In reverse, comes up, comes down. Oh, I've got a 1, 2, 3 top, and then up it goes. And it screws you up because you didn't wait. You didn't confirm. So when we go back to our little presentation here, we can see that we're entering on the break of the 2. Makes a bottom, goes up to the 2, and makes a higher bottom on a 1, 2, 3 bottom. And then it comes up, it breaks above, and now I know I have a 1, 2, 3 breakout bottom confirmed. Similarly, on the top, makes a top, comes down, goes up, doesn't go as high, comes back down, breaks through number 2. Now you've entered. That's where you enter, right here. Okay. I will point out again, it's not just a matter of breaking down or breaking through. Just like double bottoms, you want to see, I'll draw it here, just clear this canvas again. You want to see it come up, you want to see it break out, and you want to see it close above. Okay, and that close could be, again, it's based on your time frame. If you're using 15-minute charts, you want to see the 15-minute bar close above 0.2. Not just go above, but close above. That is how you truly know that it's confirmed. Let's see. Now, one other thing I want to point out for everyone's benefit is this. So you get a 1, 2, 3, comes above, closes above, and it does this. As I mentioned earlier, this here, this point, this point, this point, this point, and this point, all of those can be used for stops. Oftentimes I get asked, where can I trail my stop? So you got in over here. Okay, this is where you got in. Waited for the close above. You have the 1, 2, 3. Your first stop is here, stop 1. Goes above, keeps going higher, comes back down, does this again. I move my stop up to here. This is stop 2. Move it again to stop 3, stop 4, stop 5. Okay. That's how you can trail your stops. If you've got a chart that's doing these kind of higher highs and higher lows pattern, you can continue to trail your stops to these points. Of course, that's a lot easier to do with shares because shares you can actually use that point and the price. The options, you're going to have to sort of understand roughly where was the option at that point. Depending on the time value that's gone through, you may have to adjust for that. If it's been a day trade, obviously it'll be easier. If it's been a trade you've been holding for a couple of weeks, it'll be harder to trail those stops. But you can, in some platforms, for instance, Thinkorswim, you can set up a stop based on the price. If it goes below a certain price, you can trade the option instead. Similarly, on a 1, 2, 3 top, and it's doing the same pattern, you can trail your stops on your puts. Okay, so it comes up, it comes down, does this. You can put your stop initially here. Your breakout, you didn't enter till here. This is where you entered. First stop is the first green line, then you trail it to here, then you trail it to here, then you trail it to here, you trail it to here. And then when it does bottom and goes through, you get stopped out here, and you also go long on your calls there at the same time. So you can manage the trade that way if you like. One easy way to manage your trade as you're going through it. I will do the next one before we go into questions for the first 3. So just we've already done this one. So now the next one, I'll just go back to my list. The first one was a double bottom and top. Second one was the 1, 2, 3 double bottom and top to triple bottom and top. Now it might seem like it's pretty straightforward, and for the most part it is, but there is a couple of nuances that you want to take note of, right? So first of all, what is a triple bottom? Well, let's just make it simple. Triple bottom is it's a triple bottom. Where do you buy triple bottom? What confirms it? Same thing as the double bottom. It's to go above these peaks. Sometimes the peak, the second peak, is a little less than the first peak, and sometimes it looks like this. Okay. Generally, the concept that you're trying to do is you might have bought here, or you might do there. It depends on how you want to trade it, but generally speaking, that is where buys would happen, either here or here. Some people like to really wait and make sure. Others will get in on the first line. There is what a triple bottom looks like. Similarly, in a triple top, it's the reverse. I will just draw that just for everyone and the video purposes. See it? The triple top looks like this. Right? There's a triple top. Now, there is a couple things that you want to be aware of. First of all, similarly to what I mentioned on a double bottom, same applies for a triple bottom and triple top. And that is, if you get stock that looks like this, you don't want to trade these, because again, there's only this little bit of space. It's moved way too much up and down. The up and down movement on this triple top, and if there's someone's looking at this, might even think it's a triple bottom. The movement between the two lines is too large. So you want to generally avoid those, because if you're able to trade it for some other method using some other indicator, and maybe you got in here and you could trade it down to there, and maybe you got in there, you could trade it down to there, etc., etc. But generally speaking, if you get very big M's, okay, like that, you don't want to trade it. And if we reverse it again for the bottoms are the same thing. You do not want to trade these large things that look like that. be your triple bottom. Because the breakout is only going to be this little piece. Not worth your time. Okay. The other thing that you should know about triple bottoms and triple tops is an interesting little fact. I have to draw it in order for you to see it. A triple bottom looks like this. And a triple top looks like this. I'm going to draw a number in between. 84%. 84% of the time, a triple bottom or triple top will pull back. And what does that mean? Well, let's draw that. It will pull back. Do this. Or it'll pull back. Do this. 84% of the time, triple bottom or triple top will pull back. What does that mean? It means that generally speaking, if you want, and most people who trade these will, is they'll wait for the pullback. Sometimes that pullback looks more like, let's do it on the tops. It looks more like this. And what they'll do is instead of buying here, they'll buy here. Maybe draw a different color. Instead of buying here, end up buying here because 84% of the time, you know it's going to pull back up and then tank. Right, so they're going to try to get a better price and a better confirmation. This is the move to take. It's an interesting little fact most people don't realize, and a lot of people just buy that bottom and they're trying to buy right down here or sell right down there. If you wait for the pullback, you will be more successful. And I bring that up because, again, this is really highlighting a key that I stress it a lot in the chat. I will stress it a lot tonight. But you need to have patience. Everyone needs to learn to have patience. Too many people are trading and getting in too soon, and they're not having patience. As a result, they end up with very bad fills. They end up getting in way too soon. And it is always, 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 always better to be late and be right than to be early and be wrong. That I can't stress that enough. I'd rather miss the move entirely, even if I'm a breakout trader. Even if you're one of those, you're an active day trader, you're trading breakouts, you're not even trading reversal patterns. Even if I was one of those, I still rather miss the move and be right and have patience than to try to preempt the move thinking that it's happened only to get ruined as it goes against me. I can't stress that enough. So please, if for those of you who are newer at this, we understand a lot of the people who've been doing this for a long time are still struggling with patience. It's not easy, and still, even when you have 25 years experience, every once in a while you get in too early. So I can't stress it enough. Keep working on your patience, keep waiting. You're better to be wrong, or sorry, you're better to wait and be right than to be wrong and be early. So that covers our first three patterns: double bottoms, 1, 2, 3 bottom, which is similar to the double bottom, and the triple bottom. Before I go into channels, let's take a few questions. And I don't know where all the questions are, so I'm going to rely on our mod, Tommy, and I rely on Moonshot to help me out with questions if there are any. I can't not see the Twitch, so I don't know if any questions were posed there. Do we have any questions, guys? Do we know? I'm getting a few people messaging me personally, but I haven't read them. Hey,
Well, they're kind of all over the place, so I'm trying to find
that's fine.
where
That's fine.
where they're mostly consolidated. IR455 asked that he read that for 1, 2, 3 patterns, the deeper the retracement, the lower the probability of a reversal. And I guess he just wants to know if that's true or false.
So you're saying on this that here's the 1, 2, 3 bottom, that the farther this goes down towards number one, more likely it will fail? Does that sound like the question?
Yeah, more likely that the reversal will fail.
Yeah, I don't agree. And the reason why I don't agree is because of this pattern, the double bottom, double top. Double bottom, double top effectively is a 1, 2, 3 that went all the way down. Right?
Mhm.
So, I mean, in the end of the day, it's a double bottom, double top, and a 1, 2, 3 bottom and a 1, 2, 3 top are effectively the exact same thing. The only difference is how far down it went. This pattern is stronger. I'll go back to my list. I've listed these in strength, in level of strength. In other words, a double bottom is the weakest of the first seven. Now, 8, 9, and 10 are sort of nuances, and we'll get into those. The first seven are listed in order of strength. For example, a triple bottom is stronger than a double bottom. 1, 2, 3 double bottom is stronger than a double bottom. The head and shoulders bottom is stronger, or which is an inverse. That is stronger than a triple bottom, which is stronger than a double bottom. Right? A cup is stronger than a channel and is stronger than a triple bottom. They've been listed in order. Right? So, in a weird way, what IR is saying is true. Because if the 1, 2, 3 bottom comes down closer to a double bottom, it is a weaker pattern in theory to a double bottom. It does not necessarily mean it's weak, but I see where he's going with this question. Because in theory, yes, the double bottom is slightly weaker than a 1, 2, 3 double bottom. Does that answer the question? I think it does.
Yeah,
Sure.
yeah. I think that's a pretty good explanation.
Okay. Next question.
All right, Red to Green is asking, how do we identify stocks with these patterns? Kind of short. Yeah, this one, not really sure if you have an answer, but you could take a stab at it.
Yeah, it's hard. I mean, I don't think Thinkorswim has a pattern recognition thing, whatever you want to call it, within their chart stuff. It doesn't work very well. It doesn't really recognize them very well. It's hard to find double bottoms and double tops using software or using. I know there are some people who are very, very smart who have come up with pattern recognition type algos or whatever you want to call it. Myself, I've never been successful. I mean, I've done some algos. Obviously, some people see those when I'm on in the Discord. They see what I'm doing, but I've never been able to successfully do pattern recognition. So there's no real nice, easy answer. Of course, I'm willing if anyone has suggestions how to find them faster. By all means, suggest them, put them in the Discord, and we'll even pin the message. If there's some sort of software out there that finds them better. So, but for me, no, I mean, for me, it's the way I do it. I'm old school. I'm 46 years old. I just scroll through a bunch of charts and they pop out at me. I can quickly see a double bottom versus a triple bottom or whatever. I don't have any fancy software and I can't give you anything as a suggestion, but I'm willing to take suggestions.
All right, a few more questions. Zion is asking, is there a way to calculate the length of breakout in a 1, 2, 3 pattern?
The length, oh yeah, okay, so we're going to get into that a little bit. Just go back to the agenda. So after I'm done all the patterns, we're going to go into the targets. How far can this thing go?
Oh, gotcha.
Right, so They're in a lot of the cases, they're sort of an interval target and a higher target. Not all of them have the greatest targets. Some of them are easier or better than others, but we will get into targets. So what I wanted to do is go through all the different patterns first. Then after that, we'll get into some of the targets of each of the different patterns. So
Yeah,
I'll answer that
yeah,
later.
yeah. I'm gonna skip over the questions that are asking about price targets because that's the majority of them currently. One person, Balarik, is asking if he could have access to the slides after the presentation. This is more of an administrative question.
Yeah, I mean, I can like, I don't know if there's a way, the best way to post this. It's a Word document. Yeah, sure. We'll post it somehow. We'll figure it out.
Yeah, cool. Here's a good one. Balarik is also asking, these patterns are pertinent on all time charts.
Yes.
And I
Yes, they
think
work.
he was asking, like, does it, yeah, I think he just wants to know, like, does it work on all time charts?
It does, but always understand. Everyone needs to understand this, and I say it all the time. If you're using the 1 minute, the 2 minute, 3 minute, up to the 5 minute, the relevance of that chart is a lot less than, say, an hour chart or a 4 hour chart or a daily chart. You really don't want, I mean, unless you're day trading, you really don't want to be looking at these chart patterns in a 1 minute chart and say, oh, yeah, I've got a double bottom. And that's gonna go to the moon because you're at the end of the day, you're looking at a 1 minute chart. And when you go look at that same double bottom on a 15-minute chart, let's say, you saw on a 1 minute chart, it doesn't look like anything other than one line. And the same, if you see a double bottom on a 15-minute chart, you go to a daily chart, there's a good chance that that's not even anything other than a line on the daily chart. So the longer the time frame, the stronger or more relevant the pattern is. It doesn't mean it doesn't work. Yes, you can use a 1 minute chart, see a double bottom, and scalp off of that if you wanted to. If you're trying to use that as a swing trade for 3 weeks, 4 weeks from now on a 1 minute chart, that double bottom means absolutely nothing. Probably going to fail, doesn't work. So the longer the time frame, the stronger or more important the relevance.
Yeah. Here's another good one. JC is asking, should we consider after hours pricing for locating these patterns?
No. That's the simple answer. The only time that after hours pricing, in my opinion, matters is if the stock trades after hours, or sorry, if not the stock, if the security trades after hours, such as the futures. So those matter. The SPYs and the QQQs trade 24 hours a day, so those matter. The only time a stock after hours pattern really matters is when there's an event. If there's earnings and it does a bottom or it does a double bottom with after earnings, there's a chance that that bottom may bounce and keep going back up a bit, at least, maybe even into the next day on the trade. So then you might use after hours patterns, trade them on the price. But if it's not an earnings event, if it's not a major event where it's trading a lot after hours, if you're only getting the occasional trade here and there, just because Grandma Jones in the middle of Timbuktu traded 100 shares and created a double bottom doesn't mean that has any relevance to anything. Right? It's only when there's thousands of shares trading because earnings were good, bad, or whatever. And then yes, the after hours trading matters. Is that it for the questions for now, except for targets?
No, hold on. I think Tommy was going to ask some questions, but I'm not sure where he went.
Okay. All right.
Tommy, are you there? There he is.
Okay, so can you just go on mute for a second because we hear a lot of background noise?
Yeah, I muted him. Yeah, Tommy, your mic is a little staticky and it sounds like you have a fan in the background. But yeah, I muted you for now, sorry.
Oh, I can still hear a lot of noise.
Really? Hold on.
All right, yeah, there he goes. He's muted now. Huh. Yeah, Tommy, whoever asked that, I'm going to get into targets as to what you can use. That'll be after I just go through all the patterns. So I would just ask that anyone who has questions about how far something will go after a pattern and what you can use, we'll save all those questions to the next section. If we've got questions on understanding the various first three patterns, then I'll take those. Otherwise, we'll move on to next set of patterns.
Yeah, I think we can go ahead and move on. And for anybody in the audience, if you have any questions for Big T4X, just go ahead and post them in the questions channel. That way we can consolidate them at the end and then we can do a Q&A.
Yeah, okay, good. So channels. Channels is the next one. Is also the second one that can also be a continuation or a trend pattern. You'll notice I put the little stars or asterisks after patterns that can also be trend patterns that we'll discuss next week. But channels would be the next one. So I'm going to draw a channel. So a channel will kind of look like a triple bottom, or it could look like a quadruple bottom. Effectively, what a channel is it comes down and it does this and that and that and this and whatever, some sort of pattern like that. It's created a channel. That is the next level. Now one of the key criteria for a channel is it must be greater than 15 bars. Okay? And that applies, again, in all time frames. If you're using a 15-minute chart, if you want to look at a channel, or if you think you have a channel, it should be at least 15 bars or more. If you're looking at a 5-minute, again, same thing, at least 15 bars or 5-minute bars. If it's daily, same thing. That's what determines whether a channel. This is also referred to as a rectangle, and a rectangle only because you put a little thing here, then now you have a rectangle. Okay. You can also get these kinds of things at the end, and they will look somewhat like a flag. I'm just going to clear this one. So you could get something that looks like this. Use the up, and then it does that. Right? And some people will say, well, there you go, I've got a flag. It's a weird looking flag, but you get the concept. The stock moves up. Okay, let's use a different color. It moves up, right? And then goes into this channel. You a lot of times will see these on earnings. I actually talk about it quite a bit. Earnings tend to have this scenario where after a big move after earnings, it tends to stay in a channel for 4 to 8 days. Okay, it's not always the case. It's not 100% rule. I couldn't tell you. Unfortunately, I don't know the odds, but 4 to 8 days generally is after an earnings. So if you get an earnings event, and the stock prior to that was like this and moving up and whatever, and then earnings come out and it opens like this, and you've got this big old gap here. What will end up happening is for about 4 to 8 days, roughly, will form a channel. So sometimes it doesn't know exactly where the top and bottom is, so you kind of have to wait a little bit of time. But it's something you should know that roughly 4 to 8 days it's going to take after earnings. We'll get a channel before it moves. Let's use green just to make this easier. Before it moves up like this, or in some cases goes down. Happens too. Okay. This would then be the next level. Is a strong. So in other words, again, we're talking about a double bottom, the weakest of them all. We're now on the fourth one. So a channel is stronger than a double bottom. A channel is stronger than a triple bottom, and a channel is stronger than a 1, 2, 3 bottom. And why? Because again, we go back to my little Word document here. More touches, stronger the pattern. What does it mean by touches? I'll go back to here. This is a touch, 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 right? The more touches you have on the bottom, stronger the pattern, right? And then also, if the touches are in the same direction, stronger the pattern. So ideally what you want to see, even in a channel, even though it's technically sideways, ideally what you'd like to see is let's draw a little channel over here. What you'd like to see is that the next one be just a little higher, just a little higher, just a little, like it's almost a slight curve. You'd rather see that. Now you will see occasionally this happen, and it almost like starts again the rising pattern. The idea here is the more touches down near the bottom, and if they're moving in your direction, that is ideally what you want. Okay. This here, this channel is one of the strongest patterns, and you see it. And we'll get into targets on this and why it becomes so strong, because once you see the targets on them, you'll understand that how much money you can potentially make on them. Clear that. Next one is head and shoulders, or inverse head and shoulders. Head and shoulders. So head and shoulders looks like this. That's a head and shoulders top. And this is an inverse we talked about earlier. And it has, let's use black. It has a shoulder, a head. Okay, a shoulder, shoulders, a head. This is stronger than a channel, and stronger than triple, and stronger than double. So the more you see of these, the more stronger they are. And in fact, combining the 1, 2, 3, thus even it is a stronger pattern. Now, just I guess the side note to know is that the strongest pattern is what they call a complex head and shoulders, or other people have referred it to as a double head and double shoulders pattern. It is actually the strongest pattern of them all. I don't have it listed in that way on my little Word document. But what is that? So the complex head and shoulders is this. It will look like this. It'll come up and it looks like a double top. Then it goes higher, comes down. There's another double top, comes down. There's 2 more shoulders, and goes down. Okay. This here is what they call a complex head and shoulders. Head and shoulders. Most people they're looking on the market, or if you go on the internet sites, they don't call it that. They call it a double head. Excuse my scribble, but double head and shoulders. Okay. This here is the #1 strongest pattern you will ever see in a chart. It's because you combine 2, 3 double tops Combined head and shoulders, you combine 1, 2, 3, you've combined quadruple channel, you got a channel over here, you've combined everything basically that you can possibly have. Therefore, this is the strongest pattern that you will see. Now, where do you buy a head and shoulders? How do you know that you have a confirmed one? That's important to draw. I'm going to clear this. So you will get a pattern that comes up. I'm just going to draw the single one. It creates what they call the neckline. Here's the shoulder. There's the head. There's the shoulder. I have the neckline. So here's Joe Bob. Here's his head. Here's his shoulder. And here's his shoulder. His neck. Okay, he has a very long neck, but that's not the point. The point is this is the neckline. Where do you trade a head and shoulders pattern? You trade it right here. That is the buy. Buy of the short or puts, or sell short if you're going to short a stock, but short it when it breaks below the neckline. Similarly, we look at the inverse pattern. You have a neckline. That there, and it closes above. Again, same thing. It goes above and closes above on whatever time frame you're on. That is your buy signal. That is how you know you have a confirmed head and shoulders, and that's when you're supposed to buy. Okay, and again, the double, black, double. Yeah, this idea where there's two heads, two shoulders, and still the same idea. When it breaks above here and closes above, that is when you buy. That is your number one pattern, the double or complex. All right. The next one, actually, let's just go back to the little document so we can show them. Triple bottoms, there's the channels. You have horizontal channels and bearish channels and bullish channels. And the reason why these are also continuation patterns I mentioned earlier is because they continue to go in the direction of the trend, or continue to go sideways, continue to go down, continuing to go, but eventually they break out. When they break out, that's the reversal portion. And so that's why these are both. You can trade a channel where you're buying, you're continuing to ride the channel up or down. That would be a continuation type trading, and we'll talk about that next week. Or you can trade the breakout of this channel, which is the reversal of the channel. That's what we're talking about this week. And the head and shoulders, I don't have an example of a double head, double shoulder, but there you go. It's again showing breakout of the blue line is where the entry is. Okay. Next one, there's some caveats to it as well. So the next one we have is a cup. Cup or rounded bottom or rounded top. They're also called that. Most people call them cups. And I see so many people trading cups the wrong way. I thought I would want to make sure that everyone understands it. So a cup looks like this. You have a thing coming down, and most people see this, right? And what are they doing? Drawing a line here and going, okay, I'm in on the breakout, right? That is actually the wrong way to trade a cup. And in fact, interesting fact, 74% of the time, in other words, 3/4 of the time, a cup will do this. Let me draw it with the red. Cup will end up doing this. It will pull back. And that's why, let's draw this again. Here we have our cup. 74% of the time, what's going to end up happening? It's going to pull back and create a cup and handle. Handle. There we go. I can spell. 74% of the time. Therefore, do not buy breakouts of a cup pattern. Just don't. Don't buy this. Don't. 3/4 of the time. Want to waste your money? Go ahead. Buy a cup. It's not the proper spot to buy a cup. If you want to buy a cup, you actually have to buy a cup at 5 o'clock. And I don't mean 5 o'clock in some random time frame in somewhere in the world. I mean this. I draw a clock in this. And here's 12, and here's 6. 5 o'clock is here. Okay. So let me make it my scribble a little bit better looking. If I get again, I draw my cup. It's coming down. It's coming down. It's coming down. Green. There's my clock. 5 o'clock is here. I want to buy a cup here before it is even a cup. That is the best spot to buy a cup if you want to trade cups. That is where you want to be buying the cup. However, there is a caveat, because there's caveats for everything in trading. If you get this cup pattern and then you start seeing, instead of it going up here, let's use the eraser. Erase that. Instead of it going there, it ends up doing this. If you start seeing that, it is more likely to do this. So what do? So you have the cup pattern. It's coming down. It's now moved back up. It's now moved back up. It's around 5 o'clock on my clock, roughly in as far as angle goes. I get in. Now I get in, and all of a sudden it's kind of doing this sideways channel, sort of fading higher, but not really. I should, somewhere around here, should be exiting, because it is no longer going to be a cup. It's moved into this pattern where it's come down and then has no energy, no power at all to move higher. And what's going to happen is this. It's going to turn over and it's going to fail. So if you're buying cups, you're buying at 5 o'clock. If somehow the clocks just start squiggling sideways and you want to get out. You want to exit because you do not want to be caught in the move thinking you bought a cup and it failed. Okay. As mentioned, 74% of the time it forms the next pattern, which is the cup and handle. And we'll draw the cup and handle. By the way, the cup and the cup and handle also have top versions, though you rarely see them, but they are there. So a cup comes up, 75% of the time it pulls back. Right. Again, we draw our 5 o'clock here, and we draw our 5 o'clock here. Where do you buy a cup and handle? Same spot. You buy it here at 5 o'clock. You buy this at 5 o'clock. These are the points you buy. You do not buy here. See everyone trying to buy cup and handles, breakouts. Yes, they will move and break out after the handle. There's no question of that. You don't need to wait for it to do this and pull up and say, okay, I'm in here. You don't have to wait for that. You can buy it way down here and get in nice and early. Or you could have bought it way down here, and maybe you bought one partial, bought a portion down here at the first 5 o'clock, waited for it to come up, and now it comes to the second 5 o'clock and you get a second partial. And hell, if you want, and you're really confident now it's broken out, you can get a third partial here. Third part. Okay? But you don't need to wait for this breakout. We'll get into the targets of cups so you know where these are going and where these cup and handles are going. But that's a key point. So many people, so many people are buying here thinking, I got a cup and handle breakout. That's where I should buy. Oh, you missed. So look how much you've missed. You've missed a ton. Could have got in much earlier. I don't know. You know, you didn't know. It's not your fault for not knowing, but now you do. At 5 o'clock. Don't buy at 12 o'clock. Buy at 1 o'clock. Buy it at 5 o'clock on the pattern here that I'm showing. That's the proper spot, and you will do very, very well if you do that. Let's see. I have. So let's just go back to our Word document. So that's the head and shoulders, right? This is the cup. Breakout trend reversal at this point, but that's not where we're buying. We're buying down here. Here at 5 o'clock is where we're buying. Hopefully you can see my arrow squiggling and moving. And the cup and handle, same thing. Does the cup, the resistance line that we talked about, but we're not buying the breakout. We are buying down here at 5 o'clock. We're buying down here on the handle at 5 o'clock. We're participating in all of this move, and if we bought on the cup, we're participating in all of this move, plus whatever happens when it actually breaks above the resistance, and we get all of that move too. Okay, so let's go back to here. Oh, sorry. There we go. So head and shoulders, rounded bottom and top, also known as a cup, rounded bottom and top, cup and handle. By the way, again, these do have top versions. You just don't see them very often because usually a tops end up being head and shoulders or double tops or triple tops, but you will, every once in a while, you will see a rounded cup and handle. You'll see one of these. It doesn't happen very often, but it does happen. It's the same thing. The only difference is you can't use 5 o'clock on a bottom. You're using 1 o'clock. So if I'm drawing on a top, it's the same area, right? It's 1 o'clock. Same area, it's just in reverse. Okay, so that you can participate in the move that eventually goes down here. You can get it much sooner. Right. So, the last three are a little bit spins or differences. So just in review, these first 1 to 7 are put in order of strength. So a cup and handle is the strongest, stronger than the rest. The only caveat, as I mentioned, is the double head and double shoulder. So if I was to have rewritten this or retyped this, I would add a number 8 right in here between the wedge and call it double head, double shoulders, or what they call a complex head and shoulders, bottom or top, and that is the strongest. But otherwise, then it becomes the cup and handle, followed by the cup, followed by regular head and shoulders, etc., etc. So I will take questions on those. If there's anyone who has questions on head and shoulders or cups and handles, let me know. Other than targets, I will get into targets after. Any questions you can see or?
Yeah, LA Longshot said, since you're looking at triple bottoms, but for any pattern, once the candle closes after the entry point, is it better to wait for a retest and potentially miss the move, or get in on the very next candle that opens and does a minor dip?
It's a great question. A lot of people will wait. I tend to wait. You'll notice many times I say, and a person will say, well, I see a double bottom and it's even broken out. And I just like to wait. I just learned over the years. And again, you have to understand, I've been a long time at this. My patience level is much higher than maybe everyone, if not everyone, most people on the Discord. So I don't mind waiting. So I will tend to wait. Is it wrong to say, okay, it closed above whatever pattern, and now I'm going to buy as soon as the next bar opens? No, it's not wrong. I mean, many people would do that. They've got confirmation. They got the pattern. It went above. It closed above. What more do you want for it to happen? And they'll take it. And there's nothing wrong with that. And sometimes when you do take that, you get a much better price than, let's say, me, who might say, oh, yeah, I'll wait for a little bit more of a pullback. What I tend to do is I see that happen, and then I'll enter a price that's a little bit cheaper, my option. So let's say at the time of the breakout and the close above, the option's trading at $5. Let's say a long call, just to keep it simple. The long call is at $5. I might put my order at $4.80. And what I'm doing there is saying, okay, I'm waiting. I'm going to let it pull back a little bit. Broke out, yes, it confirmed. It closed above, yes, it confirmed. But I'm just going to wait just a tiny bit to get that little bit better price. Do you have to do that? No. If you want to just trade the break, and if you struggle with patience, the fact you waited for it to break above, the fact you waited for it to close, all power to you. You're learning patience. Go ahead, take the order, take the trade. Why not? There's no really right or wrong answer. Sometimes it's going to pull back a little bit. I did mention the statistic about triple bottoms, that 84% of the time they do pull back. Okay, so triple bottom and triple top, it'll have that, it'll close, and then still 84% of the time it does that small little dip. So if I'm going to draw that, just so that everyone is clear what I'm talking about, there's no misconfusion. Let me just draw that. So here I have this triple bottom, right? And draw my breakout point, and it closes above. Again, the figure and the fact I gave you is 84% of the time it will pull back. Okay? And that's probably partly why that I've learned over the years just to wait for that small pullback. And that's what I've done, just because of so many years of doing that. Do you have to? No. Could you have just bought here? Sure. 84% of the time on a triple, it doesn't apply to double. On a triple, it's going to do this pullback. And so I don't mind waiting just a little bit. I'd rather be wrong. I'd rather miss the trade, and I'd rather be late on the trade than be wrong. So that's what I do it. But there is really no right or wrong answer per se. Only that in a triple, it works more often than it does on, let's say, a double. That answers that question, I think.
Yeah. Another question by Always Learning. He said, or he asked, does volume have importance during these patterns?
A lot of people will say yes. I say no. What matters more on the volume is do you get volume with the breakout? Not necessarily on the pattern. So if I'm drawing, I don't know, a head and shoulders, let's say, okay, I have my neckline here. It doesn't matter that if I draw volume bars, let's choose black. Down here, or, again, excuse my scribble. Down here, there were these low volume bars. Maybe there was a little bit more here, low volume. What matters more is that on this breakout, is the volume increasing? Not necessarily big. You have to, there's a key there. Do I see increasing volume? That's what I'm looking for. Okay? I'm not necessarily looking for big volume, and I don't necessarily care that it's smaller volume down here. And in fact, generally speaking, as the stock is coming down, and I'll draw another one, as the stock is coming down and coming down and coming down, you should see volume look like this, the bottom, right? You should see volume declining. Okay? And only when then you start to see it pick up, should the volume then start to pick up. That's kind of what you're looking for, right? You're looking for this rising volume matching rising stock. And at the tops, if I clear this up, the tops is a little bit inverted, but it's the same idea, right? It's coming, doing that, right? Here, down on the bottom, I want to see volume kind of slowing down. The volume of selling is decreasing as it's rising. Then once it starts to turn over, I want to see the volume go. Okay? So that it matches. This is starting to pick up steam, and the volume is also starting to pick up steam. But I don't really care over here. This bar was small or big, or I really don't care. It's irrelevant. It's more about the trend of the volume, and is the trend of the volume increasing as we're starting to break out? That's what I'm more interested in. Does that make sense to everyone? I'm hoping yes. Unfortunately, I can't see a bunch of nodding heads, so I'm gonna hope that that all made sense to everyone. Again, the volume really wants to start to increase as we're breaking down or breaking up, depending on whatever it is whatever direction we're going.
Yeah, he said he understands and he said thanks.
Okay, good, excellent. Any other questions that you can see?
Yeah, Taps is asking, how do you differentiate double or triple top from a channel in real time?
Usually it will take a little while to know. It will start out like a double or triple top, and you won't know. And that's the reason why you really should wait. I mean, you just don't know. Like you might see a stock and he talked about tops. So let's use a top. So it comes up, comes down, comes up again. Maybe it does this, and you go, okay. I think Big T was saying that's a 1, 2, 3 top. Then it comes down and does this. Oh, okay. That's no longer a 1, 2, 3 top, but it still hasn't broken above, so that's still a top. So maybe now I have a triple top, I think. Oh, it comes down. Oh, and it comes out. And then once you sort of at this point, those with a trained eye or whatever, or with a little bit of experience, start to go, okay, that's not a double top. That's not really a triple top. That's not really a 1, 2, 3 top. We've just started to form a channel. It just takes time, and that's again goes back to what I was saying earlier: patience to wait for the move to develop. Everybody wants to get in here, right? They want to get in here. This is where everybody wants to be. They want to catch the top. Guess what? You will almost never catch the top. You will trade for 25 years, and if you hit the absolute top more than 5 times, you are something special. Because nobody hits the absolute top. Nobody hits the absolute bottom that very often. Right? But we're all trying to, right? We're all trying to get to these points. That's why we need to learn that patience is important and just let the thing develop. And then it develops and go, oh, we're in a channel. Right? I think HD. Yeah. HD is a good example. You guys can see my chart, right? Hoping.
Yeah, we can see it.
Yeah, okay, good. So here HD came down from the bottom, came all the way up to this top, came down. Okay, I've got a single top. Great. Come up here. Now I've got a 1, 2, 3 top, right? 1, 2, 3. Down. Oh, okay, I've got another 1, 2, 3. It's kind of weird, but fine. Oh, another top. And up it came here. Now I matched the tops that actually went slightly above, believe it or not, which is still in the same range. So I still call this the same. Basically, this top and this top are equal, as is this top. And it comes back down to this bottom. But I've quickly looked at this and said, hold on, I'm in a channel. It's exactly what I'm in. It may not be the most prettiest, most cleanest channel. It's a channel. Okay, so if I take this screen, put on here. That bigger. Now I can use my pens. We'll use red. Why not? Okay, what do I have? I have a channel. Okay, this is the move that came up. It's done all these little pops. That's a channel. If you look at a daily chart, which is on the left, see that pattern, and it's actually turned into a little flag. So likely it'll do this a little bit and then it's going to go there. That's what's going to end up happening. At some point, Home Depot is going to break out of this point, because on the daily it's a flag, and we'll talk about flags next week. Flags are not on, because a flag is a continuation or a trend pattern, not a reversal pattern. That's Home Depot, and that's how you tell if it's in a channel. You actually have to wait. You have to wait for it to play out, because if you're looking at this, and I go back to this thing, and I'll use a different color. Let's use blue. What was I waiting for? I was waiting for a top. I was waiting for a bottom. Needed another top. Now what did I need for it to break down? Needed it to this, below. Doesn't. It goes like this, and then it goes up again. Okay, fine. Our continuation trend trading system, I need it to break above. It doesn't. Not yet, anyways. What does it do? It comes back down, tests these bottoms, comes back up, tests it again. I know that if I'm doing a reversal pattern, I need it to go below here. Until it goes below here, it's not a reversal. By waiting, being patient, I didn't get caught. I'm just sitting waiting. Yeah, my time on my option is burning, and that sucks. Well, if you're on a long call, let's say by long call is down here, like I did. Yeah, it sucks. You have time burn, right? But as far as a reversal pattern, no, it's not a reversal pattern. I would never short Home Depot here, ever. I wouldn't short it up here either, because I'm in a channel until let me rephrase that. I would short it if I was scalping or day trading. Maybe I'm shorting here. Sorry, let's use green. Maybe I'm shorting here, buying here, shorting here, and then whatever, or shorting here, buying here, whatever. If I'm scalping. If I'm trend trading, or if I'm reversal trading, or if I'm swing trading, or whatever, it's in a channel. I'm not going to trade the breakout, and I'm not going to trade the reversal. Does that answer the question? I think it does.
Yep, sure does.
Okay. Any other questions you can see, or we'll go on to the last three, and then we'll do targets.
Yeah, there's somebody on YouTube that asked, what is the best way to see volume on Thinkorswim? Or is it just the basic one that they provide?
You look down here, I mean, you can adjust the colors and whatever on volume and Thinkorswim, but all these little bars down here, those are volume. There's going to be some spikes. This is a 15-minute chart, so there'll be some spikes on the open and on the close. That's what happens. If you go to the daily chart, you can see that not today, but yesterday, I guess. Yeah, yesterday. Today's Monday. Friday there was a volume spike. To the volumes, you just use that. Again, you can change colors. You can even have them up volume bars be green and down volumes be red. I personally don't care for that. I don't need to know for my type of trading, but that doesn't mean it's wrong. It's just what other people use. That's one way, and you can also do the volume the other way, which is what you see here. Volume profiles, and then this is based on the price, how much volume at that price. So if we're looking here at 320, the daily chart, this is how much volume has happened at 320 specifically. It's another way to do volume. But we won't really get into volume profiles and all that kind of stuff in this session because this is really about price patterns. Perhaps I will do a session on volume profiles. Somebody else might, maybe, who likes them.
Cool. And then there's one more question here. IR455 is asking, is confirmation, also known as break above, below, usually just a single close above the signal line? And also, is a V-shape count as a potential double top? If so, where do we place the line to signal a reversal?
Tommy's on again. Then let's break down that question. So, is a single close above count as a confirmation? Yes. Can you wait for more to close above, or even the pullback? As I mentioned, yes, you can do that too. And then the other question, sorry, the V shape. I couldn't quite hear that one.
He asked if a V-shape counts as a potential double top. Well, without a visual, I'm not 100% sure what he means by that.
I don't really know, but this is not a single bottom, or sorry, this is not a double bottom, and this is not a single top. This is a V shape. I'm not sure what you mean by the question specifically. That is a single bottom, not a double bottom. Okay, we talked about different examples.
Yeah, I think the double bottoms you showed earlier, like they're more of a U shape, and I think what he's asking is when you have a V shape recovery off of a single bottom, does the top of the V signify a double top still? Because on the V there's like the first top and then there's a sharp reversal and then another top.
Okay, so yeah, let's clear that up a little bit. So I draw specifically V's, and I guess they look like A's. But it doesn't have to be a V shape. So I've been all along throughout the session. I've been drawing them like this, right? They look like V's. This looks like a reverse A, right? It doesn't have to be V shaped. It can be U shaped. So you can have bottoms. Sorry, I'm using the eraser still. You can have bottoms that look like this. Okay. And I think the website, what's it called? The pattern site. I think it's called the pattern site. Not trying to give them a plug, but they call these Eve bottoms. And then they call this Adam bottoms. Personally, I think that is irrelevant. It doesn't matter that the bottom is rounded. It's black. It doesn't matter that the bottom is rounded or is a point. Irrelevant. And it also doesn't matter that the point up here that you're trying to break above, whether it's rounded or pointy. Irrelevant. And I think on that site they also show combinations of Eve and Adam, which again I think is missing the point here. Like what you're trying to do is you're trying to hit a double. If it looks rounded on one and pointy on another, and this is rounded, it's still a double. If it looks pointy here and pointy here, but then rounded there, it's still a double. It's irrelevant. So, somebody's talking. Mohammed, I think that's how you pronounce your name. Sorry. Do you want to ask something? Oh, okay.
think he just turned his mic off.
Okay. Did I think I answered IR 455's question. Let me know.
Yeah. Yeah, I think that summed it up well.
Right. Perfect. All right, so we go back to our Word document. So we've covered all of these. We're down to cup and handles. We did all of those. Those are in order of importance or in order of strength. Strength is actually the better way to say it. The strongest is 7. The weakest is number 1. Now we get to a few others that are they're just unique. Right, so let's get into wedges. So wedges are actually both. They're both a continuation or a trend pattern and also a reversal pattern. So let's just clear this. A wedge will look like this. The stock comes down. Actually, I kind of drew that wrong. Let me just erase this part. And a wedge looks something like that, or maybe if I draw the wedge first and then I can fill in the thing, but it looks, a wedge will look like this. And the stock does this. Okay, it is a continuation or trend pattern in the sense that the direction, as you can see so far, is down. Okay, and if I clear that and draw the reverse one, let's again draw the wedge lines first. Here's the wedge lines. Here's the stock. So as you can see so far, the trend is up. Therefore, the continuation or trend pattern so far is up. However, technically, or in reality, a wedge is a reversal pattern. We'll use this. So here we have an ascending wedge, or a rising wedge. A rising wedge. Okay. And a rising wedge reversal will maybe do this. It's a reversal pattern. Let me do the other one. So again, a falling wedge will look like this. Then it moves higher. It's a falling wedge. Falling wedge, but it breaks out and moves higher. Now, a few things that we need to know about wedges that you should keep handy here. First of all, wedges, just like head and shoulders and just like cups and handles, are large patterns. Okay, these are large patterns. So what does that mean? It means there's over 15 bars at a minimum. I see way too many people drawing on a 5-minute chart or even on a 15 or even on an hourly chart, and their wedge looks something like this. And they draw the thing and they go, look, I'm in a wedge. Right? Sorry, it's not the greatest drawing, but there's like 4 or 5 bars, even 15 bars, and they go, I'm in a rising wedge, I'm in a falling wedge. I'm sorry, you're not. You're in some other pattern, or you're not even in a pattern. It's part of a top pattern, it's part of a bottom pattern, or whatever it is, or it is potentially, some wedge that's going to happen in the future, but currently you're not. A wedge is a large pattern. It's over 15 bars. It also needs to have at least 5 reversals. What I mean by that is, if we look at, let me just get rid of this little wedge. It needs to have 1, 2, 3, 4, 5. Wedge, by definition, must have at least 5 reversals off these lines. Sorry, draw all the word. So hard to draw with my fingers on my screen. Yeah, 5 reversals. In order to have a wedge, whether it's rising or falling, you need to have a minimum 5 reversals. That's a key point to understand. Wedges are also the second strongest pattern. Okay, so the first strongest was double head, double shoulders pattern. The wedge comes in at the second strongest pattern, even stronger than cups. And the only reason I say that is you'll understand that when we get to targets. The cup pattern is strong, the target is not hit as much. So that's why we call the wedges a strong pattern. Now, another key thing to understand about wedges, most people fail to understand. Let's just clear the whole thing. Because a lot of people will say, well, wedges don't work. A lot of people will say that. I think I've even had a strong discussion, call it that, on the Discord about that. The reason for that is people will say, right, here's my wedge, my chart. It looks like that. 1 touch, 2 touch, 3 touches, 4 touches, 5 touches. It breaks out. Right? I say wedges don't work. Because what ends up happening is it does this. Right? It comes down. I'm going to just draw my line a little bit. And it comes down to here. And they'll say, no, wedges don't work. See? Proved it. And that's the key important factor. And there's another statistic that you want to keep track of. 47% of the time, wedge will pull back to its breakout line before moving higher. 47% of the time, it's going to do this. Half the time, a breakout will move back. Remember, we were talking about triple bottoms. 84% of the time, it pulls back on a triple bottom, right? It breaks out and pulls back 84% of the time. On a wedge, it's 47% of the time. Again, repeats sort of what I was saying earlier. Like, you will always be rewarded if you're patient and you wait. Now, you could say, well, but that's only half the time. That means half the time I missed the move. Yeah. No. But that would be my answer. So what? 7% of the time, you're going to be right. Because there's going to be some portion of percentage of the time that the person who's saying that wedges don't work is right. Not only does it pull back, but it just does this. So if I'm telling you I would like you to buy wedges, I'm also telling you to wait for the pullback because I want you to be more right. Because I know that 47% of the time they're going to pull back and they're going to bounce and they're going to move higher. You're going to get a better price. Instead of getting this price up here, you get this price down here. Why wouldn't you wait? You're going to have a better chance of, first of one, of it confirming that it is and truly a wedge breakout. 2, you're also confirming you're getting a better price. And 3, you're avoiding the scenario that perhaps the person who's saying that wedges doesn't work was right this time and they didn't work. By waiting for that pullback and waiting for it to bounce, sometimes that pullback it looks like this. Let me just erase some of this. Sometimes that pullback looks like this. It doesn't quite touch the bottom. It sort of misses it almost a little bit. It doesn't come all the way down. Still better off waiting for that pullback here. That's when you want to buy the wedges. So now if I'm doing the reverse so that people follow and don't get any sort of confusion, if I've got a rising wedge, looks like this, stock, this multiple touches, 47% of the time it's going to come up and then do that. Okay? So you want to wait for those pullbacks. You want to wait for them on the triples. You want to wait for them on almost all the patterns. And if you don't, that's okay. If you don't, in this scenario, if you bought the breakout and for a little bit of period of time, you're worried because it's moved up a bit and you're losing. You could have got up here. There's going to be a whatever. What I'm telling you is if you learn that patience, you're better off waiting for that pullback. 50% of the time. Okay, so now when we demonstrate that on the Word document, just to make sure that you can see it. The cup and handle, there's the wedge. There's another type of wedge, which is an expanding triangle, which really is just a wedge. They call this site that I pulled it from, call it an expanding triangle. The lines are a little bit different in the way that it is, but effectively it's just a wedge and it has the same outcome. Still, it's rising. Really, it's bearish. It's rising, and then it'll break down and end up moving downward. It's a reversal pattern. Same way on a bullish one, even though it's still falling, but expanding, breaks out and moves higher. These are both wedges as far as I'm concerned, even though they call it an expanding triangle. Or other people refer to it as a megaphone, the megaphone pattern. At the end of the day, they're still reversal patterns. So that's the wedge. And next one is retracements. So here's where Fibonacci comes in. So Fibonacci, just for those who don't know what Fibonacci is an Italian guy who figured out that the entire nature has this pattern, 1.62 or whatever it is from each other, seashells, everything, almost everything in this world has this fat Fibonacci pattern, and people apply it in stocks, and it looks something like this. So you have a stock that comes down, and then it does this, and then each of these different points, it's the 38%, this is the 50, here's the 62. Excuse my scribble. Oh, so hard on this. Should have got a touch pen. Would have been easier. 62. Okay. Sorry that they're not perfectly even in between it, but basically 50%, 38, 62. So there's another reversal. Is you have this long down move. Stocks when they move up, so you end up with this scenario where you get this 1, 2, 3. Let's say you tend to move. Usually the 1, 2, 3 is down here. By the way, usually it's like that. Let me clear this. I don't want to confuse anyone. Let's do this. Just so that there's no confusion. Okay, so you buy this 1, 2, 3 bottom, okay, let's say, and you're in here. Stocks tend to move to these Fibonacci levels. Okay. You do not want to buy, if you're buying a continuation or whatever, or you're buying breakouts, you do not want to buy at these points because they tend to pull back. There's another level here that I didn't mention, but this is the 23. And then there's another one up here, the 78. What ends up tending to happen is these stocks, as they're coming up, they hit these Fibonacci levels, 38, they tend to pull back. They hit 50% and they tend to pull back to 38. And then it hits 62 and it tends to pull back to 50. And it moves up to 70 and it tends to move back to 62. You are trading reversals. You are not trading here. Let me use the blue. You're a reversal trader. You're not buying here. You want to buy 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 here. So you can use Fibonacci as a way, if you're just using price and you're combining all these other patterns that I've already talked about, You can use Fibonacci also to trade off of, to buy. You can also use it to sell if you wanted to. If I was to draw this, you could use it to sell here. You could sell here when it hit these levels, but we're not really talking about that. We're talking about reversals. And so reversal patterns are trading using Fibonacci. Tend to 50%, hit 38 and reverse back down, and then you can buy the reversals when they bounce. Okay. Now you want to wait for that reversal. That's the key point I'm trying to make here. You want to wait for the reversal. You don't want to be buying as it's hitting 38 or as it's hitting 50. Okay. So if I go to my little diagram, okay. So the stock has moved up. Okay. Actually, this is the numbers have shifted over because of the way it had it. There you go. The stock has moved up. It's done a top. Did some 1, 2, 3 top, or did a double top somewhere up here. Now it's come down. It's hit 50. They tend to act as support and resistance, and they tend to go in. Does it always go up to here? No. It does tend to come here and then move back up to 38 or even 23, then move downwards, right? So you get this pattern. We're not buying reversals here. We're buying them on these lines as they bounce back up. Similarly, if it comes down, it does a double bottom or whatever down here, comes back up, it hits 38, it'll come down, it hits 50, it'll come down, and you want to be buying on those bounces of those lines as they hold. That's really what retracements is all about on the pullbacks of those. And then the last pattern, before we get into targets, is gaps. So what I'm going to do is go back to this. So it's easier for me to show this diagram. So gaps, there's various types of gaps. I will get into some of them next week because a lot of them have to do with continuation trades versus reversal trades. But gaps tend to, when stock opens, it gaps up, tend to reverse back down and go back, and that gap then ends up as a support or a resistance barrier. Okay? So you end up having this opportunity to wait again. You missed the move, you didn't get it down here, you missed the move, it gaps up, wait for it to come back down, fill the gap. It often will fill that gap. Most of the time it does fill that gap. And then you can buy it down here. The gap then ends up being your support opportunity to buy the stock, and it runs higher. This one here is a breakaway gap kind of. Actually, I should show them. Let me just clear that. I don't want to get into the ones that are continuations. The ones that are reversals could end up with a channel. Okay, here's your channel, and then it gets some sort of, I don't know, upgrade or something that opens here. That's breaking out, and you wait. Let's say you're using the 15-minute chart. You wait for the close of the 15-minute. It's broken out. That here, this is called a breakaway gap. Okay? It's broken away. Break away. I like to personally wait first 30 to 45 minutes on the open. You get an open like that, I don't know that it's not going to do this right after. Like let's say these are 15-minute bars. Here's the first one, second one. I don't know that within an hour it's going to close that gap. So I personally don't buy a gap breakout, a breakaway gap right away. I wait for it. Again, I'm being patient, waiting to see if it'll come back and fill. But sometimes it doesn't. Sometimes it doesn't do that. It just keeps going. And it looks like this. And that's a reversal breakout. A gap, breakaway. I'll talk about next week continuation gaps, and we'll talk about exhaustion gaps, and we'll talk also about there's another one we can maybe talk about now is island reversals. And that's when you get this gap way up at the top, and there's this space between here and here. This is also a reversal, island reversal. So you can trade those gaps as well. Okay, so those are the patterns. We'll get into targets, but I'll take questions on wedges, retracements, and gaps if anyone has any.
There's a good question in here. Somebody asked, and IR 455 is asking if you have stats on fib reversals.
Do I have stats on fib reversals? No. I think the quick answer is no, I don't. However, most stocks, when they do, let me draw it. When they do pull back, I'll pull back 50% of the time. Okay, or if I'm doing it the other way, this all out. Right, if I'm doing a top, most stocks will pull back 50% of the time. Do I have an exact figure for that? No. A lot of stocks will pull back at least 50% of the time. What I've noticed is in a lot of, not lately, they tend to move even more. 62% seems to be even more happening more than it ever has. It used to be 50 used to be pretty like almost a good concrete wall, and 62% now tends to happen more often, which would be this. I also want to make a note and mention something, and we'll get into this with the targets. It's slightly different in a bearish market versus a bullish market. In a bearish market, things tend to not get all the way versus a bullish market. So, how do I draw that? Let me show you. It's easier understood with targets, but you will see a lot of times in a bearish market is something like, let's say I'm doing a triple top. It won't quite get all the way, right? Because it's a bearish market, it just doesn't have the power to get all the way up to this line. That's another small nuance that a bearish market has a tendency to not have enough power to push all the way to form and fully form the pattern. Whereas a bull market will do that. In bull market, we might even see a slight peak above, and then it comes down, right? Where it looks kind of like that. Whereas a bear market, you get a lot of these first ones. More questions?
Yeah, it looks like there's a lot of questions that revolve around whether to use the candle wicks or the candle body. One of the questions was, does the pullback on wedges get invalidated if it gets a long wick but closes above the wedge breakout?
No, it doesn't. All patterns should be like I've seen it so many times. All these people, a lot of people are doing this. So let's clear this. A lot of people will draw their lines, and they will use the end of the wick in all cases. So you end up having. Okay, so let's do it like this. Have a falling wedge. Do a falling wedge. Something like this. Okay, so there's your wedge without seeing the price. And so what will end up happening is you get these lines, these bars, and the bar, bear with me. Bar looks like this. It's probably not the best drawing because I'm doing this totally on the fly here. I'll try to illustrate what I mean. When you're drawing your patterns, you want to draw where the most touches are. And I mentioned that for kind of with the beginning. Not that slide, this one. More touches, the stronger the pattern, right? When you're drawing your patterns, you want to draw them where it has the most touches. So this one here, red, it broke through the line. This is not really the best thing because I didn't draw it very, very, very well. But let's just finish the thing like this. I'm going to finish this off like that. And I'm going to finish this bar like this. Just trying to make this look a little bit easier, a little bit better. Right? Now, if I was drawing the line, I could have drawn my line like this, right? I could have, let's use a different color just so that I don't get confused. Green here. And this is black. Sorry, again, apologize for this. What happens when you're using a touchscreen? I could have drawn my wedge like this, right? Remember, I need, in a wedge, for example, I need 5 touches, right? I need 1, 2, let's draw the green line up a little bit higher. Sorry, I know it's not perfect, but anyway, you get the point. I need 1, 2, 3, 4, 5, and 6, 7, whatever, but I need minimum of 5 touches. If I'm drawing my line down here, just because it broke through, as the person who was asking, it actually closed. Let's say nothing is perfect in trading. I think everybody knows this by now. If you don't, you're going to find out really fast. You're never ever going to find the perfect pattern, the perfect setup with a perfect indicator, with a perfect anything. There's no 100%. So you're going to have some scenarios where sometimes it just peaks below a line or just peaks above a line, but then it closes below or closes above or whatever. And you're really trying to say, what does the whole picture tell me? I'm looking at this from 30,000 feet. What do I see? Not go look at a microscope and say, okay, if I look at a microscope, then this hammer, right? All I see, if I'm zoomed in, all I see is this. Right? We're talking about this thing here, right? I zoom in, that's what I see. And this is another reason why I say don't use 5-minute charts, don't use 1-minute charts, don't zoom in, zoom out. Pull it back up so you can see the whole pattern, because if you're just zoomed in, you're going to say, oh, it violated, that's it, it's over, it's done. No, because if you look at the whole thing, just did a small little whatever. Maybe even it wasn't small. Maybe it was a large because, I don't know, some market event. At the end of that bar, it pulled back, it closed above, and it kept the whole pattern. We're going to draw the whole pattern. It kept the whole pattern intact, right? You're still in the pattern. So yeah, I'm using the entire candlestick, but I'm not going to mince over a violation if it's only one or two. It has to, like, if I drew this over here, this pattern, and all the lines black, all the lines are breaking through, and they all look like that, then my pattern is not that. My pattern is actually down here, right? Maybe it's not a wedge anymore, because depending on how the pattern is, and let's say the lines, these lines are up here. Okay, well, I don't have a wedge anymore. Maybe I'm in a channel. Maybe that's what I have. I have a channel. I don't know. Depends, right? So if I'm getting a lot of these line violations, then yes, it's no longer that pattern. But if it's only one, it doesn't really matter. Okay. Any other questions before we go to targets? Because we're already at 2 hours.
Yep, I don't see any more questions.
Okay, so let's go quickly through them. So double bottom and 1, 2, 3 bottom, triple bottom. They all, well, not so much the 1, 2, 3 bottom, but a channel, a triple bottom, and a double bottom. So let's bring this back. Let's bring up the list. So the double bottom, number one, the triple bottom, and the channel bottoms all share the same targets, and they have two targets. Okay? So you have a double bottom. Do this, and this applies also to tops, by the way, just so everyone's clear. I won't be able to draw every bottom and every top. Okay, so we're just going to focus on bottom. So I have a double bottom here. What's the target? Two targets. Okay. First target is this. I'm going to use red. Distance here to here is A. Okay. Use red. That distance. It's A. First target is this. A. Okay. So I'll draw the line. That target of A on the double bottom, distance between the bottom and the top, first target on a double bottom is the same. The height becomes the height. Height of the double bottom becomes the height of the target. A equals A. Similarly, if I have a triple bottom, 1, 2, 3, okay, and it breaks a distance. To draw this a little bit better, becomes red. A. That's the first target. Okay. Jeez, didn't write that very well. Doesn't matter. Okay, so there's your first target on double bottoms, triple bottoms, and channels. Okay, we'll also draw some channels. So let's just clear this. If I'm in a falling channel, use red. Okay, here's my falling channel. If I'm, you know what, I'm going to do the whole thing all at once. I'm in a sideways channel. And then I turn into a rising channel. Do them all at once. It's easier. the distance, let me draw right here, A. Distance, or let's do over here, A, distance, or even over here. That becomes the target. So if it breaks out, and I draw my green line, if it breaks out of this declining, falling channel, it's going to move up distance of A. And if it breaks out here. If I'm in a sideways channel, it's going to move up distance A. Okay. Or if I'm in a rising channel, it breaks down. It's going to break down the distance of A. That is your first target in channels. Also similar for double bottoms and triple bottoms. Second target is width. So the first target I talked about is height. Height of the channel, the height of the double bottom, the height of the double top, the height of the triple bottom, triple top becomes your first target. Second target is a little bit more subjective because depending on how you zoom in and zoom out on your chart, it's going to be subjective. However, just to give the general idea, the width of the channel, call that B, is the height, becomes the target. Okay, B is your second target. That does not hit as much as A does. A will hit much more, obviously, because it's closer than B does. Same with a double, say a double bottom. The width, which is B, this is not really the best picture. Let me draw it a little bit better. Okay, because you could have a double bottom that looks like this. Okay. The height is your first target, A, on the breakout. And that's here. That's A. But your second target is B. B is a little bit bigger, not much bigger in this example, but that would be up here. That would be B. Same applies for triple bottoms and triple tops. So the first target on a double bottom, triple bottom, and a channel is the height of distance between the top and bottom of it. Second target is the width. And the width does not always hit as often as the height does. Does everyone understand those before I go on to others? Do you have any questions on that? The first target is the height. Second target is the width. See any questions popping up?
Laja Baba asked, how do we determine the time it will take to get to the target?
That's a great question. I can't really answer that with a straight answer. It can sometimes what you'll end up happening is this. I'm going to clear this. Sometimes what will end up happening is it goes in a channel. We know our first target is what? Our first target is the height. Okay, and our second target, our first target is A, and our second target is B, which is the distance. Okay. Generally speaking, A will hit in the time frame it takes normally to go from bottom to the top of it. You might be looking at, let's say, I don't know, a daily chart, and it took 8 days or 9 days to go from the bottom to the top. So there's a good chance that within 8 or 9 days that it took to go from here to here or there to there, it'll also hit A. B, however, it's hard to say. It does not. Many times the second target, the B, will happen very fast. That's why channels are one of the strongest patterns, because there's this, they call it coiling or consolidation or squeezing is another term that's used. It gets tight and tighter and tighter and tighter, and there's this built up tension. And then when it finally explodes, it explodes fast. Sometimes you get the breakout of B, and it happens just as fast as A would. Just blows and goes, right? Let me see. You know what? A good example was Oracle. I remember a few people were trading Oracle down here in March. Let's see if I can get back to, when was it? March 11th? Yeah. Let me get rid of this. Don't need this. Move. It's January. Here we go. So in March, when Oracle had earnings, right after earnings, I know there was a few people. I think Guru was in the trade. I even suggested buying Oracle. There's a few others who suggested it. Oracle had earnings, it tanked, and then it went sideways. And there was a lot of people who were in it, like waiting. Is it going to break out? And I think this lasted 10 days, something like that. And it did this sideways channel. I know it doesn't look like a clean one. It does this channel here. If I was to take this, just do that. We're talking about this time frame here. All right, let me just put that on the whiteboard. Screen. And we'll draw a line. So here's your sideways channel right here. Okay. And it's Tuesday, Wednesday, Thursday, Friday, a whole week, and Monday, Tuesday, Wednesday. Like you can see, it took almost 2 weeks. This is a sideways channel. Now it's not as beautiful as those ones I've been drawing, where they hit the tops and bottoms in every case, but it's still a sideways channel. It's back here. And so what was the target? The initial target is A. Right? And what is A? A is the distance from here to here. Right? And what is that distance? We look at, it's about 65 to 68. It's $3. So here, there's A. Okay. What was your first target? How long did that take? Oh, we have Wednesday, Thursday, Friday. I don't know if there was a Friday. I guess there was. I don't know if it was a holiday, but anyway, Monday. So it was either 3 or 4 trading sessions it took to hit the first target. Now, the second target is the distance. So we have this distance here. Yes, I acknowledge it's a little bit subjective, because depending on how much I zoom in or zoom out, it could affect it a little bit. But you have to try to be reasonable and flexible. There's your target for B, is the width, the height. Okay, so we add that, and we have to kind of use our fingers a little bit. But that is roughly, I'm tilting my head if you can believe me here, but that's roughly somewhere around here. Okay, that's B. How long did B take? Oh, we have another week. If it was here, then it happened within the week. And if it was there, it was another week. It was about 2 weeks. Okay. This here was 2 weeks as well. So the distance or the width of the channel It took approximately 2 weeks for it to hit the height that it became as its target. It was roughly the same. A took roughly 2, 3, 4 days to kind of hit bottoms and tops, and it took 2, 3. So the simple answer really is it's around the same amount of time that it takes for it to happen. That's a rough estimate. You can't always expect it that long. Sometimes it's much shorter. It just depends. With this specific oracle example, it takes about 3, 4 days to go top to bottom. Therefore, it took 3, 4 days for it to hit a target. It took 2 weeks or so for it to do its channel. It took 2 weeks or so to hit its target. They're about the same. Did I answer that question? I think so. All right. I'm going to say yes. All right. So targets for head and shoulders and cups. All right. So head and shoulders, what is it? Let's do an inverse one. And shoulders is like this. Okay. The neckline is here. Your target is this. The distance from the neckline to the head comes the target. That is your target. However tall that is from neckline to head comes your target. Those targets hit, if I remember correctly, they hit 89% of the time. Or is it 88%? It's 80 something. I think it's 88 actually. 88% of the time the head and shoulders will hit its target. So it's a good pattern to play because once it breaks out of the neckline, it has a strong chance of hitting its target. The next one is a cup. So let's go clear that one. And we'll actually do cup and handle too. So first of all, we have the cup. We have the handle. We buy at 5 o'clock. And here, as we mentioned, we have a resistance line. The target is here. And there's 2 targets as well on a cup and handle. The only problem with a cup, more than a cup and handle, is the second target, the larger target, only hits 37% of the time. You say, well, why would people trade a cup and handle if it's only hitting 37% of the time? Well, that's because a cup, first of all, we're buying down here, not at the breakout starters, and so we've already made a ton of money. And second of all, cups are the largest pattern. So if you take all of them and put them all together, a cup is the largest pattern. It takes months cases for it to play out. A lot of people will draw a cup on a 15-minute chart that looks more like that. Okay? And they'll say, oh, there's a cup and handle. And it looks more like a shot glass than a cup. The cup is not meant to look like this. Like, I don't want to draw anymore. It kind of looks almost like something it shouldn't be drawing on this page. But basically, my point I'm trying to make is a cup does not look like that. A cup needs to be rounded, is massive, and it takes time. And so hitting its target, which is here, okay, this distance is so big, it only hits 37% of the time. This target will hit much higher. I don't have odds, but I think it's 70, 80%, something like that. So that target, which is the initial, we should probably have called that B. That initial B target will hit much more. The A target only hits 37% of the time. But that is your target. It's a massive move. If you think about it, you bought it down here. You made all of this. You held through all of that, but then you made that much more. It's a big move. It will only hit 37% of the time. Wedges. This. The target, again, is the width. See, there's a common pattern here on these things. The width at the widest point comes the target, the breakout. Okay. Same with on a wedge. If I draw a wedge rising like this, looks like that. Actually, no, I'm wrong on that one. I apologize. This is not right. I apologize. The target is actually here. It's top of the wedge, or in this case, the bottom of the wedge. And the breakdown is the target. It's not the width. I apologize for that confusion. I shouldn't have said that. So this is A. And this is A. It's a different color. There's your target. This also, now, I've had a discussion with a few people. I don't know who exactly it was. Can't remember. It doesn't matter. Some people don't agree with my targets on wedges. The pattern site doesn't have these numbers. However, based on my testing and based on the course that I took way back, and I knew nothing about trading, this is the numbers they came up with. So you can take them with a grain of salt. You can disagree with the numbers on the targets. I've already told you that the breakout of a wedge will pull back half the time, or 47%. But according to the numbers I received, 89% of the time, a wedge will hit its target, which is, again, these numbers. And I know there are people who don't agree, and I know the pattern site doesn't agree with that. I don't necessarily agree with the pattern site. I only bring it up because I know this discussion has happened before in the past.
Hey, Big T.
Yes.
Someone
Hello.
asked, it's Riley, hey.
Riley.
Somebody asked, how do you differentiate between a breakout and a fake out?
How do you differentiate between a breakout and a fake? Well, I mean, if you're buying as soon as the breakout happens, you wait for it to go above or whatever. Let's say you're doing a breakout, so you're trying to go higher. You wait for it to go above. You wait for it to close above. It does both of those things. In theory, you have a breakout, but then it pulls back. And I've tried to give some of the numbers on certain patterns that are breaking, that will pull back. You don't ever know with 100% certainty that it's a breakout versus a fake out. Just don't. Even if I'm doing a, let's gonna clear this here. Even if I'm doing a channel and it looks like this, right? It comes down and does a channel, does a channel, does a channel, and then I've got my lines here, great. And it moves above, okay, it moved above, it closed above, great. You don't know with 100% certainty. You just never, ever truly know that is not gonna possibly be a fake out. What you do know is that a lot of these patterns tend to pull back. So for some of us with patience, for some of us with experience, we don't care if we miss move. We don't care that potentially, let me just do this again. Moving that. Potentially, okay, it closed above, but potentially it just does this. Don't care, because we have learned over the years, some of us, not all of us, we have learned that over the years that more often than not, it will do some sort of pullback, not violate the breakout point, and then do this, right? The question was, how do you know? You just don't know until it happens. You can never, ever truly know that that breakout won't potentially be a fake out. How do you counteract it is with what I'm saying. You wait for the breakout, you wait for the close above, you wait for some sort of pullback. Sometimes that pullback doesn't happen right away. And then you're kicking yourself and you're saying, oh crap, I missed this good move. I could have blah, 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 whatever. But what ends up happening is this. It moves, and then does one of these. And you go, great. Awesome. I was smart. I didn't get fooled. I got my pullback. It held, and I bought there. But the question is, how do you know? You just never truly 100% know that it's going to be a fake out versus a breakout. You can counteract it with a pullback.
I imagine you're kind of tired. So do you want to go to like 9:45, like EST?
Can go as long. If everyone wants to stay till 2 in the morning, I'll keep going. I'm good.
Wow, what a king.
No, I'm not a king, but just a humble servant. I'll keep going, but I wanted to cover at least the all the different targets. Target on the retracements is the Fibonacci. So we'll go back to here. What's your targets? Targets are it comes down, it does a reversal. It's going to hit the 38. It's going to pull back to the 23. It's going to go up to the 50. It's going to pull back to 38. Going to go up to the 62. Pull back to the 50. What's your targets? Your targets are the next Fibonacci. If you have this large move and you're able to get a double bottom or let's say a triple bottom or something down here, what's your target? At least 50% retracement. That's just pretty standard in the market. Most of the time you're going to get a 50% retracement on a large move. It doesn't always happen, but that's usually what happens. As far as gaps go, I will cover the target for a breakaway gap, which will be next week. A target on a continuation next week. A target on a breakaway gap is really, like I said before, it depends on what it was. So if this was here, it's great that this one's here. So let me remove this. Okay, and here's my breakaway gap. Got some earnings, or not even earnings. I got a news, an upgrade. The target on this gap, on a breakaway gap from the channel, is the channel's target. It's not. There's no target on the gap. There is a target on, like I said, on a continuation gap, which is way up here. Continuation gap, which I will discuss next week, is this gap. We're not talking about the gap down here. We're talking about this gap. This gap here has a target. This gap here does not. Again, you don't know that it's a gap until you have confirmation that it keeps going. Basically, the target on this gap is whatever channel was, or the target is for the double bottom or double top or whatever. So that's it. There's no target for this specific gap. And then the 1, 2, 3, which is the one I skipped. 1, 2, 3 is basically the targets are similar to Elliott waves. I didn't want to get too much into Elliott waves. One, because there's a lot of rules for Elliott waves. Two, this thing is all about price patterns, not Elliott waves. But generally speaking, just draw it. So you get the 1, 2, 3, and it goes up. Right? It goes up, goes up. Generally speaking, the distance of here comes the next target. Of course, Elliott waves, it's sort of similar, that the distance on wave 1 could be this entire move, depending on, this could be all of wave 1, right? But it's the same general concept that wave 1 can be a little bit, it sort of measures how big the next wave will be, wave 3. But I don't want to get too much into that. Basically, it's the easiest way to understand it on a 1, 2, 3 is whatever the distance here, similar to level bottoms. Distance here becomes the target for the next level. I probably shouldn't have even mentioned Elliott waves. We can do that another time, and we'll bring in people who are more experts at Elliott waves than I am. I haven't used them in 20 years. So.
Someone asked the question, how did you get into trading? What made you wanted to start?
So I wanted to be in a trading since I was 5 years old, or at least as long as I can remember. I remember watching the news and seeing all the paper flying on Mercantile Exchange and the paper flying on the New York Stock Exchange. And I live in Canada, so there was also paper flying on the Toronto Stock Exchange floor. And that's just what interested me. I immediately was like, that's what I want to do. That's what I've always wanted to do. Unfortunately, I grew up with no one around me telling me what to do or how to do it. And no one showed me what courses to take, nothing. I had to basically learn it all on my own. But I pushed and I got a job at a brokerage. I worked for a broker and I got my license there after taking a bunch of securities courses. Now, I don't know the name of the courses in the US because it's different in Canada, but basically I finally figured out I had to take certain securities courses. And I took them, and I got the job at a broker, and I never looked back. And I worked for that large broker. He was a $5 million producer, and I was one of his 4 assistants. And that's where I went from there. From there, I went on to another trading floor, and then another one. Yeah, whatever. But it all started with just watching on the news, and you have to remember, when I was 5, there was no CNBC. That was 1979. And I was, the only thing they had was Saturday Night Fever, right? Disco and whatever. So all I could see was whatever was on the news, the paper flying. So that's basically what got me interested. I said, I want to do that. Whatever that is, I want to do it. And as I got older, I realized, I can make money doing that. Oh, cool. All right. My story.
Thank you for that.
Any more questions? I think I've covered all the targets and I've covered all of that. So basically, for the agenda is any questions on patterns, and then if not, I'll take general questions on trading, on anything. If you want me to plot some charts, different symbols, I'll do those too.
So far, there's nothing new. So if you want to continue with whatever you have planned, go ahead.
I have nothing else planned. I've covered a lot.
There's people typing. Hold on.
Yeah, ask the questions. I can try to do some examples on charts. But if they just want, what do they think of this symbol, I'll do that too.
Someone asked a general question on how you chart Fibonacci retracements.
I do it automatically. I have code that's dynamic that automatically charts Fibonacci. I know there's some code out there for Thinkorswim. I took mine and massaged it a little bit, but you look at, I'm looking at Oracle. I guess is this the latest Oracle? Yeah, this is the latest. Okay. So here on the 15-minute chart, it's drawing a bottom and a top, and it's doing it automatically and dynamically. I don't have to draw anything. The code is doing it for me. So I can show it on anything. So if I don't know, let's pick a random stock, Home Depot. As soon as I do that, yellow line is the top, yellow line is the bottom. That's the 0 and the 100, and it's giving me 23, 38, 50, 61, 76, right? As my Fibonacci is already set to go. If you look at this, in this specific example for Home Depot, it bounced and went all the way to 61. It didn't stop, but 61 was, if you notice, 61, 60, well, 62 when you round up. It acted as a resistance, and then it just kept on going. It was just strong. For me, I don't have to draw them, but if you are drawing them, you want to take, let's take this move here on the daily. It's the same Home Depot. You want to take a bottom, you want to take a top, then you get your tool. In toss, it has a percentage tool, Fibonacci retracements under the arrow. Of course, Trading View has its own as well. But anyway, you take your thing, and then if I select that, I can pick the bottom, I can draw the top, and lo and behold, when I do that, it draws the lines right over the gray lines that my automatic dynamic one did. And so here we go, we hit a top. This is a very long, on the daily, there's a very long 1, 2, 3. Sure enough, it came down to 38%, came back to 23%, down through 28, came almost to 50, back up. Where is it going? Chances are it's going to go all the way back to 23. It's going to break out of this channel, and it's going to go up to here. I've been saying for a while, for those on the option swings, that the target for Home Depot is 322. I wasn't using Fibonacci, I was actually using something else, but lo and behold, there's your Fibonacci at 322. Okay, so there's likely where Home Depot will rise on its next move above on a channel. That's why it's good to have these. But for me, I personally, they're not my number one way of finding targets. I use other things. So that's why I've shaded them in darker gray, so they're not so prominent. Because if you shade them in yellow or red, your screen ends up looking like a grid. I don't want that.
Somebody asked or I read this wrong. How do you decide to trade stocks with huge gap ups like SWBI?
Okay, let's look at S. I don't even know.
It's
SW.
Smith and Wesson, yeah. SWBI.
Okay. Where's the gap?
Let me find it.
Is it down here? Is this what we're talking about?
I don't know if there is a gap. I'm not looking at the chart, but I think he's more so just trying to ask like really big parabolic runs.
Okay, so this is what I was saying earlier. So we'll say that what he's referring to is this, and I'm going to zoom in a little bit. This. Here we have a stock. Looks like that, right? So you know what? I will even, so we don't get confused, just the whole chart, the intraday. Here we have a sideways channel. Good example, actually, believe it or not. A sideways channel, I'm going to use tosses things. You can draw a line here. Okay, and we see that, but bouncing between the yellow. Okay. Sideways channel. And it does a breakaway gap. Actually a good example of a breakaway gap, right? And I said earlier that we want to probably try to wait just in case. I like to wait about 30 to 45 minutes to see if it's going to pull back. And these are 15-minute bars, and it turns out it doesn't pull back. It's just going to keep going. For me, I'm going to get a little bit worse of an entry on this if I was trading it at $21. But I would get in somewhere around here. And because it's a breakaway gap, I'm now going to look at my targets. Okay, so what's my target? So if I bring this back here, first target was the height. I could almost argue that this here is where the channel is. It's right up here. It's $20.82. The bottom is $19.54. So that first target is $1.30-ish. Okay, so where's it going to go from the breakout point? It's going to go at least to $21.30, and it's already done that. Now the next thing I'm looking at for targets is the width. Now I could argue, bring this here, just here. I could argue it was in a sideways channel for a while, but at least from here to here, okay, and what's the distance of that from here to here? If you're using your fingers and you're looking at the screen, you're going to say that distance is approximately, I don't know, $4 or $5, right? So somewhere up here. The distance from here to here is about at least here, at least there, and probably up here. Right? So it hit both targets on a sideways channel. It did a breakaway gap. There's no specific target on the breakaway gap. There's a target on the channel, and the channel, we had multiple targets that I gave you. It hit one and it hit the next. And it just kept on going. As you can see, it kept on going. Okay. But then you get another channel here, so that we can draw another line if we want. Get another channel right here. We get another channel. Sorry. We could even draw it here. We don't even have to use the spike through, as we were talking earlier, that it can spike through. So there's another channel. So now I have this distance. So the first target is going to be here. Look at that. That distance to this distance hit here. Next target is the width. The width is up here. You can see sort of what I'm doing, right? I mean, I'm just saying, okay, I got a channel. What's my targets? My channel is first the height, then it's the width. Stack them on top of it. Okay? That's how I would have traded. I would have probably bought 3-4 bars in, missed the first initial move. I'm okay with that because I want to wait for confirmation, and I don't mind missing a little bit of it. I could have also, if you wanted, waited for this whole move and then waited for the pullback. There wasn't much of a pullback. Chances are I would have missed it if I did that. I also could have used this as a resistance, these 2 points, and said, okay, once it breaks above there, which it does on the next day, I'm going to buy. I'm going to live with missing this move because I believe this thing is going parabolic and I want it to go higher. It broke above these two highs. It was in a little mini channel. It was a double top, a little mini double top. It broke above and away it went. I hope that helps. Now keep in mind over here, you can see it was earnings. It broke away on earnings. So I didn't even look at that. Knowing that it's breaking away on earnings like that, I might have bought even sooner because it's an earnings play. Waiting for the day after, it must have been strong earnings or something. And maybe I get in sooner. Maybe even on the first bar, depending. Does that help? I think it does. We have questions from others?
We have 2 more, and then we have some chart requests after. And this first one's up to you for answering. How long did it take you to be profitable consistently? Yeah.
About 10 years. About 10 years. And the reason for that is, without getting too much, nobody really cares too much of my journey. But the reason why it took me a little, the reason why it took me a little longer is because I was a little bit. I'm an introvert, believe it or not. I'm an introvert, and I was just trying. At first I was trying to find the perfect indicator. And let me tell everyone out there who's just starting, and anyone else who hasn't, who maybe been starting and been doing this for a while, there is no perfect indicator. They all basically don't work. They all have an accuracy rate less than 40-50% of the time. What you use indicators for is to give you an idea of where to buy. You use price to actually buy. If you like MACD, great. I'm happy for you. You like MACD. MACD, you're not buying when it crosses a line or crosses another line or when it crosses the zero line or whatever. Your MACD is telling you, oh, it's oversold, oh, it's overbought. Now let me go look at price. That's what MACD is telling you. Stochastic, same thing. RSI, same thing. All the fancy indicators, Bollinger Bands, whatever, anyone, doesn't matter which one you choose. They're all telling you, oh, this here is in a possible overbought, oversold situation. Now let me go look at price. If I understand all the price patterns for reversals and continuations, I can look at the price and thus trade. So back to my story. Why did it take 10 years? I spent a lot of time trying to find the perfect indicator. It doesn't exist. And the next thing I did is realize I don't have the perfect indicator, and oh, I have to work too, because at the time I was still working. So what did I end up having to do? I tried my hand in Forex. And what that ended up happening is I ended up staying up till 2, 3, 4 o'clock in the morning trying to trade Forex. And I wasted about a couple of years trading Forex when I should have just been trading stocks all along. I was trading them on my investment account, like I was buying and holding. I wasn't trading stocks. I was actually trading Forex. So that took me on a 2, 3 year sideways journey off to something else. And that's part of the reason why I never got into crypto, because I like my evenings, I like my sleep, and I like my weekends. So I've never traded crypto. I've traded every single thing else, futures, Forex, stocks, bonds, options, whatever. But I never got into crypto because of my experience with Forex. Because there was way too many nights I was up at 4 in the morning trying to trade my Forex account and then had to get into work by 8 o'clock. And it just ruined me. So that's why it took a little longer for me to realize, yeah, there is no perfect indicator, and profits weren't as easy until that point.
Somebody asked, how do you pick a stock and how long does it take before you decide? Do you read the news?
Do I read the news? No. Could care less what the news is. I am not a momentum trader. I am not a news trader. I don't care. It's nice to know that a certain stock got upgraded or a certain stock got certain news. It helps, but I don't trade that way. What do I use? I use math lines, math statistic lines in order to trade. I'll show you an example. Here, let me bring up one. There we go. No, I thought I brought it up. This one. It's over here. It's on. I have multiple screens. It moved over to the other side. Sorry. There we go. So I use math lines, statistic lines, linear regression, and standard deviation, normal distribution, and can't remember the other name of it. But basically, you see these lines on here. These lines help me to decide where to buy and sell signals are, and that's where you see these arrows. And then based on those arrows that you're seeing, so such as this dark blue one down here, just using the person who asked about SWBI, here's where I had a buy signal at the time. Then these lines were in a spot to create a buy signal. I would wait then for a price pattern or a price to confirm the entry, and I would buy. The confirmation came here on the break above here. But that's what I use. Just because I have arrows doesn't mean I'm trading. And I want to point that out because a lot of people ask me for charts, and I'm okay with that. Please, just because you see all these arrows, and you could say, holy crap, man, your system sucks. Hey, look at that. Sell, 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 sell. And up, keep it going, keep it going, keeps going. Sell. Like, your system sucks, buddy. I don't know why you're even talking about it. Well, that's because I'm still waiting for price. It's just telling me, and everyone would agree, back down here, let's just zoom in. It was this stock's WBI was trading down here, and it was moving $1 up and down. And all of a sudden, it's breaking out, and it's moved $2, $3, and it keeps going, and it's moved $5, $6. Everyone in there with any sort of smarts would say it's overbought, it's overbought, it's overbought, and that's all this is telling me. This is overbought, it's overbought, but it means nothing. It means nothing until price confirms it. So here, it's overbought, it will top, but doesn't confirm the breakdown as we talked about earlier. No confirmation, can't short it. I guess I have a bunch of arrows telling me it's overbought, but it's not. It actually breaks out the other way, which you end up seeing over here on the daily chart, and it keeps going. Again, overbought, 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 again overbought. Whole triple top, whatever, into a channel, doesn't break. It kind of broke down, kind of. I'm patient, and lo and behold, it backs back up and it keeps going, right? That's what I use. I use math lines to give me the overbought and oversold. You could be, for instance, interested in MACD or RSI or whatever, and it would, of course, it would be down here on your chart. But it's just telling you it's overbought or it's oversold. That's all it's telling you. You must use price. I've seen Guru do this. He uses RSI and MACD, I believe, and he can correct me if I'm wrong. But then he waits for price, and he'll show his price patterns, and he'll draw trend lines, and he'll do whatever, and he's buying the breakouts. He's not buying the MACD going above a certain number. That's not what he's trading. Some of the other guys who are analysts here don't even have indicators on their chart. They just have price, and they'll draw their trend lines. I think, what's his name?
Hydra's really big into doing that.
Yeah, Hydra. Exactly, Hydra. He does it huge. He does so many trend lines. The guy is bang on accurate. I'm just telling you, like, sometimes his breakouts don't work. Somebody was asking about that earlier. All he's using is price. He's doing continuation and breakouts, trend trading, not reversals. That's all he's doing. He's just drawing lines on his chart and saying, if it goes above here, closes above, maybe it pulls back, I'll buy here, whatever, and boom. That's it. Whether you're using MACD, whether you're using math lines or whatever, my math lines that I'm using, standard deviation, are not my entry. They're just telling me, oh, it's oversold. Oh, it's overbought. It's the price that's telling me my entry. Almost all the analysts that are on X Trades are all using price. Almost. I don't think all of them are, but a lot of them are.
Somebody asked, can you run through stops where patterns are invalidated?
Run through stops where patterns are invalidated.
Someone said that, like, it wasn't explained on the falling wedges, channels, double or triple bottoms, and head and shoulders.
So if it's invalidated, where do I put stops? You would put stops at previous support or resistance. Hang on, let me draw. So you have head and shoulders. Breaks out. Does this. This is what we're talking about, right? I believe.
Yeah, I think so.
So somebody's typing yes. Okay, so where we put stops, right? So stops could, now it depends on the size of this, because head and shoulders can be really, really big. You could have a stop here, you could have a stop here, or you could even have a stop here. Okay, you're waiting for it to go above, close above. Okay, great. On a trail your stop. So depending on the size, this size here is 20 cents. Well, maybe you're not using this one. Just not. But if this size here is like, a good $2-3, then yeah, maybe your stop is there, or maybe it's down here where the last shoulder was. And it goes above. Hopefully, when it did this, just erase this a little bit. Hopefully, and it broke out, it did one of these instead, because then you could raise your stop here. Right? It broke above, it kept going, but it then invalidated. But you said, oh, look, I've stepped up my stops, and I can put it here. Right? Now, depending on the type of option strategy you're using, as Time Hawk described in his butterfly session on Saturday, and I do encourage you to please watch that if you're interested in option strategies, or even if you're not, you'll learn a lot. Depending on the option strategy, you may not have a stop loss. Stop is simply the price that you paid, because you're buying a hedge strategy already, buying a butterfly, which is already much cheaper. So a butterfly pattern, B-fly, would cost you something, let's say around $3, whereas a regular long call on, say, something like, I don't know, Netflix, it costs you $7. This stop here, or here, or here, or here, is probably somewhere around $3 to $4. You get out with $3 to $4, meaning you lost $3 or $4. The butterfly, or similar patterns, if it did this and went to zero, lost $3. So depending on the type of option strategy you're using, and if you're using hedged ones, which involve selling options and buying options, you may not have a stop. However, if you're trading just regular long calls, long puts, nothing fancy, plain vanilla stuff, yeah, you would trail the stops as I showed here on the head and shoulders. On the cup, you can do that one. And the cup and handle. And the cup, you do this, you buy at 5 o'clock. I talked about if it goes like this, it's probably going to go down. You could also set your stop down here. And then trail the stop, because the let's get rid of this. Cup is going to do this, right? But it's not just going to go up, it's going to do these little mini ones, right? So you could trail those stops here to here to here to here, you know, that kind of thing. Just keep trailing them up, leaving a little bit of distance. Like you notice when I'm drawing my lines, I'm not drawing them here. I'm drawing them a little bit below. So that's a key distinction. Right? So down here, I'm leaving a little bit of space. A little bit of space. A little bit of space. See? I'm not putting my stop right on the line. Because what ends up happening is, as you know, market makers like to hunt for stops. The algorithmic trading will hunt for stops. You want to add what I was taught, they called it fluff. Fluff. Spelling it out for you in case you don't understand what I'm saying. Fluff. So if your bottom here, let's say, is $50, here is $50. You want to add some fluff or some extra to it so that you don't get triggered on one of these little jerky moves. So I might, depending on the stock, if it trades not very volatile, I might make my stop 49.80. I've added a little 20 cents of buffer or fluff, buffer too, to allow for my stop not to get triggered so easily. Same thing with an option. And the option makes it a little bit harder because you're using the option price, but you wanna add a little extra. Right? I know Kevin has asked me to do a whole session on position management, money management, whatever, and we'll do that. But basically, if you're trading stocks, you should have a 10% stop loss. If you're trading options should never lose more than 30 to 40% as a stop loss, unless you have a specific hedged option pattern. Okay? But if you're just doing regular long calls and long puts, should be around, your stop loss should be around 30-40%. If you're doing stocks, it should be 10%, and you can use these bottoms as a way to do that. What other pattern did we not give stops on? The rectangles or the channels.
The four that they said that weren't stated were falling wedge, channels, double or triple bottoms, and a head and shoulders.
Double or triple bottoms. Okay, so double bottoms and triple bottoms are simple. You want to sell here. Doesn't matter whether this is a double or triple. This is your stop. You put it again. It's similar to it's similar to the one I just drew. Like you have support. Right? The other ones they were rising, right? They were support. But you want to put them just below. Give it a little bit of buffer, a little bit of fluff, or whatever you want to call it, to allow for for a little bit of a spike through. Not a lot. That's depending on, if you're trading, for example, if you're trading a stock that's $50, I think Delta or something like that is trading around $50. Then your buffer could be, like, say, 20 cents. If you're trading Tesla, 20 cents is nothing. Right? If you're trading Tesla, you want to have a buffer, let's say, of $2, $3, $4. Right? But you're providing a little bit of buffer. So if you have a double bottom, triple bottom, it's the same thing. If you have a channel, the channel is like this, same thing. Goes below a certain amount, that's your stop. What was the other ones they said? Riley? It was Riley, right?
Yeah, my name's Riley.
Yeah, okay, right. Sorry.
You're good. The last one was head and shoulders.
Head and shoulders I just did. But I'll quickly do those again. Head and shoulders I just did. So you do this, or even this. Your stop is here. Let's do this. What's your stop point? Excuse me. Stop is just below the shoulder on the inverse and just above the shoulder on the head, the proper head and shoulders. Another one?
There's no more patterns at the moment, but this is going back to your math lines question.
Sure.
Do they refer to the same thing as pitchfork? He thinks those work around standard deviation if they're not mistaken.
They don't use. I don't believe pitchfork uses linear regression. My math lines use linear regression plus standard deviation. So, here. Let's bring. I don't know. I'm searching for a stock. Okay, so let's use the daily on Netflix. The linear regression line is the blue, or sorry, not blue. This is cyan or aqua blue color. Also here. Okay, that's linear regression. Standard deviation is the purple, red, blue. This is 1 standard deviation. This is 2 standard deviations. This is 2.5. That's what I'm using. Here is telling me now that Netflix on the daily chart is overbought. Doesn't mean it won't run. When we look at the intraday, it's just above linear regression. This thing could keep going, which is what I showed earlier, where you can even here, you see it on the daily. You see a sell signal, and it still went higher. Over here on the intraday, sell. They're not sell signals, they're overbought signals, and it just keeps on going. A pitchfork, as I understand it, and I don't remember 100%, but I don't believe it uses linear regression in order to formulate it. I believe it doesn't. It uses standard deviation for the outer edges of the pitchfork. You have to draw the line itself. You're drawing, in my case, I'm not drawing anything. Math is drawing the center cyan aqua blue line. Linear regression is being drawn for me. Whereas in a pitchfork, you're drawing the line, and then the outer edges of the pitchfork are standard deviation. So it's only using half the equation. Something similar is Bollinger Bands. So Bollinger Bands uses standard deviation to build the bands. What it fails to do is it uses moving averages as your center line. Moving averages are the slowest indicator on the planet. So that's what's wrong with Bollinger Bands. It's not that it doesn't work, and not that standard deviation is not good. It is. It's just not as good as linear regression because you're using a moving average for your center line.
We don't have any more questions at the moment, but we do have 2 stocks listed to chart. Let me see where they're. One of them's going to be Twitter, and the other one's going to be MRIN.
Twitter. Right. So let's just do a little bit of a zoom in here. All right, so now we have our intraday chart and we have our daily chart. So on the daily chart, we are still in a breakout strong pattern, whatever you want to call it. It did try to sell off, but then held the green line, the dotted green line here is the 21 daily moving average, EMA, and the purplish, bluish, grayish color there, 50-day daily EMA. It broke above those and held and kept going. So in theory, there is a resistance here that it's been holding. In theory, Twitter should keep going when I look at the daily chart. If I look at Fibonacci, just to throw it out there, Fibonacci has come up to 61%, but there's another target up here at 78%. Now, when I look at a intraday chart, it's showing that same strong move. It has a number of overbought signals, but it's never confirmed until you have price. It did a top, and let me just zoom in a little bit here, just to move the arrows a bit. It did a top, down, a higher top, thus invalidated a double top, invalidated a 1, 2, 3 top because this is now the new top. So this becomes your new top. It comes down, it comes up. Now, this is where it gets a little tricky. This day here, it gapped up, then and down. For the person like me who's waiting, I don't view this as a gap or as another top or anything. I view this more as the top because it didn't last very long. It lasted 20 minutes. 20 minutes of up and down it goes. So I have a 1, 2, 3. Okay. 2, 3 top. Then I do have this point, this point. I have this point even though it's not very strong. So then when again, here's the problem. If I'm zoomed in, I don't see the whole picture. I'm thinking, oh, if I'm zoomed in, I got a 1, 2, 3 top, held, whatever, broke down. Okay, go short. Okay. When we zoom out, we see a little bit more of a picture. When we start drawing some lines, we can draw some trend lines here too, right? Oh, okay, here's my top. Here's my other top. Here's this. And there's that. You could say I drew that wrong. So let's remove that drawing. Draw through the lines. It looks like this. This is what we talked about earlier. Someone was asking if it peaks below, pierces through, but then ends up closing above. This is a perfect example. So Twitter pierced below, and at first I drew the line here, but now when I looked at it and I drew back enough, I'm able to draw my lines through that piercing, but still obeying where it closed at for those 15-minute bars. And what I end up having is I have a channel, and when you zoom in even more, I have actually, which we will discuss next week, I actually have a flag. Sorry. Let's get rid of this. See that? So I have an up, I have a flag. So I won't get into the targets of a flag because I want to save something for next week. However, overall, the answer to this, Twitter is bullish. It should keep going after this flag pattern is done.
The next two tickers are MRIN and BABA.
MRIN. MRIN. Marin software.
Yeah.
Okay, so just so you know, for everyone's sake, I don't trade penny stocks. I don't trade small stocks. Everything I buy is over $100. It's just why people ask me this all the time. The answer is I don't want to have to worry about the fundamentals. However, I will answer the question. What I see here, the intraday it really doesn't show it very well because it's so tight, but the daily shows it. You have this long sideways channel. You can argue that it's like a triangle, but really it's a channel. You have a bottom here, you have a top there. I'll draw a line just for the sake of it. Right, this is a sideways channel, long sideways channel. First target, what was it? It's the height. Height, we bring it here. It did that literally on the first day. Next target is the length. Well, that's a little bit different scenario. Here we have from March to June where it went sideways. So when I stack this distance, wish I had a little measuring ruler, but when I stack it, I'm up here somewhere. It's about roughly around here is the height. So it's hit the second target. As of right now, I have to go intraday in order to, because the daily chart's telling me nothing as far as whether it's over or done. It's just telling me it's mooning. When I go intraday, I go up to here. Besides the fact I've got all these overbought signals, of course I do because it's so high up. I have a top here, came down, came here. It looked like it confirmed 1, 2, 3 top. Come down, so it didn't confirm it. And then this price here closed above, thus invalidating this top. So now all I have really is a single top. It's overbought. It's a single top. And until you get a top pattern on the price, all I can say is this likely keeps on going. I know nothing about this company, so I can't speak to it. That's the reason why I trade $100 stocks, because I can tell you fundamentals about some $100 stock. I can tell you nothing about Marin software.
The next ticker is BABA.
Good old Chinese stocks. That's another thing I don't
China's
trade.
taking a dump. China's taking a dump right now too.
Oh, lovely times. Okay, so overbought, double top, 1, 2, 3, double top, declining double top. There I see it. 1, 2, 3 top. Blows below here. If it goes below 226.50, it's going down. It's going to fill the gaps. I'm able to do this really, really quickly. I just try to whatever. But when I look at volume profiles and whatever on the daily, it's up near resistance. There's some resistance here. You can see it. Resistances came down, whatever. It's up near resistance. That's why it's probably slowed down. It's overbought. It has a 1, 2, 3. I would not short it until it goes below 226 because it could go higher. Right now, it's still a buy, but it's on the radar for a possible short. And if it does, we start to look at what will happen. And what will likely happen is gap fills. So it probably is going to target this gap. And if the market gets really, really negative, it might even target this gap down here. At the very least, it could do a 50% retracement, which my automatic dynamic thing is not showing it yet because of how it's designed. But a 50% retracement, 208 to 230 is $22. So $11 move from 230 back down is 219. Oh, look at that. There's the gap at 218. 50% retracement. If this ends up being a top and it gets confirmed, BABA will drop to 218 and close this gap and do a 50% retracement. There's your target. Pretty simple and fast once you get a hang of these things.
We got 3 more, so I guess the charting requests are coming now, as normal.
That's fine.
Disney,
No worries.
yeah. PLTR, Disney, and Roblox.
LTR. The PLTR, looking on the daily, has broken up above this point, but still has that one, actually two times. I remember watching it a few times. That $28 level, 27 and change, 28 is a strong level that it needs to break out. Looking at the intraday, yeah, it was overbought for a while. It's no longer overbought because of this sideways movement. That caused the lines to shift. So now we just got a top, but we haven't got a breakdown. So I would say PLTR, it probably will at the very least attempt to break out of the $28 level. If it fails, it's at 27.38, right? If it fails, then it will come back down. Again, you can't really trade that until you have a price pattern confirming the breakdown. If it goes to 27.50 and comes back down, it's more than likely going to come back down. And then you have to look at where could it pull back to? Well, this breakout of the last major sort of channel is here. It's right here. This stuff. If you look at this little, you can't see it as well without drawing lines, but if I draw a line here, right, now you can see it. There was this glut of trades in here. That's what this is. So likely what could happen is you have a channel. What you could have here is a channel breakout, broke out and pulls back whatever percentage of the time, back to the line and then goes. You can see the lines here that I just drew on the intraday. Okay. You had a channel, broke out, it may pull back to the line and then go. Right? Pull back here and then go. But it could still keep going. It's very possible. If it breaks this $28 level, which is proven to be, and there's also a gap back here. You know, if you can see it, let me here. To zoom in. There's this gap right here. Very small gap. 28 level is proven to be a sticker for PLTR. So there's two possibilities here. One, it pulls back to the breakout and then bounces and moves higher. The other thing is it just breaks out at 28 and keeps going. We won't know it happens until it happens, and then we start to look at other things. And the next thing that pops up is there's a gap here. 30. If you're using just the wicks, it's 30.5 to 31.39 or whatever. If you're using the bodies, then it's a little bit bigger gap. That would be my next target on a breakout of 28. What was the other one? PLTR and Disney, I think I heard.
Yeah, the next one, how do I tell you the list? Disney, Roblox, Spotify, and AGTC. So for now, Disney.
I have Disney on the chart. Just fix this. All right, so yeah, see how I back out because this is a channel. It's a big one, but it's a channel. It helps that my lines sort of pop up and tell me these things. So I get a little bit of advantage that way, but this is effectively a channel. It was overbought, it bounced. It did a 1, 2, 3 bottom, broke above. Here it does a top. And now we have to zoom in to see it. There's a bunch of tops, there's a higher top, and then broke down. Right now this is a sell. It's a sell for two reasons, because you have a 1, 2, 3 or double top breakdown. Came down, then pulls back up to the breakout point and drops again, just confirming yet again that it's a sell. And it's also a sell because it's in a channel, and at the bottom of the channel, top of the channel, bottom of the channel, top of the channel. My first gut feeling on Disney is this is coming back right back down to 172. Could it stop somewhere else? Sure, it could. Fibonacci, for example. Here's the 0 line. There's the 100 line. What's 50%? 50% is where it stopped on this drop. It pulled back up to 78. Where's it going to go next? It might go right back down to 38. So there's 174, which there's another small little mini support there and a resistance there. So 174 is possible. Also, 173 is possible. We have a support, and kind of a little thing here. But overall, Disney is a sell. It's a sell with likely either to hit 175 again, 174, 173, or all the way down to 171. Roblox, RBLX, right? I don't trade it.
Yeah. He said specifically as well how you feel about the cup and handle possibly on the 1 hour.
Handle on the 1 hour. I see what he's talking about. Here's looks like a kind of a cup, but it looks like a shot glass on the daily. So let's go to the 1 hour. Are we referring to this? I'm guessing that's what he's referring to.
Yeah, that's the only thing I'm saying.
Yeah, the shot glass. This is a little sharp. However, I mean we can still use the rules. What are we buying on a cup? We see the cup coming down. At 5 o'clock, we would have bought here. Okay. The 5 o'clock on the patterns, we would have bought. Now, if I look at the regular patterns, I got a 1, 2, 3 break above. It just so happens that break above area, there's another top here and here, one, whatever. You can count it or not count it. It's up to you. But basically, here is your breakout point. And it's also your 5 o'clock point on your cup. Who would have bought? It just so happens that the cup did not end up going sideways here. It kept going. Great, awesome. Now, what do we remember? We remember from our cup patterns that 74% of the time, I believe that was the number, just double check. Yes, 74% of the time, a cup will pull back. What does that mean? That means if this is a cup, 74% of the time, here's the top of the cup, which is where it basically hit. It's going to pull back 3 times out of 4, quarters of the time. When it does, you want to buy on the 5 o'clock point of that cup, and then the breakout. So what's the breakout? If this is a cup, and everyone agrees it's a cup, and the target, $80 to $94.50 is $14.50. The target that's on the breakout of $94.50 is $14.50. That's the target. However, the target on a cup only hits 37% of the time. Keep that in mind. However, see what he's saying. It's a little bit sharp of a cup. I prefer to see cups more rounded versus V-shaped. This is kind of what it looks like, a V-shape. I mean, you can sort of zoom in a little bit on the 1 hour, but it's still V-shaped. But yeah, there you go. Buy here for pullback, buy there, breakout, target 1450. What would that be? That would be 98. That'd be 109.
That's so bullish. Oh my god.
Yeah, so bullish. If I was trading this as a cup and I thought this was a cup, yes, I would wait for the pullback and I would get out 103. I wouldn't wait till 108.
Your next ticker is Spotify or Spot.
Spotify. Yes, another one of those breakout stocks. I actually did mention it was breaking out way back here. I don't know if anyone listened, but yeah, it's overbought, but it's breaking out. I have no reason to sell this. And there's a top here. It's likely to, again, unless the market goes negative, it's likely going to keep going. And where is it going? It looks like it's going at least a 50% retracement, which happens to have two tops right back up here at $299, so $300. If the breakout of Spotify was 252, it looks like the target is $300 if you have a long enough expiry option, which we won't talk about how you need to have longer expiry options and not 1 week.
Yeah, the rule 6 weeks. Come on, now we're learning from Big T.
Yeah, exactly.
Yeah.
No 1 week options. Unless you're day trading.
Sorry.
No, go ahead.
The next one's AGTC.
AGTC. I've never heard of GTC.
Neither have I. It's my first time hearing about it.
I don't know. What can I say? It looks like a sideways channel, which had a small peak above and then came back down. I actually did it twice. I see the first thing that jumps out of me when I look at this is a sideways channel, because I see bottom, top, bottom, top. Didn't quite go so much. Came up here, peaked a little above, back down. It looks like it might be doing a double bottom with a higher bottom, so a triple bottom. So you have 1, 2, came down here. I wouldn't buy this. If you don't already own it, I would not buy this until it clears this level. You see this here? It just so happens this is the same peak it came. So that's 460. If you don't own it, I wouldn't buy it unless you want to trade the channels, which you can. You can trade the channels. So then what would you do? You'd wait for it to come back down to 350, buy it down to 350, just trade the channel up and down, up and down, and up and down. If you're a breakout player, if you're a trend trader, a continuation trader, you'd wait for the breakout above 460. And then where does it go? Well, again, first target is the distance, 350 to 465. So that's $1.15. So the first target would be 580. I can't even show it on the intraday. Here, 580. So first target would be up here. And there's the distance or the width of the channel will become the height. So then we're talking about $7.50, $8 maybe. That's where the next targets would be. Looking purely at the chart, you can see there's a target here. Sorry, a resistance here, not target, a resistance here. You can also see resistances here. So it could reverse at these levels, this level or that level. But yeah, if you're trading it, if you already own it, great. It's not going anywhere until it breaks out. If you don't own it, either buy it at the bottom or buy it on the breakout. Another symbol?
AMBL.
Great.
Amble. AMBL.
AMBL?
Yeah.
Can't find the symbol.
That's interesting. We'll move on from it for now. Oh, ABML, my bad. They mistyped it.
ABML.
Or I mistyped it. That's my bad.
That's okay. Another penny stock. This is the penny hour.
It'll change after this one.
That's okay. All right. Do you know, without getting into the stock, you notice what I'm doing here? Like you're the only one that can comment, but if you notice, I had this, and I'm like, I can't really judge what it is. Okay, and I'm zooming out. Please do that. That would be one of my biggest tips for chart patterns or looking at charts. Period. Zoom out. I said it earlier. Go 40,000 feet, 30,000 feet up, and just see kind of what's going on. You don't see it when you're here. When you look at a chart like this, you could say, okay, I've got a little top, maybe. No, and I kind of see whatever. But when I go zoom out, I see a little bit better picture. I see a single bottom, came here, came down, did a 1, 2, 3, finally broke above, and went into another channel. It used previous points, previous support and previous resistance in order to build these patterns. 1, 2, 3. This 3 matches levels here and here. Then when it broke above, it used this level in order to build whatever. What I see here is I see a stock that's overbought, forming a possible top pattern because you have a 1, 2, 3, but it hasn't broken down until it breaks below $2. It looks like $2 or $1.99. Until it breaks below this point and this point, it will probably keep bouncing in this and break above and go higher. But if it breaks below $2, it's likely going back down to $1.50. It's a channel, possible top. So if you're looking at also, for those of you who look at my little chart that I post on watch lists, I've been posting on watch lists since I had my promo. You'll see I'll say a top formation is forming, or a reversal pattern may be forming. That's what I'm referring to. Something like this. You have a top, a bottom, a top, a reversal pattern may be forming, but until I get a price confirming it, it's not an actual breakdown. It's not an actual top. Maybe a top. Hopefully, when you're hearing that now, you understand what you read when you see my Excel spreadsheet signals. Symbol.
Baidu. Baidu.
All right. Oh yes, the one of the ones that was hammered on that March drop. Not as much as others, but single top. This is and this goes back to what I said earlier. And here's a good example actually. Just zoom that in a little bit. And we'll bring up this. We'll put this side by side. Clear this. Right, so what do we have here on Baidu? We have top, came down, and then it's done this little I don't want us to call that a little That's what it's done here. Over here, this little So, is that a top? No. So don't treat it as a top. Just because it did a little small little down bar, red bar, green, whatever, down bar, doesn't mean that this is a 1, 2, 3 top. It's just not. You need more pattern. You need to see here, like if I was to draw it, I need to see another line and another line and another line. And then I still need a break below. Sorry, that didn't come out as straight as I was hoping. Here. Still need it to break below. Close below. And I have a pattern. Right now, all I have is a single top. I wouldn't even call this a 1, 2, 3. A 1, this is not a 2. Maybe a 2. I don't know. It could end up dropping. It could end up just dropping. Look like this. And then this is my 1. And this is my 2. And then up it goes. Right? And then it creates this. And then I have a 3. Or I have a double top. However you want to look at it. Doesn't matter. Right now, this is nothing. This is just a single top. It should keep going. It's just bounced. And when I look over here on the daily, without even looking at the daily, now that I've looked at the daily, I can see that. Here we have a breakout. It is broken above this point. Which is a 1, 2, 3 breakout. That. Okay. And it closed. Did it close above? Closed just above that. Okay. Now, how do we trade it? We could wait for the pullback. Okay. We talked about this earlier. We could wait for the 1, 2, 3 small pullback. So maybe it comes back down here and holds. We can just buy it. Right now, Baidu is a buy. The 1, 2, 3 breakout, both on the daily, on the intraday, it's a buy as well. Where is it going? Well, let's start looking at targets. Here, possible. I also use my math lines for targets. So if I was looking at intraday, I'm looking at least up to 211, 212. And yeah, I don't want to get too much into my system because my system's irrelevant. We're talking about price patterns. So yeah, we're looking at targets around here. Here. And then there's also the 50% retracement, which would be way up here. So, or maybe no, that's 38. Wow, 50's way up here. Jeez, yeah, that's possible. Possible, not likely, not at least not on the first run, but possible. Right, next one.
Snapchat.
Right.
Snapchat. Our good old Snap.
Yeah. Anything over 100, well, 66. I know the symbol. Jeez. I want a dog's breakfast. Notice I keep going, zooming out, zooming out. Big ass channel. Sorry, I should say ass.
Ooh.
Big channel, big large channel. Formed. Big large channel that formed. Traded the channel. It looked like we have a channel breakout. It came back down to the breakout point. Look at that. We zoom in. Oh, it breaks above. Oh, it comes back down and retests. That's why we wait. Now what happens? What happens likely is after that support, if it holds, likely will run up to here. If we look at the channel height, it goes a lot higher. The target on that is a lot higher. We're at $48 to 65. That's 17 move from 65. So that'd be 72, 82 is where the first target would be on this channel. When I go intraday, yeah, it's the same. $82 is the first target, although the first target in my mind is 73.59, which is the all-time high, or at least the 52-week high. That's where this goes. And as long as support is held, support starts to get violated, if it's only a little bit, because it can happen, and I mentioned that before when I was drawing. Let's bring this back clear. When I was drawing, we could have this channel break above and then come back down and do this. So it doesn't have to hold. You can go a little bit lower, not a lot lower. So as long as we're in the, let's say $62, about $3, as long as it doesn't go below here, it should keep going up to 73.50. Potentially hit the targets of the channel, which are much higher. I didn't even look at the width. The width is even higher. I don't even know. Does Snap have a higher price?
No, that's the all-time high.
Is it? Oh, okay, yeah. So then, yeah. So yeah, that's. I think Snap is going to keep going up to this high at least. But again, it all depends on what it does here. If it holds support. A good place to buy too.
Sorry.
It's a good place to buy. I was just going to say, like, as long as it's holding, it's a great place to buy. Like, you haven't missed it. You can't say, well, it would have been nice to get it back down here if you're trading it. If you haven't been trading it and you're a trend trader, great place to buy as long as it holds.
Yeah, I took 716 swings today, so I'm excited for it. You just made my heart happy.
As long as it holds in this,
Yeah.
like you said, that Chinese or whatever the hell's going on overseas is no big deal.
The next one's gonna be Boeing.
Favorite of many.
Yeah, man.
Boeing has held 21 day. You don't see it here. Yeah, I was holding these lines before. Let's just look at it now. So in the daily chart, I have a 1, if a declining top, 2, 3. On the intraday, obviously is a little bit different. You got to buy down here, you got to sell here. If we zoom in, you see a top, a bottom, a top, and a drop, and a breakdown. And then you see a gap down. It's a sell, has a gap to do the sell. The only thing I would add as a caveat is that it traditionally likes to hold its moving averages. And that's what I was mentioning that earlier. It likes to hold the moving averages. So both 50 and 21 daily EMA holds them. It's held them here, held it here, even though it went pierced through, it held it and then broke down, right? So again, now we have it coming back down in the moving average. If you're long, attention, if it breaks below here, it's going a lot lower. If you want to go short, kind of missed it, you're going to wait for a retracement, because you should have shorted somewhere here. Or if you were patient, you waited for the pullback, as we talked about, and it pulled back to here, and you went short there. There's another way to play it. That's why I like pullbacks. I really love. That's what I do. That's why. Just to clarify that. That's why you'll see a lot of my signals and say, oh, such and such stock is oversold or overbought. And you don't hear me talk about the stock again the next day, the day after, because I'm waiting for the pullback, and that can take days. And I even mentioned it in my note when I send my alert. I said at least 2 to 5 days for it to develop. Sometimes it takes even longer. I just prefer to wait for pullbacks. Just more reliable to me, and I don't mind missing this move. Now, a breakdown, trend following person. I'm not picking on Hydra, but let's use Hydra as an example. He might have had a trend line here. He shorted here, and he made a ton of money, which is awesome. Great, it's perfect. And anyone who followed that, I don't know if he did or not. Let's use ABC analyst, whoever that is. A random analyst in X-Trays could have had a breakdown here, and then they made a ton of money. Just for me personally, I prefer to wait for pullbacks. So I wouldn't have traded this. The only way I might have traded this is if I somehow was watching at this point here. Maybe I grabbed it. I don't know. I probably would have been the guy who bought it here. Shorted or bought puts here. It's just me. There's nothing wrong with my style versus someone else's. It's just different. As long as you learn how to use price. Both reversals and continuations. Any other symbols?
The next one's gonna be low.
So similar to HD, right? I think that's what someone said today. Really? Not really close to HD. I'm struggling to call this a channel because this is really a lower bottom. It's not really a channel. Like you can see it more here in the daily. This is a lower bottom. This is a 1 bottom. I don't really see a 2 here. It's hard for me to see it. I mean, this is 15-minute chart, and I still don't really see a spike. Is it breaking out of this level? It could. If you ask me, this looks more like a potential double head and shoulders. I mean, the head is really small. See a little line and a little line here. Could be a double shoulder, but only single head. But here you have a shoulder, a head, I would say it's possible that this could come back down here and do 2 more shoulders. It's not really a 1, 2, 3 bottom. It's not a double bottom. It's not a triple bottom. It's not a channel. It's not a maybe it's a stretch, but maybe it's a cup. Maybe you have this kind of curving format. It's kind of a stretch. It's a stretch to call it a cup, but I see no pattern here that is so strong that says, oh, that's this. I just see a potential double shoulder, single head pattern, or a possible 1, 2, 3, and then breakout. It's hard for me to call it a channel. It's hard for me to call it anything else. On the daily, on the math lines, we're getting some buy signals here. It's very messy. It's not clean. I don't know what to say. I'd love for it to be a breakout because, it's similar to Home Depot, and I own Home Depot. I don't see a breakout yet. Maybe if it goes above here, then we can call it, I don't know, maybe like a small cup. This pattern here, which you would have bought down here on a cup. Right? This would be like a little mini 1, 2, 3. Very small. Zoom in. 1, 2, 3. And you would have bought on the breakout here, which is the 5 o'clock point on a cup. But it's not clean. So I wish I could give you a better, or give whoever's asking a better answer, but it's a messy chart. It's not to say it won't break. It could very well break and go right back up to here. It's just not clean. It's not something that I would personally say, oh, I love that chart. That chart is awesome. Let me buy that. No, I don't love it. I don't really know what's going to happen. Next one.
The next one's going to be X.
Another popular ticker symbol.
Yeah, this thing got beat to the ground.
I don't know why everyone loves X, but anyway, I never quite got that. Maybe it's just the idea that it has United States in the name. I don't know. Buy signals on the math lines. 1, 2, 3 kind of format, or even here 1, 2, 3. Held some. It looks like it's holding some supports, although it does have to get back above the 21 daily EMA. Is also here on the daily and here on the intraday. I think if it can hold this support and go and start to make its way back above into like high 23s, 24s, it'll likely keep going, go right back up to here. It has to hold. The only pattern that I see here is a 1, 2, 3, either 1, 2, 3 here, or if you want to be more backed up or zoomed out, then 1, 2, 3. It cannot go back down. If it goes back down, it'll likely break down, and then we start to talking about these levels, $20.50 or on there somewhere. It has to hold support. Next one.
This one's gonna be our fan favorite. The crowd loves this one. Give it up for Tesla.
Oh yes, Tesla.
Oh yeah.
Tesla, I own shares, so there's my disclaimer. I have shares in it. I do not have stocks, or sorry, I do not have options. Zooming out, you see the nice double bottom. The intraday from March to May, a nice double bottom. Yeah, March to May. There it is. Looking at without drawing trend lines and doing continuation patterns, breakout patterns, or breakout, yeah, without doing the breakout patterns, I want to save that for next week. You have a 1, 2, 3 bottom, 2, 3 bottom. Yeah, a 1, 2, 3 bottom. There's actually, I see 2 other patterns here. They're both breakout patterns, not whatever. So you actually, interesting. You have a continuation. That's what it's called, right? I'm just double checking my notes. A continuation gap. So we're going to talk about continuation gaps. It'll be interesting to see where Tesla is next week, because continuation gaps are the only gaps that have targets. So if this is truly a continuation gap, it's going to be fun. But yeah, it's a breakout 1, 2, 3. It should keep going. The only thing holding it back right now is the fact it looks like a 1, 2, 3 top. As long as it doesn't violate this level, this gap, this level, as long as that doesn't violate, it should keep going. In fact, it bounced here. I don't know. Again, it's only 3 bars, so we'll have to see. But it's a breakout. And we know $700, everyone who trades Tesla knows $700 is a key level. It has been for months. It's just, yeah, look, 700 broke out, came down, played around in 700s again. Did the 700, went down, went above, did 7, broke below. 700 is a key level. So as long as 700 gets broken, we're looking at potential revisit of 780. That's what we're thinking. That's what I'm thinking. 780 revisit, as long as support gets held. Can it go above 780? Well, yes, it can. You just have to see what happens when it gets there. It's probably going to need some sort of boost at the open. Break out at 805 or something, crazy like that on the open. Anyway, for now, we're talking about a stock going up, breaking above 700 and keep going. Next one.
All right, so this guy requested 3, but I'm only going to pull 1 to keep it a little bit more fair to give everyone a chance. A lot of people have been talking about this because of Hydra's analysis on it. Could you do Beyond or BYND?
Okay, so before I even open the chart, I want to give a disclaimer. And the disclaimer is I have no idea what Hydra's been saying about Beyond. I think I read somewhere he's saying it is breaking up, blah, blah, blah. I don't know. I haven't even looked at the chart.
It's just
If anything, no. If anything I say is different than what he thinks, that's just my opinion. Okay, so I really try my best to not put one person against another in their analysis. I oftentimes will not comment a stock that another analyst is recommending because I don't want it to sound like I'm trying to one-up them or give a different viewpoint that's whatever. So with all that caveat said, let's look at Beyond. I don't know whether I will agree or disagree with his analysis because I don't even know what it is. All right. So let's just, one thing I want to say, a flag is a continuation pattern. That's next week. Okay? For starters. We do have some overbought signals on the math. We had a top this top got invalidated. So this became the next top. It has done this pattern 1, 2, 3, 1, 2, 3. It did rig below these points, potentially being a short. This is why you also need to understand continuation patterns, because even though it is potentially a breakdown, it's not because of the continuation pattern. I see what Hydra is talking about when you said a bull flag. I'm going to put this on the whiteboard because it's easier to draw. Oh, print screen. Paste. All right. That's Oracle. That doesn't work. I don't know how the hell I got Oracle. Undo. Let's try that one more time.
For some
Yeah.
context as well, his price target on Beyond is 165.
165. Okay. All right. I'm not going to get into the target of a flag until next week. So I won't say what my target would be. I will next week when I talk about flags. Somebody remind me to look at Beyond flag, and I will we'll talk about it. Let's just see if I can get this to put on the whiteboard. Is that right? Yeah. Excellent. Okay. Yes. So, drawing lines, red. Do this. So, triple bottom. 1, 2, 3. Okay. 1, 2, 3. And we can call this a channel. It's not really a channel, but we can say this is a channel here. Or we can say a break above this point. Either or, doesn't matter. And it breaks away, and it does a breakaway gap. That's what this is. It broke out of the channel, and it broke away right on the open. So we showed another stock earlier. I can't remember the name. But you would wait, and you're probably getting in somewhere around here, roughly. Or potentially right on the open if there was some sort of news that caused this breakaway. I don't know. Whoever knows Beyond would know. But anyway, there's the breakaway gap on the 1, 2, 3, and then you have this big push-up move, and this is what Hydra is talking about. You have a flag. If you look on the daily, the big push-up move. I know my lines are not the greatest, but you get the point. It's a flag, and it broke out of the flag. This has a target. What did you say his target was? 65?
Yeah, 165.
I will discuss the targets next week, as I said. However, his target is too low. It's higher. It should be higher. Should have a larger target than 165. Yeah.
That's just his first price target for context.
Okay, well then that's good because without getting into targets, without saving something for next week, yeah, 165 is bare minimum. If this flag here, whichever side you want to look at, if this actually plays out the way it should, this is going much higher than 165. And it'd be interesting to see where we're at next Friday. We can talk about it. So you know what? I'm going to make a mental note of that. I'm actually writing this down. So flag pattern, I want to look at bond. And for the continuation gap, we want to look next week at Tesla. I don't know if there was another one we mentioned. I think there was another one we mentioned earlier to look at next week to see what it's at. But at least we got two of them, flag and continuation. Yeah, so yeah, this is definitely, I agree with Hydra. This is a flag breakout, 100%. And there's where knowing all the patterns matters, because if you just knew your reversal patterns, you have a 1, 2, 3 top, break down, okay, I shorted. And you'd be like, today, you'd be royally pissed off. You'd be like, okay, what the hell? I took the 1, 2, 3 breakout just as Big T4X said, and it should be dropping, and I should be making a lot of money, but now I'm getting killed. What the hell's wrong with him? Because you didn't wait till next week when you get the flag patterns to tell you what happened. That's why you need to know them all.
This is something that can help out. This is more like me telling you to tell other people. But when something breaks out of a bull flag, do you like to wait for that confirmation of the back test first?
Not so much on a bull flag.
Okay.
I will get into what you wait for and what you don't wait for. We'll go through a bunch of continuation trend breakout patterns. Bull flags are one of them.
On that note, your next ticker is going to be V.
Visa.
Yeah, Visa. And you could also, if you could look at it for me, MasterCard as well,
All right,
since
I'll
they're
do
both
that too.
sisters.
Yeah, no worries. You had a buy, 1, 2, 3, support held. Did a series of rising 1, 2, 3 bottoms. 1, 2. You trailed your stops. Here, you trailed them again. Again, waiting for waiting time to trail them. Don't just trail them just because, oh, look at there, there's a little line. No, you have to wait to trail them, but you got a series of rising bottoms. Then have this top here. This, actually, you know, I'm writing this one down too. This is a good example of an ascending triangle. Writing this down, ascending triangle. We're going to see what V looks like next week. Right now, you have a double top here. It's held resistance. It came down. This is the initial push. So 1, 2, we need it to break below here. However, we also have an ascending triangle. And without getting into all that, which we're going to wait for next week, we can draw the line and you can see it just to give you an idea. I can actually prefer to draw it on the daily. Let's draw it over here. You can see this line. Look at that. And you notice I'm not necessarily using all the bottoms. I use this one, I use that one, I let that one pierce through a little. I use this one and I use this one. This is a 45-degree ascending triangle. I am interested to see what will happen next week. Based on this pattern, this should break out and move significantly based on this pattern, if it holds true. So right now, yes, you have a overbought, but it's not a sell because you don't have price confirming the sell. In fact, if you know all the patterns, you have price telling you that more likely this is going to break out and break out large. So that's V. MasterCard. MasterCard does not look the same.
Interesting.
So, yeah, interesting, exactly. So MasterCard, I called it as a buy back down here. It spiked up. It did a gap, spiked up, came back down, and did another buy. So you have a double bottom with a, you have this. This is another way you get triple bottoms. I didn't really draw them, but I should draw them. So here. Triple bottom can often look like this. Let me draw it. Comes down, I'll draw rounded ones, and then looks like this. You have a bottom, and then this higher bottom. Okay, so that is what happened. Here, you have the bottom, a bottom, and then this higher bottom. And then it went into a channel. And it actually also went into a symmetrical triangle at the same time. You have a triangle here. I don't know if you can see it, but you have a triangle. And it broke out. And now it came back and retested is what it's done, and retested the 21 daily EMA as well, which is what this was holding, kept on doing it. So it's not as nice looking as a Visa. Visa looks like it's really going to move, but right now MasterCard is holding the support. It broke down, but this is, yeah, it's holding the support. So if I can draw a trend line like this, right? See? And here is the symmetrical triangle. This to me has just come so easily. I can see the channel's here, like just how it is, right? There's your symmetrical triangle, and it broke out of the symmetrical triangle. Now it's coming back to retest, which is similar to wedge, but it's different. So let's not get into it too much. But anyway, that's what's happened here. So as long as this support 21 and this line holds, it should bounce, move higher. It doesn't have the monster potential an ascending triangle is. So I mentioned earlier the number one pattern is the double head, double shoulder pattern. Number two is the wedge. Number 3 and 4 is the rectangle or the channel. Number 4 is an ascending triangle. Visa is an ascending triangle. These are the strongest patterns. Visa, you can see this is a strong pattern that if it plays out, it moves. It's going to move quite a bit. Right? We'll talk about that next week, but MasterCard is not an ascending triangle. It's a symmetrical triangle. The daily shows it a little bit better. Symmetrical triangle breakout that came back and pulled back. And using this as an example, it really moved fast. So if you were not, let me just zoom in a little bit. If you were not quick on your feet, or say you work and you cannot be watching your computer screen every second, and you weren't watching MasterCard, chances are you missed this, right? And you didn't even catch this pullback. So now you're presented the opportunity by waiting for the pullbacks to buy it here. And it held, and so in theory it should keep going. Come right back up. There's your opportunity. And that's why it's good to know these patterns and the fact that they tend to pull back. Any other symbols?
There's no other ones currently, so if you have anything else you want to talk about, then.
No. Other than, I would just say I'm intending to do these every Monday night. That's my intention. Next week, we know what the topic will be. We're going to be talking about continuation and trend breakouts, which is what a lot of the day traders use. The day traders are using that instead of reversals. I have been asked to discuss position management, money management, stop losses, all that kind of good stuff. So we'll do one on that. I don't know when, but maybe the following week. Yeah, so the intention is to do this every Monday. I don't know if I can, but we'll try. So I'm welcoming everyone to attend. I do need some sort of feedback, if at all possible. Did everyone see my screen? Like, does it look far away, or do I need to zoom in? That's one question I have. 2, is there anything about the format that is too boring, too whatever, that you're just dying now, you're just waiting for me to stop talking? That kind of thing. Like, if you have any of that feedback, please provide it. You can do it now or you can do it later. I do have looks like 1,000 DMs. While I was talking, I got so many people sending messages. I'll get to those when I get to them. Sorry, I couldn't get to them. Other than that, I don't really have much. Not much. I'm hoping that everyone learned a lot. One of the key messages out of all this is you don't need indicators. You just don't. Indicators are only there for you to give an idea if something is overbought and oversold. You do not ever, ever, ever buy something because some line goes above another line on an indicator. It's just silly. You have to wait for the price to go above something before you buy. You should not be buying because MACD crossed 0 or because RSI crossed the 50 or whatever. Stochastics crossed the 20 line. Shouldn't be buying that. Just as much as I don't buy math lines. Like if I was buying all my math lines with all these, you can see it with all these arrows, I'd be getting killed. Sometimes I'm right. Sometimes these arrows are bang on. I need to wait for price, right? So price is king. Price is what's deciding. So please remember that. Whatever you're trading, and I'm not putting down any specific indicator. I'm saying all of them need price before you use that indicator. Unless you're some other type. We talked about that at the beginning. If you're a momentum and news trader, you don't even need the chart. From fundamentals trader, you don't need the chart. Arbitrage trader, you don't use the chart. It's only these two guys. Day trading or swing trading, you're one of these two. Those are the ones using the charts. Should I even look at my DMs to see if there's questions?
Honestly, you've been going since 6, bro. I know you love teaching, but you should give yourself a break.
Yeah, I should get dinner.
You should get dinner, maybe like a glass of wine.
We've been going since 7. Yeah, so what is that? 4 hours, 19 minutes. Okay, well, I'm good. Unless there's any final questions, please send them right now in the next 30 seconds. Otherwise, we will have a good evening. And we'll talk to you on the chat. And we'll see you next week.
The only other questions I'm seeing are just chart requests, which are C and SoFi.
Okay. Don't know the symbol for SoFi, but I do know C. C, bottom 1, 2, 3, not very, didn't give you much time. Give you a little bit of time. Yeah, gave you a little bit of time. 1, 2, 3, break above 69, and it ran. It's still a buy. There's no sell signal. I believe the banks are raising their dividends after hours. I believe Morgan Stanley did it. Don't know who else raised it, but because of the liquidity is not as required as much, they're raising their dividends. So I expect to see the banks up tomorrow. So likely Citigroup will also be up with them. And like I said, it is a buy. There's no sell. So yeah, it's probably going to keep going. And if I was to guess, I would say right back up to $80. But we'll see. What was the other one? SoFi, Sci-Fi, whatever.
SoFi, SOFI.
I would say Sophie. I would say SoFi. Whatever. It's all good. SoFi, I don't know the company. You can see we had a bunch of overbought signals. It finally did a 1, 2, 3 top, declining top. It kind of came down, didn't hold, came back up, did a triple. You can draw some lines. See a line there. We also can draw a line here. And this is why you also need to know the other patterns, because here you have an asymmetrical triangle that breaks down. You actually didn't have to wait for the 1, 2, 3 breakdown because it broke down the triangle. And that's why, well, I don't know what the news was today, but that's why this gap lower. Based on the chart only, this is why it's gap lower, because we have a triangle breakdown. Maybe there was news to justify it, but from a price chart pattern perspective, and we'll talk about these triangles next week. It's a breakdown of a triangle.
You killed it, man. I think you're good. It's just,
And
you
we're
know,
gonna go
but
to
next time you got to go 15 minutes longer because Time Hawks was longer. So sorry about that.
oh, that's okay.
Yeah.
Yeah.
It
His
wasn't
was
enough.
much more his was more complicated than mine, believe me. So he deserves the extra time. Next Monday again, we're gonna go a continuation breakouts. So this is trend lines, this is triangles, this is flags. Um, and we'll talk about wedges again. We'll talk about channels again a little bit. There's a few things we'll talk about again because they're both. But yeah, we'll go through all of that. That's what's on tap for next week. Okay.
This is for everyone. If we have the VOD saved on our Twitch stream, so if there are points you want to go over, you can just go over to the Twitch VOD and rewatch any points you want and in the same amount of speed you want. So go revisit it if you need some big T knowledge.
Yeah, pause it anytime. It'll take you about 20 hours to watch it if you pause it, but sure.
And there's 2 times speed for a reason.
No worries. Okay, I'm going to mute and then I'm going to sign off. So, everyone, have a good night. Thank you for joining. I appreciate it. You're too kind to listen to me for 4 hours, so I appreciate it. Thank you.
We can do a lot longer than that.
Oh, I'm sure. I'm sure there's 20,000 more symbols.
Yeah. We can just do the whole S&P 500.
Yeah, sure. While we're at it, why not?
All right. So
Did Moon leave? Moon?
yeah, Moon said he was busy, so I was like, I can hop over and take care of it for you.
Okay, and thank you also to Young Bull Tommy, who had a lot of background noise, but I appreciate him streaming to Twitch and everything else. Thank you. He's still there, but he probably doesn't want to unmute. I don't know.
No, we don't want to hear static.
Yeah, we don't want to
He
get
said,
back
no problem, Big T, I can't speak.
No, you can speak. Can he? Or you get muted.
Yeah, Tommy, unmute. It's okay. Hurt our ears, unmute.
I can't unmute him. I'm not powerful enough. No problem. You in like a
Plane?
I don't know, a truck stop or something, or a plane? Yeah. Oh, I see. Okay, that's okay. It's all good. We're just teasing. Just teasing a little. Don't take me seriously.
Yeah, that AC better be God tier. All right, well, I'm gonna head out of here. Have a good evening, you guys, okay?
Yeah, everyone have a good evening, and I'm going on mute, and then I'm hanging up.
See
you
you
later.
everybody.
Hey, what's up, my friends? So, welcome to the Ultimate Technical Analysis Trading Course for beginners. And here's a true story. When I first started the financial markets, I wasn't a technical trader. I was actually more of a fundamentals guy. I was trying to emulate Warren Buffett to find the next stock that I can hold for the next 30, 40 years. And as a fundamentals person, right, what I realized is that by the time the fundamentals of a stock has turned bad or sour, I would have lost a huge chunk of money already. So that kind of, led me to find something else, and that's where I got introduced to technical analysis because it's more faster in that sense. So when I entered the world of technical analysis, I was overwhelmed because there's just so much information out there. You got indicators, support resistance, chart patterns, candlestick patterns, RSI, MACD, pivot points. Where do you even begin? What should you focus on? So it's after years of trial and error researching, right, that I realized that less is more when it comes to trading. So this is why in today's training, okay, I want to shortcut your learning curve. I don't want you to go through the same, misery that I went through with technical analysis. So here's what you learn in today's training. Number one, why 95% of traders lose money with technical analysis and how you can avoid it. Number two, how to know when to buy, sell, or stay out of the markets. Number three, how to identify the best levels to trade so you can find low risk and high reward trading opportunities. Number four, how to avoid jumping into trades too early so you can avoid unnecessary losses. Number 5, when to take profits before the market turns against you and wipe out, right, all your open profits. And do you hate to watch, your trade, right, going to the moon after you exit the trade? Then, I'm going to share with you this one technique that you can implement, right, that prevents that from happening. And along the way, I'll share with you a ton of charts, examples, and much, much more. Sounds good? Then let's get started. So, my definition of technical analysis is this, right? Technical analysis is using past data like chart patterns, candlestick patterns, volume, indicators, etc. to help you make a trading decision. And before we dive deeper into technical analysis, which is what this training is all about, I want you to be aware of two mistakes, right, that many traders make. Many losing traders make this mistake. Number 1, they add too many indicators, tools, right, to their charts because it makes them look like a professional trader. But here's the thing, if you have a chance to look at the screens, the monitor of, pro traders, you will realize that their charts are actually quite empty. They have tools on it, right, but it's not a lot. It's usually relatively little compared to new traders who just got started in trading. They add the moving average, RSI, MACD, make the charts look so complicating, thinking, it makes them look like a real trader. But that's usually, further away from the truth. Okay, so the reason why you don't want to add too much tools to your chart is because you will get analysis paralysis. You will get conflicting information and you will feel overwhelmed. Alright, it's like, having too many chefs to make one soup. You have too many chefs, each one add their own flavor, their own spice, their own tweak to the soup. The soup is going to taste like crap. And it's the same for your trading. If you add too much stuff to your charts, right, you will hurt your own trading results. Mistake number 2, you don't have a framework to work with. So I know this sounds a bit vague, so let me explain. So let me ask you, let's say, you want to build a house. How would you go about doing it? Will you just, go out there to like, a store and let me buy a toilet bowl because I need a toilet bowl for my house. Oh, here's a sofa. Let me buy a sofa. Oh, I need a bed. Let me buy a bed. And you go back home, you put your bed down here, you put your sofa, you plant a toilet somewhere beside your bed, and just like this. I hope not, right? Because if that's what you're doing, you will live, right, in a pretty darn ugly house. So what most people will do is they have a blueprint. They have someone to design, right, the framework, the layout of their house. Maybe if it's a 3-story house, the first story could be building a kitchen on the first floor. Then maybe you have a living room and a guest room on the first floor. So this is where you kind of play and entertain yourself and cook just for the first floor of the house. Second floor could be where you're resting. So you have more bedrooms, maybe 5 to 6 bedrooms on the second floor. You have more beds, you have toilets, right? So you don't have to wake up middle of the night and walk 50 meters to your toilet and stuff like that. And maybe the third floor is your home office or your man cave or whatsoever. You have all the latest technology, entertainment on the third floor. And this is how you would go about, building your house. You have a framework, something to refer to, right? To help you, make your purchase decision so you know where, things will be. And this is the same for trading. You must have a framework. Okay, so this, right, will be core, right, to today's entire training, because the framework that matters, right, is this. There are only 4 parts to it. Very simple, but I'm going to dive deep into each and every single part. Number 1, market structure. This, right, is in essence, right, trying to find out what is the current market condition so you know what to do. For example, if you know the market condition is in an uptrend, then you look for buying opportunities. If the market condition is in a downtrend, then you look for selling opportunities. So don't worry, right, I'll dive deep into this aspect later on. Second part is area of value. So just because a market is trending doesn't mean you want to blindly hit the buy button, because the market could be overbought, right, and about to make a reversal or a pullback. So this is where you want to identify areas of value, right, where you can find a low risk entry to enter a trade. In essence, right, you're trying to find out where on the chart, right, should you buy or sell. The third thing, entry trigger. This answers the question, when exactly do you buy or sell? When exactly? What is the thing, right, that would trigger you to get into a trade? And finally, once you're in a trade, right, you must also plan your exits. What if the market moves in your favor? Where will you take profits? What if the market moves against you? Where will you cut your loss? So in essence, this is the framework, right, that we will be learning more later. And for now, let's do a quick recap. Number 1, technical analysis is simply using past data to help you make a trading decision. You must have a framework to work with. If not, you'll be lost, right? Like, blindly, building your home, right? If you don't have a framework, you don't have a blueprint, you will get lost, you will get confused, and you will, have a horrible looking house, right? So if you don't want that, start with a framework. And the framework that I've shared with you is using market structure, identifying your area of value, defining your entry trigger, and then planning your exits. So in the later section, right, we will dive deep into each of this component within the framework. So let's get started. Now, in the next section, you will learn, right, how to use technical analysis to define the current market condition so you know whether to be buying, selling, or staying out of the markets. So let's move on. So let's talk about market structure. So market structure seeks to answer this question. What to do, right? What should you do in different market conditions? Should you be looking for buying opportunities, selling opportunities, or to stay out of the markets? So the way this works is that market structure, it helps you to define the current market condition. So you know whether to be buying, selling, or staying out of the markets. Make sense? So how do you identify, right, market structure? Or if you want to phrase it, right, how do you identify the current market condition? Well, to do it right, there are two techniques I want to share with you. And bear in mind, there are more than two ways to do this, but I just want to share with you two useful techniques, because if I share with you too many techniques, you get overwhelmed, you get confused, and you give up. So I'll just share with you two useful ones. Number one, candlestick chart, and number two, moving average. So let's have a look at this two, right, in more details. So first and foremost, right, let's talk about candlestick chart. What exactly is this? So candlestick chart is a method of reading a price chart. So it's not the only way to read a price chart. You can use things like bar chart, Renko chart, etc. But we'll stick to candlestick chart for this training. And a candlestick chart, it consists of individual candlestick patterns. So candlestick patterns is something that you are probably familiar with. It looks something like this. This is one candlestick pattern. Could have a little bit of upper shadow and lower shadow. Sometimes this could even be, let's say a darker color one. Could be like, let's say in this case, black color or even red to signal lower close, right? Something like this. So this is what we mean by candlestick pattern. So a candlestick chart consists of many individual candlestick patterns. So it's just like a forest, consists of many individual trees. So we will talk more about candlestick patterns later on, but for now, this is kind of like the macro, the big picture. I want to share with you how do you actually use candlestick chart to identify the market structure. So first thing first, right? Identifying market structure using candlestick chart. So there are three types of market structure you want to pay attention to. Number one is an uptrend. This consists of a series of higher highs and higher lows. So it looks something like this. Price hits higher, makes a pullback, breaks out higher, makes a pullback, and then breaks out higher. So when you take a step back and look at this, you can see a series of higher high, and higher low, higher low. Make sense? So this is what we call an uptrend. Next one, we have what we call a downtrend. So this is in essence the opposite. The price is heading lower over time. So down, it makes a pullback, heads down lower, makes a pullback, heads down lower. So if you look at this big picture wise, you see a series of lower high, and lower low, lower low. And finally, we have what we call a range market. This is where the price is contained between the highs and the lows, kind of like getting stuck in a box. So let's say price goes up, comes back down, goes up, comes back down, goes up, comes back down. So you can see that it's stuck between these highs and these lows. And this is what we call a range market. So let me share with you a few chart examples, right? So you know what we're talking about. So first one here, this is the chart of S&P 500. Let me ask you, what is this market structure? Well, I hope you can see that this is a uptrend. Why is it an uptrend? Because you see a series of higher lows, higher low, higher low, higher low, and higher high, higher high, higher high, higher high. Next one, what about this? Platinum. So I just want you to pay attention to this chart. Is this in an uptrend, a downtrend, or a range? So one tip that I have for you is that if you're not sure, take 5 feet away from your computer, just walk 5 feet back, look at the chart, right, and ask yourself, is the chart moving higher or lower, or is going nowhere? So if you look from left to right, I'm sure you can agree that this market, which is platinum on the daily time frame, it's heading higher over time from left to right. And if you look at the more granular details, you see a series of higher low, higher low, higher low, higher low, higher low, higher high, higher high, higher high, higher high. Of course, I didn't draw every higher highs and lows on this chart. The main thing is just to pay attention to the major swing points, right, and see whether is it heading up higher, lower, or just stuck getting nowhere. What we call a range market. Another example, dollar against the Norwegian kroner. So what we can do is go use this platform I'm using is called TradingView. You can click reset a chart and just zoom out a little bit, and then ask yourself, is this market heading higher or lower over time? So we can see series of lower high, lower high, lower high, lower low, lower low, lower low. We can see that this market is heading down lower. It's in a downtrend. And since the market, let's say it's in a downtrend, what do you want to be doing? I hope you are looking for selling opportunities. Why selling opportunities? Because this is the path of least resistance. Because if you know a market has been heading down lower over the last few months, there's a good chance that it will continue heading down lower. So you're going to look for selling opportunities. Likewise, if you see a market that's, for example, this S&P 500, heading up higher over the last few months or even the last few years, then you want to look for buying opportunities because this market is likely to continue higher. And you can see this is why we want, first and foremost, right, want to define the current market condition so we know what to do. To look for buying opportunities, selling opportunities, or to stay out of the markets if it's something that we don't want to trade, we're not comfortable with. So have a look at another example. This one again. UK 10-year gilt. If you look at this chart, is this in an uptrend, downtrend, or range? So look from left to right, you can see this market making a series of lower high, lower high, lower high, and lower low, lower low, lower low. Okay, now let's move on into something different. How about pound Canadian? Now, is this in an uptrend, downtrend, or range? It's a uptrend. No, I'm just kidding, right? It's a range market, right? Why is this a range market? Again, range market is where the price is contained between the highs and the lows. So it's contained between these highs over here and these lows over here. So one thing to point out is that this is not an exact level on the chart. You should treat this as an area. So if it helps, you can use tools like a rectangle tool to draw this as an area like this, or maybe even another one over here. So this way you can treat this like an area on your chart. And this is another area on your chart between the highs and the lows. And this is where we call this market, or we treat this market as a range market contained between the highs and the lows. So one more example before we move on. This one here. Silver. Is this in a range market or an uptrend? So if you look at the chart, right, as it is right now, I would say that this is in a range market. This market is contained between these highs and then these lows. But if you zoom out a little bit more, you might now say that this market could be in an uptrend, right? Yes, it could be if you zoom out your chart like this, but I would argue more towards a range market, as you can see that it's still stuck between these highs and these lows over here. Yep. So I would say that this is a range market. And of course, what I've just shared with you is using candlestick chart to define the market structure, but it's not the only way, because you can also use tools like moving average, which I'll cover next. So what is moving average? So moving average is an indicator that seems to follow the price. So if you see the price heading up over time, right, your moving average will be pointing up higher. If you see the price heading down lower, you can expect your moving average to be pointing down lower as well. And why is that? And that's because of the math behind it. So let me explain. So it's nothing too complicated. It's going to be pretty simple, I promise you. So the math behind moving average, or rather the idea behind it, is that moving average calculates the average price over X number of period. So let's say if you're looking at a daily time frame and you have a 5-period moving average, what this does is that it calculates the average price over the last 5 days, since it's a 5-period moving average. So let me show you how this works. So let's say you're looking at the chart and you have bars like this. This is the first candle. This is the second candle. This is the third candle. This is the fourth. And let's say this is the fifth, right? 5 candles on the chart. And let's say the closing price of these 5 bars is, $1, $2, $3, $4, and then $5. So this, right, the first candle means the price closed at $1. Second candle means the price closed at $2. This one closed at $3, this candle closed at $4, and this candle closed at $5. So let's say you overlay this chart with a 5-period moving average, right? What will the value of your moving average be? Well, it's going to be pretty simple, right? What you're going to do is to add the total, right, of this closing price. So 1 plus 2 plus 3 plus 4 plus 5, and you divide by 5, since we are calculating the average price over X number of period. Our X number of period in this case is a 5-period moving average. So you take 1 plus 2 plus 3 plus 4 plus 5, divide by 5. And if you do that, okay, your answer will be along the lines of divide by 5 equals to $3. How do I know that? You can just pull out your calculator and you'll see that this average of this 5 candle, the average price is 3. So let's say we add 1 dot over here, right, at this price point. I'll explain what this dot means shortly. So now let's say a new candle has formed, right? Price is closed higher on this 6 candle over here. And let's say it closed at $6. Now, what is the new 5-period moving average value? So what you're going to do is you will now, okay, take the most recent prices, right, over the last 5 candles. So 1, 2, 3, 4, 5. So you take 2 plus 3 plus 4 plus 5 plus 6. You divide by 5 and you get the value of 4. Now you might be wondering, hey Reno, what about this first candle number 1? Well, we'll ignore it because we are calculating the 5-period moving average. We are just looking at the 5 most recent candles. So in this case, right, we have 6 candles over here. We will ignore this one, the oldest one. So this is the 5 most recent candles from here all the way to here. So again, we just calculate the average of this total value here, 2 plus 3 plus 4 plus 5 plus 6, divide by 5, and you'll get $4. And what you'll do is you add in it, let's say you draw another dot over here. So if the price keeps, going up higher, what you can do is you realize that your dots gets higher and you connect the dots, it will appear as a moving average on your chart. And that's how it works. Okay, so hopefully you got some aha moment down here. Okay, so this is just some simple calculation which I've, shared with you earlier. So now, the key thing is this, right? How do you actually use moving average to define the market structure? So let's find out. So for an uptrend, what you can do is when the price is above the 200-period moving average, you can say that the market is in an uptrend. In a downtrend, right, is when the price is below the 200-period moving average. So some of you might be wondering, hey, Reno, why 200-period moving average? Well, there's really nothing magical about this, but when we use 200, right, it will take into consideration, right, 200 bars on your chart. So it will give you like a long-term guideline to whether this market is heading higher or lower. So this is kind of a way to help you define the long-term trend. And finally, the market is in a range, right, when the price chops up and down the 200-period moving average. So let me just show you. So for example, Euro against the USD, I'll add in the moving average here. So if you're wondering how to do it, right, just go to indicators, you look for moving average. Right, you can see over here, just click on this and the line will appear. So in this case, I already have it on my chart. And if you look at Euro against the US dollar, you can see that this market is in an uptrend. The price is above the 200-period moving average. Now, if you look at the dollar against the South African rand, you can say that this market is in a downtrend because the price, which is here, is now below the 200-period moving average. And if you look at this one over here, pound against the Canadian dollar, you can see that this market is in a range because the price, right, you can see it's chopping up and down the moving average. Okay, so we can conclude that this market is in a range. And that's how you can use moving average to help you define your market structure. Okay? So let's do a quick recap. Number 1, market structure helps you to define the current market condition so you know whether to be buying, selling, or staying out of the markets. So for example, if you see a market in an uptrend, what do you want to be doing? Well, you want to look for buying opportunities. That's the path of least resistance. If you see a market in a downtrend, what should you be doing? You should be looking for selling opportunities because the market is heading down lower over time and there's a good chance it will continue to head down lower. And finally, if you see the market is in a range, then you can look to buy low and sell high, buy near the lows of the range and sell near the highs of the range. And I'll explain how you can do all that in the later section, but for now, just understand what is market structure and how it can help you alert you right to what you should be doing at any one point in time. So market structure consists of uptrend, downtrend, and range. You already know this. And finally, you can use a candlestick chart or moving average to help you define market structure. So now at this point, right, you have learned market structure, but it's just the first step because a market could be in an uptrend, but it doesn't mean you want to blindly hit the buy button because the market could be getting ready to make a pullback or even a complete reversal. And the last thing you want to do is to buy high and sell low. So this is why it pays, right, to be watching, right, for your areas of value on the chart so you can better time your entries. And this is what we'll cover next. So, area of value. And by the way, if you're enjoying this training so far, smash the thumbs up button. If not, hit subscribe. So where was I? Area of value. So area of value, in essence, right, helps you to answer this question. Where to buy or sell? So if you recall, market structure tells you what to do. Should you be looking for buying opportunities, selling opportunities, or maybe to stay out of the markets totally? For area of value, it tells you where on the chart to buy or sell. So I define area of value like this, right? Area of value helps you to identify areas on your chart where buying or selling pressure could step in. So let me explain this in more details. So how do you identify area of value? So again, there are many techniques that you can use, but for this training, I'll share with you 2: support and resistance and moving average. So let me explain. So what is support and resistance? So support is an area on your chart where buying pressure could step in. So if you look at this, right, let's say price goes up, comes down, goes up, comes back down, goes up, comes back down. Now from the looks of this, right, we can say that this is an area of support, because this is where previously the price has bounced off once, twice, and now possibly a third time over here. So this is what we call an area of support. Okay, an area on your chart where buying pressure could step in and push the price higher. On the other hand, we have something called resistance. This is an area on your chart where selling pressure could step in and push the price lower. So it looks something like this. Let's say, price is in a downtrend, comes up, bounce up, comes back down, goes up, comes back down, goes up. And we can draw this as an area of resistance. Price got rejected once, twice, and now maybe a third time over here. This is what we call an area of resistance. Is where potential selling pressure could come in and push the price lower. So this is the opposite of support. And another thing to add is that when support is broken, it could become resistance and vice versa. So for example, let's say market is in a range like this. Okay, goes up, comes down, goes up, comes down, and breaks out of the range, breaks out of resistance. Now when it comes back down lower, this area of resistance, this previous area of resistance, right? Resistance. Now once it breaks out of resistance, it could now become support. This is what we call previous resistance, which now become support. So likewise, if support is broken, it could now become resistance. So let's say price is in a range, then it breaks down below support and it comes back up. Now previous support could now act as resistance, and you can actually anticipate, right, that the price could reverse lower from here. Okay, so this is what we mean by when support is broken, it could become resistance and vice versa. So let's have a look at some charts so you know what I mean. So first one here is platinum. You can see the support and resistance here in action. So this is, you can see previous resistance, price then, hit down lower, tested once, then had a massive slide off. Price then came back and retest resistance, hit down a bit lower, retest it, hit lower, then finally it broke out. Previous resistance become support. Then you continue up higher, pull back, hit up higher, pull back, and then breaks out of this resistance. Comes back, previous resistance now becomes support. It hits up higher, pull back, hits up higher to kind of where it is right now. Another example, euro against the Australian dollar. So for this one, you can see that this market is in a downtrend series of lower lows and lower high, lower high, lower high, lower high. So okay, we're not talking about market structure now. Now we want to pay attention to the support and resistance. So if you look at this one over here, you can see over here, this previously is support. Okay, price broke below support and retest previous support become resistance. So it's a bit far away from this area of support, but you want to bear this in mind. It's not an exact level or line on your chart. It's an area. Okay, so this, had a bounce over here, a rejection at this previous support, which became resistance. Then price hits down lower, retest previous support, which became resistance, hits down lower, comes back up, pulls back, and heads back into this area of resistance to where it is right now. So you can see, support and resistance here in action. And finally, another one is a pound Canadian. You see that this market is pretty much just stuck within this range between these highs, which is resistance, and this lows, which is support. And one thing to add is that you can also, if you want, you can, use a tool like the rectangle tool to draw or identify your area better like this. Personally, I like to draw it as lines, even though I treat it as an area. But for those of you who prefer to draw it as a box, this is something that you can do as well. Okay, so this is kind of like personal preference, just a tip to share with you. So now, let's talk about how, right, to draw support and resistance, shall we? You might be wondering, hey, Rainer, how do you draw these areas, man? So that's what we'll cover right now. So a few things to share. Number one, if the market is trending, you only want to draw the two most recent swing points. So let me explain. So let's say if the market is in an uptrend, right, hit higher, pull back, hit higher, pull back, hit higher, pull back, and hit higher. So at this point, you have, a number of swing low. You have 1, 2, 1 here, 2 here, and 3. But my suggestion is to draw the two most recent swing low as support, meaning you just draw a support like this, and then another one over here. Why do you not want to consider this one here? And it's very simple, because when the market is trending higher, right? Yes, it could make a pullback. And where could it pull back into? I'm guessing probably into one of these areas over here. This of this. The market can pull back into this swing low, this lower one, but if it does, right, then you would realize that this market is no longer in an uptrend, because if the price could come back all the way down here into this level here, you can see that, you can imagine that this uptrend is no longer intact, it's maybe even in a downtrend. If the market is in a downtrend, then what the heck am I doing trying to buy at this level? So this is why I only pay attention to the two most recent swing lows. And don't worry, I'll share with you a few chart examples later on, but that is how I would draw my support and resistance in a trending market. So likewise, if the market is, let's say, heading down lower, and you have numerous swing highs to reference, I would just, draw my resistance possibly at this one here and at this one here. And of course, right, if this is a previous support which could become resistance, I would also, highlight it on the chart. But in terms of swing points, right, the swing highs, this would be the two most recent swing highs that I would pay attention to. On the other hand, if you have a range market, then it's pretty simple. Just draw the highs and lows of the range and adjust it, right, to get the most number of touches, right? So I'll explain that shortly. So let's have a look at a few charting examples. So this is Euro against the Japanese yen. This is the daily time frame. Just reset, okay? So you can see over here, where should we draw our area of support? Now, the way I will do this is here. I would take this level here and draw one here. This is the most recent swing low. And another one over here. And that's it. Right, this will be the two area of support I will pay attention to. But also bear in mind that this over here could be previous resistance which becomes support. Remember, once price breaks above resistance, it could become support. So this is actually another level that's worth, right, paying attention to, and I will draw it on the chart. So if you ask me, right, for this uptrend, this will be my area of support on this chart. Why don't I draw, let's say, over here or over here? Very simple. If the price can come back all the way down into these lows over here, this could be in a downtrend already. So instead of, wanting to buy at this support, I would rather be looking for selling opportunities at this previous area, where previous support could become resistance. So I'm going to shift, right, my dynamics, right? I'm no longer looking for buying opportunities, because if the market is in a downtrend, we should be looking for selling opportunities. So this is why I just pay attention to the most recent swing points in the market. Another one, dollar against the South African rand. So same thing. What is the market structure? If you look at this market is in a downtrend. So pay attention to the two most recent swing points. It will be this one here and possibly this one over here. Okay, so this will be the two areas on the chart that I will pay attention to. This is where previous support could become resistance. And this, right, clearly is an area of resistance that I tested once, 2 times, 3 times, and 4 times over here. So the previous example, I had 3 levels. This one, I have 2. So there's some kind of discretion over here. It's not like an exact science where you can only have 2. No, if the chart, right, makes sense, if it permits, right, I can have, 3 potential support resistance areas on the chart. Okay, and one last final example. Okay, so this one, dollar USD against Singapore dollar. So if you look at this, you would see that, is this in a downtrend or is this in a range? So if you zoom out your charts, right, you can see that this one long-term wise, it's in a downtrend. But if you zoom in a little bit like this, right, you would say that, this is not exactly like a downtrend. This seems like a little bit more of a range. And I would say you're not wrong. So the way I would do this is, again, I would draw, right, the key areas on the chart. So as of right now, which is the nearest swing points, right, relative to the price right now. So if you see the price right now, it's over here. The nearest major swing points on the chart is here, between these highs and these lows over here. Okay, so you can see this is how I would draw my support and resistance for this particular chart over here. This is the highs and this is the lows. So one thing to point out is that, recall earlier I said that I would adjust it to get as many touches as possible. So if you look at this, right, I can actually draw my resistance smack, right? Okay, I would say I could draw it. No, this is actually okay. So let's talk about this one. This lows, right? I could actually draw it maybe at this extreme point. Okay, at this extreme low over here. But why don't I want to do that? Because I mentioned earlier, I want to get the most number of touches. So if you just look back in here, if I draw at this extreme point, I will neglect this low over here, and I don't want that. So let me shift it up slightly higher so I can also take into consideration this low. Okay, so I have 1 touch, 2 touch. Make sense? So same for here, right? If I were to draw at this level, I have 1 touch, 2 touch, and 3 touch. Compared to, let's say, I were to only, shift it up higher. The reason why I said this is fine, because if you look back here, you get a number of touches here and here as well. But for me personally, I want to take into account the most recent touches. I want to get the most recent touches together. So I'm going to adjust this slightly lower and take into consideration this as well. This one here, 1 touch, 2, and 3. Okay, so let's have a look at another example. Pound against the Aussie. So again, this one here, the way you draw your support and resistance, you can draw at this extreme high. But if you were to do that, then you would, neglect quite a bit of levels. You actually ignore this one here, And so what I'll do instead is that I would prefer to adjust this slightly lower to get the most number of touch. So when I do that, I now have this over here, 1 touch, 2, 3, 4, and 5. Great. So same for this one and the lows over here, drawing this area of support. I don't want to draw it at the extreme level. I want to adjust it so I can get the most number of touches. So I'll adjust this slightly up higher. And now I have 1 touch, 2, and 3. And this is my area of support. Okay, and this of course is my area of resistance. And that's how you go about drawing your support and resistance on your chart. And of course, right, this needs practice. It's not like, watch a 5-minute video and you become a pro. No, you got to practice it and, watch how the market reacts to your level in real time. And from then on, you will get better at drawing support and resistance. And of course, right, this is only one way to draw support and resistance. In the next section, I'll share with you how you can use moving average, right, to do this, to identify your area of value as well. Okay, so moving average again. So how can you use moving average to define an area of value? So here's how. So in trending markets, for example, in an uptrend, a moving average can act as an area of value. It will look something like this. So let's say market is in an uptrend, higher, makes a pullback, another high, pullback, another high, pullback, another high. When you overlay with a moving average, let's say the 50-period moving average, you would realize that the price, right, has bounced off the moving average a number of times, once, twice, 3 times, and if you come back for a 4th time, okay, we can say that, hey, this is an area of value and this is where buying pressure could step in and push the price up higher. So which moving average do we use? We have, 1 to 1000. For me personally, I like to use the 50-period moving average because for 50-period moving average, the trend usually tends to be a healthy trend where you can see the ebb and flow of the trends very clearly. You can see the pullback. It's not very shallow. It's not very deep. To me, it's just nice, right? The sweet spot. Of course, you don't have to use the 50-period moving average. Some people prefer shallower pullback, then they use the 20-period moving average. Some people prefer, a deeper pullback. They use the 100-period moving average. So there are, different types of moving average you can use. Ultimately, right, you have to find, right, the type of trends that you want to trade. And you might be wondering, but Rainer, how do I know whether, the moving average holds up? Sometimes I look at different charts, the price just sliced and diced through the moving average, right? Doesn't respect it. I get it. So this is why before we use moving average as an area of value, we want to make sure that the price, respects the moving average. And we use this 2 tests, right, to confirm it. So let me explain. So let's say market is in an uptrend, then makes a pullback, goes up, makes a pullback, and then goes up. And you overlay with a moving average, it has to be tested at least twice. So this is 1 test, and this is a 2nd test. So this way, if the market comes back for a 3rd time, all right, I know that, hey, this market seems to be respecting this moving average. I have more confidence, right, to use the moving average to define my area of value, having, proven itself 2 times previously. So this is what I mean by, at least 2 tests to confirm it. So let me walk you through some charts so you know what I mean. So you can see over here, this is Brent crude oil. Over here, we have 1 test. Price test the moving average once. Then it breaks above this swing high, tested a 2nd time, breaks out above this swing high, and then tested here a 3rd time. Okay, so we have 3 tests over here. So this means if in future, maybe for a 4th time, the price comes back to this 50-period moving average, I can say, hey, this is an area of value for this particular market, and on this time frame, I can look for buying opportunities at this 50-period moving average since it's acting as an area of value. Okay, and then in this case, right, yep, it did came back and tested, I would say, a 4th time over here. So now some of you might be thinking, Rainer, why isn't this a 4th test? And that's a good question. And the reason is because for me to define a test, the price must break above, the swing high or the swing low. So in this case, this was already the 3rd test. But the price, when it tested here, it did not break out this swing high over here. So I don't consider this a 4th test. The price has to break out of this swing high. Only then, when it breaks out of it and retests, would I consider it a test. Okay, so that's the way I define my test. Dollar against the Japanese yen. Same thing. If you look at this, price tested once, bounce up, tested twice, heads up higher, came back a third time. We have 3 tests over here. So again, on this market and on this time frame, dollar against the Japanese yen, 8-hour time frame, I would say that, hey, the 50 period moving average, right, is acting as an area of value. I can look for buying opportunities if the market pulls back towards the 50 period moving average, since, you know, it's respecting it. In this case, I tested a fourth time and then just collapsed and break down. Aussie against the Japanese yen. So let's have a look at this and see if there's any tests. So over here we have one test. Price breaks out of the swing high. Second test, price breaks out of this swing high. Came back a third test. Then start to chop. It hits higher, but eventually I think you saw what happened, right? It hits higher. So that's how you kind of define the test and use it to serve as an area of value. And just one last final example. You can see over here the dollar against the Chinese yuan. You don't have to use the 50 period moving average. For this one over here, you can see that the 20 period moving average can serve as an area of value as well. So you can see one test, hits down lower, second test, hit down lower, third test, hit down lower, and there's another fourth one over here, and you know, fifth, and so on. So one thing to point out is that when you see this chart that is respecting the 20 period moving average, if you look at the depth of the pullback, this one is much shallower compared to the 50 period moving average. If you look at the depth of the pullback, it's usually quite shallow compared to the 50 period moving average one, like on the, let's say, the dollar yen 8 hour. You can see that the depth of the pullback is much deeper, right? This one you can see is much deeper, and much deeper. So this, right, gives you more time, right? If the depth of the pullback is, I would say, longer, in this case of the 50 period moving average, you have more time to plan your entry, right, compared to a 20 period moving average where, you know, you need to scramble and act fast. So this is why I prefer, right, using the 50 period moving average to define, right, the area of value in trending markets. Okay, let's do a quick recap to what you've just learned. Number one, area of value helps you to decide, you know, where to buy or sell. You know exactly where on a chart, right, you can look for buying opportunities. Where on a chart exactly you can look for selling opportunities. And to accomplish that, I share with you a couple of tools and techniques. You can use support and resistance or moving average, right, to help you identify your area of value. And in fact, you can actually use both as well, support and resistance and moving average, to define your area of value. Okay, I'll cover more later on. So that's what we've just covered. So at this point, right, you know market structure, right? It tells you, you know what to do, whether to be looking for buying opportunities, selling opportunities, or to stay out of the markets. Then we have talked about area of value, where to buy, where to sell. Now the next question is, when exactly do you buy or sell? When is the right time to click the buy button? When, right? That's where we will, you know, talk more about it in the next section, which is called entry trigger. Hey, what's up, my friends? So let's, you know, carry on where we move on. But before we get started, I want to do a super quick recap to the topics that you have just learned. So first thing first, number one, remember, market structure. What is it? Well, in essence, right, market structure tells you what to do. If the market is in an uptrend, you will look for buying opportunities. If the market is in a downtrend, you will look for selling opportunities. So that's what we covered, market structure, the first thing. So let's say market is in an uptrend, a series of higher highs and higher lows. Then this brings us to the second section that we have covered. We talk about area of value. And the reason why this is important is because just because a market is in an uptrend doesn't mean you want to blindly hit the buy button, because the market could be getting ready to make a pullback or a reversal. So this is where I introduced to you, right, the concept of area of value, to identify areas on your chart where buying pressure could step in to push the price higher. So in other words, these are areas on your chart where you want to look for buying opportunities. So in this case, let's say it's an uptrend, this could be an area of value, right, where previous resistance could become support. So this is an area of value. This is where you want to look for buying opportunities to hop on board the trend. And now this brings us to our third section, entry trigger. So once you have your market structure, once you have your area of value, the next question is, when do you enter a trade? So this is what entry trigger is all about. It tells you when exactly to enter a trade, when exactly to buy or sell. So to do that, right, entry trigger, we'll learn some simple price patterns, right, that you can utilize, right, that tells you when to enter a trade, right, after your earlier market conditions are met, right, namely the market structure and the area of value. So let's, you know, study this more in depth. So how do you define an entry trigger? So there are numerous ways, but I'm going to share with you two techniques. Number one is what I call candlestick patterns. I didn't call it, right, you know, it's the people, the traders before me, right, they came up with this concept. And then we have the moving average break. So let's study these two techniques, right, that you can use to define as your entry trigger. So let me first and foremost explain what candlestick pattern is all about. So candlestick patterns is something that you might be familiar with because most charting platforms offer this type of candlestick charts. So it has 4 data points: the opening price, the highest price point of the day of the candle, the lowest price point, and the closing price. So I'll explain this in more details shortly. So I want you to know is that candlestick patterns can be utilized across different time frames. You can use it on the daily, the 4-hour, the hourly, the weekly time frame. And depending on the time frame that you're using, how you can interpret it is that on the 1-hour time frame, right, one candle will be formed every 1 hour. If you're on the 4-hour time frame, then one candle will be formed every 4 hours. And likewise, if you're on the daily time frame, one candle will be formed every single day. You get my point. So now this brings me to this section, right? How do you read candlestick patterns? Okay, so remember there are 4 data points. I'm going to explain to you step by step. So when you deal with candlestick patterns, right, you will likely see one of 2 types of candles, either a green candle or a red candle. Sometimes it could be a black candle or a white candle. It really depends on how you set your chart settings for. But for most charts, right, it's either green or red. So for a green candle, it simply means that the price has closed above the opening price. Okay, so in this case, right, you can see the green candle. This over here will be the opening price. This over here will be the closing price. What about these 2 black line over here and here? Very simple, right? The one at the top is the highest price of the candle, and this over here is the lowest price of the candle. Now you might be wondering, hey Rainer, what do you mean by of the candle? So this depends on the time frame that you're using candlestick pattern. So let's say, for example, you are on the daily time frame. Let's put it daily. Okay, so how do you interpret this on the daily time frame? Very simple. This means this is the highest price point for the day. This over here is the lowest price point for the day. And this all here is the opening price of the day, and this is the closing price of the day. So this only holds true if you are, looking at this candlestick pattern on the daily time frame. If you change this to the weekly time frame, then this is the highest price point of the week, this is the low of the week, this is the open of the week, and this is the closing price of the week. You get my point. Okay, now let's have a look at the other inverse, the inverse of the green pattern, which is actually this is what we call a bearish pattern. This is where the candle has closed below the opening price. Okay, so for this one over here, the opening price will be on top, open. This is the closing. This again is the high, and this is the low. So the way to interpret this bearish candle is the same. The only difference between a bearish and a bullish candle is their opening and closing price. For bullish, the open is below and the close is on top, right? Because the bar, right, has closed above the opening price. This is bullish, right? This is like a sign of strength where the buyers are in control. They have pushed the price and closed above their opening price. Whereas this one is a bearish candle where the sellers are in control, where they actually close right below right where the opening price is. So this is what we call a bearish candle. So this is actually how you read a candlestick pattern. And to sum up what I just said, this diagram will be useful. So you can see over here, this is like a quick summary to what we've just covered. This is the opening price, closing price, because this is a bullish candle. This is the high, and this is the low. Likewise, on the opposite end of the spectrum, this is a bearish candle. The opening price is here, closing price is here. Because this is a bearish candle, this tells you that the bar has closed below the opening price. So that's why the close is below the opening price. Open is here, close is here. This is the low of the candle, and this is the high of the candle. Actually, the low of the candle is actually here. Okay, so another terminology to explain is sometimes you might have heard of things like body wick. So the body refers to the colored segment of the candlestick pattern. So you can see that this colored area from here all the way down to here, this is what we call the body of the candle. And you see the 2 black lines sticking out. We call this the wick or upper shadow. Since this one is the top of the wick, we call it upper shadow or upper wick. The one at the bottom, we call this a lower shadow or lower wick. And that's pretty much how you read a candlestick pattern. So now moving on, right, I want to share with you some really useful candlestick patterns, right, to help you time your entry so you know when exactly to buy or sell. So let's move on. So if you look at this one over here, let's first talk about the bullish reversal candlestick patterns, right? It looks something like, there are a few variations to it. I want to explain to you 2 that I find useful, right, in your trading journey. First one is what we call a hammer. So let me explain to you the story, right, behind the hammer. So the hammer, again, it's a bullish candle, so you know the opening price is here. Where is the low of the candle? It's here. Where is the closing price? It's here. Where is the high of the candle? It's here. Okay, so let's say this is like, a daily time frame candle. So this is the opening price of the day, closing price of the day, high of the day, low of the day. So let me explain to you, what's going on with this hammer pattern and why is it so significant. So if you think about this, right, this actually tells you that, when the market opened over here, the sellers, they quickly dive in, right, and push the price lower all the way down, near these lows of the day, right? And when things are looking doom and gloom, right, when things are looking so bad, right, suddenly the buyers, right, they got revived, right, they, inject themselves with, maybe some steroids and push the price all the way up higher, and finally closing near the highs, right, of the day. So it's kind of like, you watch movies, right? The good guy get beaten up, get trashed, and then suddenly, they think of some of their loved ones, it's hurting them, they got to gain strength to overcome the battle, and then they win the battle and the movie ended. So it's kind of the same story, right? Where the sellers are in control, pushing down the price, and then sellers, kind of like get strong, those cheesy movie lines, and they revive and they, beat the bad guys and they're victorious. So same as this hammer over here, right? So basically the sellers got overwhelmed by the buyers and the price, right, closed bullishly, close near the highs of the day. So this is a sign of strength, telling you that the buyers are in control. So another pattern, right, the bullish engulfing pattern, is actually a similar variation to this one, but this one is a one candle pattern, okay, whereas this one here is a two candle pattern. So this one requires two candle to define it as a bullish engulfing pattern, but the story behind it, it's the same, right? Let me explain. So if you look at a bullish engulfing pattern, you can see that on the first day, price open here, and then the sellers took control and closed right near the lows of the day. So the sellers were celebrating, right? Hooray, we're victorious. If you watch Avengers Endgame, right, you know how is it like, right? Where, the bad guys, they were winning the war. Then what happened is that, all the good guys started to assemble, right? And then push back, and then they win the war, So in this case, it's the same thing, right? The sellers thought they were winning, and then the good guys suddenly come in, right? Reinforce together, Avengers assemble, and then, they push the price up higher, right? And close near the highs of the day, and the buyers, they pretty much, won this battle between the war between buyers and sellers. So in this case, bullish engulfing pattern, similar to the hammer, sellers were in control at first, then they got overwhelmed by the buyers, and, they pretty much won the war temporarily. So this is what we call a bullish reversal candlestick patterns. Hammer and bullish engulfing patterns are useful ones to know. So if you are trading the markets, right, you notice the price is in an uptrend, it's at your area of value like at support, and then the hammer forms, right? This tells you, right, that it's time to enter a trade. So a quick illustration could be something like this. Let's say, let me just get rid of the bars here first. Oops. Okay, so if you look at this, right, let's say market is in an uptrend, comes back to your area of value here. Okay, then you got your entry trigger at hammer. Okay, what this tells you that now, at this point, right, the buyers have, win the tug of war between buyers and sellers temporarily, and this is where you can look to enter your trade on the next candle open. Okay, we'll cover some trading examples later on, but this is pretty much to let you know, right, where this entry trigger stands, right, in the grand scheme of things. So now let's move on and talk about bearish reversal candlestick pattern. So there are again two to share with you. Number one, shooting star. So let me illustrate to you the story, right, behind a shooting star. So you can see over here, the price opened at this price point. This is the close, this is the low, and this is the high. So what is the story, right, behind the shooting star? So when the market first opened, right, the buyers, right, they were victorious, right? They quickly pushed the price up higher, drive the price up near the highs. And beating their chest, celebrating. Suddenly, right, the sellers came into control and pushed the price all the way down, closing near the lows. So an analogy that I can give you is like, you go for you got back your exam results and you realize, man, I got an A. Well, you're so excited, I got an A. And after which you realize the A is not what you think. It means A for absent. And you come crashing down again. So it's the same thing for this shooting star, right? You're really high, you thought, you're really happy, and then your whole world just come crashing down. So same for this, right? The buyers, they took control at the start. Buyers took control at the start, only to get overwhelmed by the sellers and the price closed near the lows of the day. Okay, so likewise, there's another one, what we call a bearish engulfing pattern. Meaning is similar, just that this time around, it uses two candles to represent this so-called story. So I'll explain, right? So again, here is the opening price. This is the low. This is the high, and this is the close. So you can see that, on this day, the buyers were in control. They managed to close near the highs of the day. They were really happy, really excited, right? This is good news. Yay! The next day, sellers quickly took control near the opening price, at the opening price, and drive the price down and close near the lows of the day. So this, you can see, right, this bearish candle, right, is even more powerful than the earlier one. Why do I say that? Because if you look at the body of this red candle, this body, all right, remember, body is simply the colored portion of a candle. This body is even bigger than the previous bullish candle body, right? This body is engulf or cover this first candle body. So this is why we call this a bearish engulfing pattern, because this body of this candle has engulfed, has covered the body of the previous day's candle. Okay, so let me just walk you through a few chart examples so you know how to actually spot, bullish engulfing pattern, bearish engulfing pattern, and stuff like that. So you can see over here on this chart over here, Aussie against US dollar, this is what we call a bearish engulfing pattern. See how this body of this candle has engulfed, has covered the body of the previous candle. Okay, and if you look over here, this is what we call a hammer. Look at this candle over here. This is what we call a hammer, right? We can see the long wick at the bottom, right? Rejecting these lower prices. Okay, let's see what else. This is what we call a shooting star. I would say this over here. Notice this long wick up higher, right? In fact, some of you, if you want to call this a bearish engulfing pattern, I wouldn't say you're wrong, because this candle has actually covered the body of the previous candle as well. So one thing to note, right, is that when you are learning, understanding candlestick patterns, don't get too caught up with the name, the exact definition, because the concept is really what matters, right? Who's winning the war, right? By how much, right? How much rejection of higher prices are there? How long is the wick relative to the body? This is what matters, not really the exact name and the exact meaning behind it. Because if you look at, for example, this pattern over here, which I didn't cover, okay? Let me ask you, do you think this pattern over here, is it bullish or bearish? Well, if you learn how to read the price action or read the story behind candlestick patterns, you will agree that this is actually a bullish candle. This tells you, right, at one point the opening price is here. The sellers drive the price down lower near this low. Then the sellers took control and pushed the price back up near the highs of the day. So you can see that this is actually a bullish candlestick pattern, and this is what we call a dragonfly doji. I didn't teach that to you, but using the concept of open, high, low, and close, where the price open, where the price close, who's in control, you should know that, hey, this is actually a bullish candlestick pattern. All right, so let's have a look at one or two more before we move on. So look at this chart again, you can see, this candlestick patterns are pretty much, quite common on the chart. This one here, we have a bearish engulfing pattern. This one here looks like a shooting star, but a shooting star, we have a red body, a bearish close, but this one here we have a green body. But just because this body is green, you won't say that, hey, this is bullish, right? No, this is still a bearish candlestick pattern, a bearish reversal candlestick pattern. Only difference is the body is a little bit green, right? Telling me that the price is closed slightly above the opening price. But the key thing to pay attention to is this long wick over here, right? This tells you that, the buyers at one point in time were over here and they got overwhelmed by the sellers pushing the price near, right, the lows of the day. Okay, so again, remember the story behind the candlestick pattern and not try to, understand or memorize every single pattern out there, because you will get overwhelmed. So moving on now, let's talk about the second, right, entry trigger technique that you can use, which is called the moving average break. Okay, so now I want to share with you another technique that you can use to time your entry. This technique is what I call the moving average break. So to illustrate how this works, right, so just imagine if the market is in an uptrend, right, a series of higher highs and higher lows, and then it makes a pullback. So now the question is, at which point of the pullback do you enter a trade? So earlier we talked about candlestick patterns, right? How you can use tools like hammer, bullish engulfing pattern to time your entry on the pullback. So the other technique that you can use is what I call the moving average break. So what you want to do in essence is to overlay this chart with a short-term moving average. Okay, so let's say, let me just get this one over here. Let's say this is a short-term moving average like this, right? Heading down lower because the market currently is making a pullback right now. So what you're looking for is for the price to actually break and close above this short-term moving average. So let's say this black line is the price. You need to break and close above this short-term moving average. So when this moving average is broken, when the price is break above it, we call this a moving average break, and this is where you can enter a trade. So the rules that you can use is this, right? For a long entry, you can enter right when the price breaks above the 5-period moving average. And for a short entry, you can enter when the price breaks below the 5-period moving average. And one thing to be clear is that this entry trigger, like the candlestick pattern, is not meant to be used in isolation. It's meant to be used within the context of the market, right? Market structure, area of value, and then finally look at the entry trigger. So let me share with you a few examples of how this moving average break works. So over here, let's say you have this Canadian yen. You can see that this market is in an uptrend and it's making a pullback over here. This pullback. So now you might be wondering, hey, when is, is it the right time to, enter a trade? So again, you can use the concept of the moving average break, overlay with a 5-period moving average. If you can't find an indicator on this platform, just go to indicator, look for moving average, right? Called moving average. Click on this and you'll find it. So I already have it on my chart. I'm just going to release this. And you can see that the 5-period moving average is this red line that you see over here. This red squiggly line on the chart. Okay, this one here. So what we are looking for is for the price to break and close above this 5-period moving average to time our entry to enter a long trade, since this market is in an uptrend. So you can see over here on this candle, this green candle, it has break and close above the 5-period moving average. This tells us that it's time to buy and enter on the next candle open, which can be on this candle here. So you can enter on the open of this candle here. So this is how the moving average break technique works. So one more example. Again, look at this. Market has broke out and then now it has made a pullback. Okay. So now, at which point of the pullback do we enter this long trade, since we know that this market is in an uptrend? It just broke out of resistance over here. This is resistance, price broke out, just made a pullback. When exactly do we enter? So if you don't want to use candlestick patterns, you can use the moving average break, wait for the price to break and close above the 5-period moving average to get on board the trade. So this actually happened over here. Okay, so this is an entry trigger. This is where you have the moving average break and you can look to enter on the next candle open, which is entry will be on the opening price of this candle here. Okay, so this is a moving average break technique, relatively straightforward. So let's do a quick recap. Number one, right? Entry trigger tells you when exactly to buy or sell. Then I've shared with you, you can use, things like candlestick patterns and moving average break as your entry trigger. So at this point, right, you know when exactly to enter a trade. So now this brings us to the next section, right? When do we exit the trade? What if the market moves against us? Where do we cut our loss? What if the market moves in our favor? Where do we take profit? All this and more in the next section. Okay, now let's do a quick recap, shall we? Entry trigger tells you when exactly to buy or sell. And I shared with you a couple of entry trigger techniques you can use, right? Namely candlestick patterns. You can use things like hammer, shooting star, engulfing pattern to time your entry. Then I also shared with you the moving average break technique, right? On how you can actually use the 5-period moving average to help you time your entry as well. And one last thing to note is that entry trigger is meant to be used within the context of the market. I'm not saying, no, if you spot this price pattern, if you spot the moving average break, hit the buy button. No, it's meant to be used within the context of the market, namely, market structure, area of value, and then your entry trigger. And now, this brings us to the next point, right? When exactly do you exit the trade? What if the market moves against you? Where do you cut your loss? What if the market moves in your favor? Where do you take profits? So all this and more in the next section. Boom, shakalaka, boom, shakalaka, boom. Okay, so in this section, it's all about exits. And when it comes to your exits, there are two parts to it. First part is this. Where do you exit if you're wrong? This is also known as your stop loss. Number two, where to exit if you're right. This is also known as your take profit. So let's study stop loss first, right? Where do you set a proper stop loss, right, when you're trading so you don't get stopped out too early? So when it comes to stop loss, I only have one technique. This one technique, right, serves my trading, right, to set a proper stop loss. So the one technique that I want to share with you is based on this concept. You should place your stop loss at a level which invalidates your trading setup. I know that sounds a mouthful, so let me explain. So let me ask you, right, if you look at let's say a trending market is in an uptrend. Let me ask you, at which point, right, would you say that, this uptrend is invalidated or this uptrend is destroyed? Will it be at here? Let's call it point A. Here, point B. Or here, point C. A, B, or C. Take 3 seconds. 1, 2, 3. Well, if you ask me, okay, I would say the level that this trend will get invalidated is at point C. Because if you think about this, if the market retraces down to point C, all the way down here, then clearly this uptrend isn't looking like how an uptrend should be, which is a series of higher highs and higher lows. So your stop loss should be at C, right, which invalidates this uptrend. Now, why not A or B? Because if you think about this, if the market retraces to A and continue higher, this still looks like an uptrend. If it retraces to B, goes up higher, this uptrend is still pretty much intact. So your stop loss, right, the key thing that I'm trying to bring across is that it should be at a level which invalidates or destroy your trading setup. So if your trading setup is a trend trading setup, your stop loss should be at a level, right, where your uptrend looks funny. It doesn't quite look like an uptrend anymore. So another example, let's say you are trading support resistance. Market is in a range, goes up, down, up, down, up, down. Then this is the lows of the range. This is otherwise known as support. Bounce once, twice, three, and here, fourth time. So let me ask you, at which, let's say you're long over here at this price point, where do you put your stop loss? Well, using this concept, right, your stop loss should be placed at a level which invalidates your trading setup. So at which point on this chart will support be broken? Is it over here? A? Let's call this A, B, or C. And again, I'm sure you agree, right? It's a no-brainer. It will be C, because if the price hits down lower and hits at point C, this area of support is likely broken. If it reaches A or B, support could still be intact, because you know support is an area on your chart, and it didn't even breach the lows of support for A and B, right? But for C, it has exceeded it by a decent margin, and there's a good chance that support is broken and your trading setup is invalidated. And that's what I mean by invalidation. So now here comes the so-called quantitative part of it. How do you make sure that your stop loss, right, is set the proper way consistently each and every time? Because I mean, if you look at the chart, you can eyeball, right, this level, that level, but if you do that over the next 500,000 trades, you can see that your subjectivity might creep in, right, and cause you to not set your stop loss properly in a consistent manner for the long run. So the way to do it, right, is that you want to use the concept of the ATR, which stands for average true range. You want to set your stop loss 1 ATR beyond the area of value. So before I talk about this technique, right, let me share with you what ATR stands for. So ATR stands for average true range, right? So average true range. So let me give you a quick crash course on this indicator. So this indicator is a volatility based indicator. So when volatility is high, the value of this indicator will be high. If volatility of the market is low, the value of this indicator will be low. So for those of you who do not know what volatility is, in other words, it measures, right, how much did the price move, right, over a given period. If it moves a lot, like a huge percentage, volatility is high. Okay, if it didn't move much, like maybe 0.1% a day, 0.05%, very small percentage change on a day-to-day basis, we can say that volatility is low. When volatility is high, the average true range indicator value is high. When volatility is low, average true range indicator value is low. Okay, so one thing to be clear, this indicator doesn't measure the trend. It measures volatility. So let's have a look at how this indicator works. So what do I mean by 1 ATR beyond the area of value? So let's say, let's look at the chart, shall we? So this is Brent crude oil, 8-hour time frame. So let's say, for example, okay, price came into this area of value, this 50-period moving average. Okay, so let's say you want to go long and enter on the next candle open. Maybe you think that this is a valid trading setup and you go long at the opening price. Where do you set your stop loss? Well, you want to set it, right, 1 ATR below your area of value. So in this case, let's say this low over here is your area of value. Is the low of this near the 50-period moving average. This is the swing low at that point in time. So let me just cover this candle. At this point in time, this is the swing low, right? The lowest point of this 50-period area of value. So what you want to do is to pull out the ATR indicator. Just search for ATR. Click on this. Comes up this one at the bottom. Go to settings. I like to use a 20-period ATR and I like to use SMA. Click OK. So how do you interpret this? Very simple. So remember, ATR indicator is a volatility-based indicator. When volatility is high, the value goes up. Volatility is low, value goes down. So if you look at this portion here, this ATR value is increasing over time. Why is that? Because if you look at the chart, From here all the way down to here. Notice the range of the candles from here to here. What's happening? The range of the candles here are pretty much increasing in size. So when the range of the candles are increasing in size, it tells you that the market is moving more. So that's why your ATR value is increasing higher during this period. And likewise, if you look at this, why is this ATR value here going down? Well, just need to look at the chart. You look at from here to here, you notice that the range of these candles from here to here is decreasing in size. Market is moving lesser. Volatility is decreasing. That's why volatility here is heading lower. Make sense? Okay, so now, how do you use this volatility concept to set a proper stop loss? So this is what we're going to cover next. So I mentioned earlier, you want to set your stop loss 1 ATR below the area of value, right? This is an uptrend. So first and foremost, what you want to do is to find out the current ATR value. In this case, is $1, 1.195. Simple, because it's stated here. Then what is the value of this swing low over here? So looking at this trading view chart, it tells me that the low is 63.176. So what I'll do is I'll take 63.176, 63.176, which is the lowest price point here, and I minus 1 ATR, which is this value here, 1.195. And this gives me, I'm not going to calculate this with my head because I suck at, this mental calculation. Trusty calculator is here. 63.176 minus 1.195 gives me 61.981. Of course, you don't have to be so exact to the, exact thick, right? So you can just make it like 61.99 or 62 if you want, or 61.95 if you want to give it more buffer. So what this means, right, you're going to take this value, let's say it's 61.99, and that will be your stop loss level. So we're just going to take this tool over here. Let's call it the horizontal line. I'm going to change this to red so it signifies our stop loss, and the value is 61.99. Okay. There we go. So how do you interpret this now? So very simple. So from this extreme low over here to this red line over here, okay, this red line is 1 ATR. So in other words, this is your stop loss. Okay, so if let's say, this is the, this red line over here is your stop loss over here. So if let's say you enter on the next candle open, if you enter on this next candle open here, let's say it's here, your stop loss is at this price point, this level over here. So from here, opening price all the way down to this red line is your stop loss. Okay, so in this case, all right, you can see that you wouldn't have gotten stopped out of your trade because you had enough buffer, right, as your stop loss. So let me walk you through another example because this concept is important. So let's have a look. How about this one here? Okay, say close this. Okay, let's say over here. Let's say we have for example, let's say you went short, right? Maybe there's a valid trading setup and you notice this strong bearish price rejection on this candle here, and you went short. So again, where should your stop loss be? So again, the concept is you want to set your stop loss, right, 1 ATR beyond the area of value. So in this case, where is the area of value? Area of value is here, this area of resistance. So within this area of value, this is the extreme high point. Okay, so reference that high point. So in this case, the high point, the value is, let me find out what that is. It is 6.515. Okay, 6.515. So the high point is 6.515. And what I'm going to do is to add on 1 ATR. Why add? Because we are now in a downtrend, right? Our stop loss should be above 1 ATR above this swing high. So the current ATR value is 0.014. So just 0.014, and that will give us, let me see, 6.515 plus 0.014. 6.529. 6.529. That is where your stop loss is. So if I were to get again, right, the red color line and to draw it out. Okay, 6.529. There you go. So let's say you enter on the next candle open, which is here. Okay. Your stop loss, let's say you enter on the next candle open is here. Your stop loss will be at this red line over here. So your stop loss is, in other words, from here all the way down to here, right? This is the size of your stop loss. Make sense? Okay, so pretty simple stuff, right? Your stop loss is, in essence, right, 1 ATR beyond the area of value. So this gives your trade room to breathe. So what this does is that if let's say the market makes a sudden spike up higher, right, at least, right, your stop loss is away, right, from these highs or from here. So you give your trade, right, more room to breathe and not get, stopped up from all this sudden spike up or down. Of course, it's not 100% foolproof. You will still get stopped up from time to time, but it will, protect you, right? Hopefully more often than not. And that's the concept right behind to why I set my stop loss in this manner. Okay, so just remember this. 1 ATR beyond the area of value. So your trade has breathing room. And finally, one last pro tip is this. Some of you might be wondering, hey Rainer, why do you use 1 ATR? What about 2 ATR or 3 ATR? Now here's the thing, it's perfectly fine, right? You can adjust the multiple of your stop loss according to your needs. But one thing to bear in mind is that the wider your stop loss is, right, is that your position size will be reduced, right? So you can accommodate, right, your risk management. And of course, the smaller the size of your stop loss is, right, you can afford to put on a larger position size. But the downside to that is that, you might get stopped up prematurely. So again, you can, decide what ATR multiple suits you best. For me, personally, I just simply go with 1 ATR beyond the area of value. So that's pretty much it for stop loss, right? Now let's move on and talk about your exits, right, if the market moves in your favor. Okay, so now what if the market moves in your favor, right? Where do you take profit? So when it comes to exiting your winning trades, you have two options. Number one, you can adopt a swing trading approach or a trend following approach. Let me explain these two methods, right, to you, and you can later on kind of decide which of these two approaches suit you best. There's no right or wrong here. There's no, swing trading is better than trend following or stuff like that. There isn't, right? It really depends on you, the trader. So first, let's talk about swing trading. What exactly is swing trading? So as a swing trader, what you're trying to do is to capture just one move in the market, just that one swing, zoom, that's it. So to illustrate, what is a swing in the market? Let's say market is in a range between these highs and these lows. Market goes up, that's one swing. Comes down, that's another swing. Goes up, that's one swing. Come down, that's another swing. So basically from here to here, this is one swing. Here to here, this portion here is another swing. Here is another swing, and this is another swing. Make sense? I know this looks like a mess, but in other words, right, swing trading refers to capturing one move in the markets. So now the question is, how do you capture one swing? So to do it, right, you want to exit your trade before opposing pressure steps in. So let's say if you're a buyer, then opposing pressure is seller. If you are a seller, then opposing pressure to you is the buyer. Right, let me just explain, right, since some of you might be confused. So let's say again, market is in a range and you bought near the lows of support. Let's say you bought over here. Okay. Now let me ask you, if the market moves in your favor, where do you think sellers might come in, right, to push the price down lower? Well, if you know that this is a range and if you know that this is an area of resistance, you will conclude that, Rainer, I think, sellers might be at resistance, right, trying to short the market at this area. And if you think along those lines, you're not wrong. So this is what I mean by, exit before opposing pressure steps in. If you know that this is an area of resistance, you want to take profit before resistance. The keyword here is before resistance. Okay, you don't want to set your take profit level here above resistance or here. Why is that? Very simple, because if you were to set your take profit level here above resistance, what it means is that you will only exit with a profit if the market breaks above resistance. If it doesn't, right, you will watch your trade reverse 180 degree against you and hit your stop loss. Do you want that? Of course not. So this is why you want to be smart about this, right? Don't set your target above resistance, because you're making the market difficult, right, to reward you. Instead, set it before resistance, before opposing pressure steps in, because this is where you have a higher likelihood, right, of exiting your swing trade with a profit. Okay, so let me share with you a few charting examples so you know what I mean. So if you look at this chart over here, let's say for whatever reason, right, you went long you saw this bullish candle and you went long on the next candle open. Okay, and you're trying to just capture one swing in this market. This is the oil market. This is the daily time frame. Now let me ask you, where should you exit this particular swing trade? Where should you set your target? I'll give you three options. Okay, option one is here. A, B, or C. All right, let's call this A, B, or C. Think about this, right? Where do you want to exit this trade to capture one swing? A, B, or C? And the answer is C. Why is that? Remember, we want to exit our swing trade before opposing pressure steps in. If you set it at A, you are making the market, difficult to reward you because the price has to break above this swing high over here before it can reach your target, making things difficult. If you set it at B, it's not as bad as A, right? But remember, this is a swing high. This is a potential area where selling pressure could step in. There's no guarantee the price will retest this swing high before it reverses down lower. Okay, because the price could come up higher, just approaching the swing high, and then start to reverse down lower, meaning the opposing pressure, or rather the sellers, step in earlier, right, to push the price down lower. So if you want to be conservative, if you want to be smart about this, and if you want to capture just one swing in this market, C, right, would be a better option, because this is where opposing pressure, or rather this is the level, right, before opposing pressure will step in, right, to push the price down lower. Okay, so to me, C, right, is a much better level, right, to exit your swing trade. This is where you're kind of like earlier a little bit, right, and exiting your trade before opposing pressure at the swing high steps in to push the price down lower. So if you're exiting your trade somewhere here, right, you're kind of putting yourself in good shoes, because this is the swing high, this is the area of resistance, and this level is before the opposing pressure at this swing high here. Another example, this is the chart of gold. Okay, so let's say, for example, this time around, market here had a rebound. Okay, so let's say at this low, it rebound, closes green. Let's say you enter on the next candle open again. At what point, right, do you want to exit your trade to capture just one swing? If you ask me, it will be somewhere about this level here. Because let's first identify where is the swing high and low in this chart. So the swing high is at this price point. And the key thing here is to exit your trade before the swing high, before opposing pressure steps in. So this is ideally, right, probably somewhere about here is where you want to exit your swing trade. So if the market you enter over here, this over here is where you are likely to exit this particular swing trade. This over here is before this swing high here. Make sense? Okay, now let's talk about the pros and cons of swing trading. So first thing, right, swing trading, the pros is that it has a higher winning rate, right? Because you are consistent in capturing your swing, right, from one trade to another, and you are usually exiting your trade before opposing pressure steps in. So your winning rate should be higher. The downside to swing trading is that you are unable to ride trends, and that's because you will exit your trade at a predetermined target. And if, let's say, the market, exceeds that target and continues, right, moving in that same direction, you will be on the sidelines, right, unable to reap profits from it because you have already exited that position. Okay, so this brings us to the next type of trading, which is trend following. And this is for you if you want to ride trends in the market. So what is trend following, right? It's in essence, right, trying to ride a trend. So it's different from swing trading where you're just capturing one move. No. Riding a trend, right, is trying to capture the meat of the trend, right, to ride the waves, right, as it continues to go higher. And to do that, right, you will use a trailing stop loss. So there are different types of trailing stop loss out there. The one I'm going to teach you is a moving average trailing stop loss. So depending on the type of trends that you want to capture, whether it's short-term, medium-term, or long-term trend, right, you can use different moving average parameters, right, to meet your needs. So in essence, right, what you are going to do is that, let's say the market is trending higher. Okay, you're going to overlay this trend with a moving average, something like this over here. And as long as the price is above the moving average here, you will continue to hold the trade. Only if the price, pulls back and then finally closes, let's say the candle closes below the moving average, right? Then you exit the trade when it closes below this moving average. If not, you continue holding the trade, right, and see how much of a trend you can capture. And which moving average parameter to use depends, on what you want, whether you want to capture a short-term trend, medium-term trend, or a long-term trend. So if you want to capture a short-term trend, right, you can exit the trade when the price closes below the 20-period moving average. If you want to ride a medium-term trend, you can exit when it closes below the 50-period moving average. And if a long-term trend, you can exit when the price closes below the 100-period moving average. So there's no best moving average settings here, right? In case you're wondering, some of you might be thinking, okay, Rainer, so which moving average is the best to ride a trend? There isn't, right? Unfortunately. So there's pros and cons to trying to ride a short-term or long-term trend. So for short-term trend, right, the downside is that you might get stopped out of your trade too early, right? Maybe it could be just a pullback, but because it really hits your short-term trailing stop loss, you are out of the trade. But the good thing is that, for trying to ride short-term trend, right, you don't really have to endure too much pain because the depth of the pullback is usually quite shallow that you have to endure. And if you endure any further, you are already stopped out. compared to, let's say, a long-term trend, right? The good thing about long-term trend is that it keeps you in the trade longer. So even if the pullback can be deeper, there's a good chance that you can still be able to ride it out and continue riding the trend. The downside, right, to riding a long-term trend is that it's going to be more painful, because you can see that the amount of open profits that you have to give back, right, while trying to ride the long-term trend is a lot more. So when the pullback occurs, right, you will see your open profits get smaller and smaller and smaller, and it can be emotionally, right, more difficult, right, because you watch a huge chunk of your profits, get returned back. So there's kind of like the pros and cons to, short-term trend following and longer-term trend following. And again, there's no right or wrong. You have to find the one that suits you best. So just to illustrate a quick chart example, so let's say this is the chart of Brent crude oil. Okay, if you, let's say for whatever reason, maybe you got long somewhere about here, let me just change. Let's say you got long for whatever reason, right? I don't know what the reason is. That's not important. Let's say you buy somewhere here and the market moves in your favor. So you can see that if you overlay for 20 period moving average, you will be pretty much, exiting your trade probably when this candle breaks and close below this 20 period moving average. So you can capture, pretty much this portion of the move. And if you go with, let's say, a 50 period moving average, you can see that you are in the trade longer, because when this candle closed bearishly, right, it did not close below the 50 period moving average. So you can see, right, that you're actually in this trade, right, you're able to withstand more pain, in other words, right, by using a slightly longer term moving average. In this case, you would have, exit the trade over here on this candle when the price breaks and closes below this 50 period moving average. And finally, if you go with a 100 period moving average, in this case, you can see that you can endure even more pain, right? And you will be pretty much still in this trade, right? You wouldn't have gotten stopped out on this pullback here. You have to, kind of withstand that pain and then eventually watch the market bounce back in your favor. So again, I'm not here to say, whether the 20 period moving average is best, the 50 or the 100. This is something that you have to decide and be comfortable with for yourself, right? And to decide, what type of trend you want to capture, whether is it long-term, short-term, or medium term. And that's how trend following works. And you have to be comfortable, right, with giving back your open profits, because for example, if you saw earlier the 50 period moving average one, right, you are not going to exit. You're not going to be like a swing trader where you manage to exit, right, let's say before this swing high over here. Okay, you're only exiting your trade after the market has pulled back and moved against you. So you can imagine at one point in time, right, your open profits, right, is at a maximum, right, around this high over here where the market is really bullish in your favor. Then you saw your open profit slowly dwindle and then, decrease, right, as the pullback occurs. So this is something that as a trend follower, you have to be prepared as well. This is the only way, right, you will ride the trend is by to be able to give back open profits. That is kind of like the cost of being a trend follower. So with that said, right, let's talk about the pros and cons of trend following. The pros is that you can ride massive trends. Okay, and it can be a huge profit potential for you. The downside to it is low winning rate, because you're always, right, trying to attempt to ride the trend using a trailing stop loss, right? You will only exit the trade after the market has moved against you. So this usually results in a lower winning rate compared to a swing trader. So really, it depends on the type of person you are. If you hate being wrong, right, then swing trading is probably for you. But on the other hand, if you're someone that really wants to ride trends, right, you can't stand missing out on trends, then trend following is probably for you. But you have to embrace, right, the so-called downside that comes along with it, namely a lower winning rate. Okay, I get it now. You are probably feeling overwhelmed, right? What is this, Rainer? Market structure, area value, Avengers, absent for exam. What's going on? So I get it, right? You are overwhelmed. You might even be, a bit confused. But don't worry, because in the next section, right, I will share with you, right, how you can actually utilize all those different concepts, strategies, and techniques that you have just learned, right, to trade the markets. In fact, right, my own trading strategy, right, is based on all these concepts that I've just shared with you. I will share with you, how to actually use it, right, to profit in bull and bear market. So all this and more in the next section. Breathe in, breathe out. Let's go. Okay, so now, before I share with you my own trading strategy and look at some real-world trading examples, I think it's important, right, to take a step back and actually do a recap to all the things that you've learned up to this point. So let's get started. So number one, right, the first thing about this technical analysis training is to share with you, right, market structure. And this is important because if you can define the market structure, then you know what to do. If the market is in an uptrend, you should be looking for buying opportunities, not selling, because you don't want to be trading against the trend. You want to be trading along the path of least resistance, to be trading in the direction of the trend. So that's what market structure does. It helps you define what's the trend so you can trade in the direction of it. So if the market is in a downtrend, then of course you look for selling opportunities. So next thing we covered is area of value. And this is important because just because the market is in an uptrend doesn't mean you want to blindly hit the buy button, because the market could be overbought, it could be getting ready to make a pullback or a complete reversal. So this is why we want to be trading from an area of value. This could be things like support and resistance or moving average. So for example, if the market is in an uptrend, we want to be looking to trade at support, around support area. Then this brings us to the third section, right? Entry trigger. So once the market is in an uptrend, it's at an area of value, then we look for a specific price pattern called an entry trigger to tell us when exactly to enter a trade. The entry trigger gives us some trigger, right, to tell us that, hey, at this point, the buyers, they are in control. They are starting to, turn up the heat, right? It's a good time, right, to now enter our trade and to time our entry. So once we have the entry trigger covered, we then look to cover our exits, right? What if the market moves against us? Where do we cut our loss? What if the market moves in our favor? Where do we take profits? And that could be, depending on whether you want to be a swing trader or a trend follower. So we covered all these different techniques. So in essence, right, what you're trying to do as a technical trader is, there are many ways to this, but this approach that I'm sharing with you is to trade with the trend. So again, number one, let's say we have an uptrend, series of higher highs and higher lows. Next thing we look for is for the market to come into an area of value. So in this case, let's say the market come into this previous resistance, which becomes support. The third thing we look for is a valid entry trigger. So let's say we have something like a hammer, right, to tell us that the buyers are in control, and we can look to enter on the next candle open. So once we have that, right, we want to cover our downside and to know where to exit a trade, if the market moves in our favor. So that's where we set our stop loss, which is beyond the price structure, somewhere here, and for targets could be just before this swing high over here. So at this point, you can see that we have defined the market condition that we are trading. We know when to enter, we know when to exit if we are wrong, and we know where to exit if we are right. So if you think about this entire training on technical analysis, right, is sharing with you this trading strategy called, it's like a formula, right? I call it MAEE, the May formula. And this trading strategy is not cast in stone. It is robust because you don't have to just trade uptrend, you can trade downtrend. You don't just have to use support resistance as your area of value. You can use things like moving average. You don't have to use candlestick patterns, right? For entry trigger, I shared with you the moving average break that you can use as well. You don't have to be a swing trader if you don't want to. You can also be a trend follower, to ride massive trends. So you can see that this trading strategy, it's robust in the sense that, you can tweak it right to your needs. And of course, there are more techniques and concepts that you can use as a trader. This that I share with you over here are the ones that I personally use, right? Of course, if you want to use different methods to define your entry trigger, like, chart patterns and whatnot, it's entirely up to you. So right now, what I'm going to do is to share with you some real world trading examples and see how this May formula, to see how this trading strategy, right, can help you profit in bull and bear markets. So let's get started. So first one here is the chart of Canadian against the Japanese yen. This is the daily time frame. So remember the May formula. So first thing we are looking for, number one, is M. What is the market structure? Uptrend, downtrend, or range? So I'm sure you can agree with me that this market is in an uptrend, right? A series of higher highs and higher lows, so uptrend. So once you know that the trend is up, do you want to be buying or selling? I'm sure you can agree that you want to be a buyer. So where do you want to trade from? Where do you want to buy? From an area of value, and in this case, the price is at this area of value, right, at this support. So let's call it the area of value is at support. Entry trigger. Do we have a valid entry trigger that tells us the buyers are temporarily in control and the market could hit higher? And in this case, we have a bullish engulfing pattern on this candle here. So I'll call this, I'll call it a BE, bullish engulfing pattern. What about exits, right? Do you know where to exit if you are wrong? So if we are wrong, right, I want to set my stop loss 1 ATR below this low, which is somewhere about here. As for target, I can set it right just before this swing high, which is possibly around the $88 price point. So you can see at this point, we have covered the market condition that we are trading. The area of value, we know where to enter from. We know when exactly to enter our trade and when exactly to exit, right, if the market moves in our favor or against us. So I'm going to go one step further and share with you, where exactly to set your stop loss and target. So just to do a quick recap, when we set stop loss, right, for me personally, it's always 1 ATR below the area of value. So this is the extreme low in this area of value. I find out what is this value and minus 1 ATR. ATR stands for average true range. So you can see over here, this ATR value currently is about 0.7, about 70 pips. And this low of this candle, right, from what I last checked, this is about 85.42. So I'm going to take the this low over here, okay, 85.42, and I minus 70 pips. That gives me, okay, trusty calculator is here, 85.42 minus 0.7, that gives me 84.72. That is my stop loss level on this trade. So let's say the market, open on the next candle open, okay, over here. Let me just share with you where I will, set my entry, stops, and exits, okay? So let's call this entry, which is at the open of the next candle. I'll change this to, let's say, green, okay? So that's my entry point. Now, what about my stop loss? We just calculated it. Your stop loss will be at 84.72. Let's put it to red. Okay, let me just change this to 84.72. That is my stop loss. Okay, and let's say we want to go with a swing trading approach. We want to exit, right, and capture just one move in this market. So for this one here, we can exit just before this recent swing high. I'll put it, let's say, around the $88 price point. Let's set this to blue. Okay, and there you have it, right? So from this strategy, right, you know exactly where to enter, where is your stop loss, and where to take profit if the market moves in your favor. And you're trading in the direction of the trend from an area of value. I hope this makes sense. Now, let's move on to another example. Okay, now let's have a look at example 2, right, and see how this trading strategy, right, can be tweaked, right, using the techniques that I've just shared with you. So again, once again, applying the May formula, right, market structure, this one here, again, it's in an uptrend. Area of value, you can see that this right now, the price has retested previous support, previous resistance, which could become support. Okay, so we have this over here. And then entry trigger, okay? Do we have a valid entry trigger to go long? So let me share with you, instead of, let's say, using bullish reversal candlestick patterns, right? We can also use the moving average break technique that I've shared with you. So let me just overlay with the 5-period moving average, as you can see over here. And notice that this candle has break and close above the 5-period moving average. This candle here has break and close above the 5-period moving average. So we have a valid entry trigger to go long. What about exits? Again, we can set our stop loss 1 ATR below this low and target just before this swing high over here. So let me again share with you how to set your stop loss and target, so you can see where exactly is your entry, stops, and target. So let's say we enter on the next candle open. It will be over here. Okay, this candle open. Let's change this to green. Let's say our stop loss is 1 ATR below this low. So find out what is the ATR value. At this point, it's about 53. Okay, let's say on this candle here, the ATR value is about 53.5. Find out what is this low. The low price over here, it's 1110. So quite simple. You just take this extreme low over here is 1110 minus 53.5. Oh, sorry, minus 53.5. Okay, 1110 minus 53.5, and that will give you 1056.5. 1056.5. So what you're going to do is to set your stop loss at 1056.5. And let me just share with you over here. See, stop loss is red, and the level that we will use is at 1056.5. There you have it, our stop loss. What about target? So again, let's say we are going to go with a swing trading approach. We want to capture one move, and for a swing trader, you usually want to exit your trade before opposing pressure comes in. So where might opposing pressure come in? Well, you can see that there is this swing high over here. So it would be prudent, conservative, right, to exit before this high over here. So I would say, a good level will be somewhere about here, 1293, 1295. Okay, let's change this to blue. Okay, so let's say 1294. Okay, and there you have it, right? So again, in this example, you know where exactly to enter your trade. So let's do a quick recap. Market structure, it's up. We're trading from this area of value where previous resistance becomes support. We have a moving average break as our entry trigger. So we enter here on the next candle open, which is on this candle here. We enter here. Our stop loss is 1 ATR below this lows, which is here. And our target, right, is just before this most recent swing high, which is this blue line over here. And once again, right, I'm using the same strategy that I've shared with you, the May formula. The only difference is, right, we have changed our technique, right, for the entry trigger. We use a moving average break to enter our trade. So now let's move on and look at another example. Okay, so example 3, right? This time round, let's look at a downtrend, shall we? So we can see that you can make money in bull markets and even bear markets. So in this case, this time around, you can see this market dollar against the Chinese yuan. This one is on the 8-hour time frame. Let's apply the May formula and see how we can trade this market. So again, market structure, you can see this time around, it's in a downtrend. Okay, so market structure is down. Area of value. Okay, so this one is interesting stuff, because if you look at this area of value, you will realize that, hey, the market has retested previous support, which became resistance, and possibly at this area of resistance again. So area of value and resistance. And another thing is, if you overlay with the 50 period moving average, you would realize that this market also seems to be respecting the 50 period moving average, right? It tested a number of times, somewhere here, although it exceeded by quite a little bit, right? But I would still consider this, the moving average as an area, and it had a bounce, right? A number of times here, and now we're back here again. So you can see that the 50 period moving average is also acting as a confluence, right, at the area of value. So your area of value is kind of stacked right now. You have the resistance and 50 period moving average. So that makes the area even more powerful. Then what about entry trigger? So if you look at this entry trigger, we have something bearish price rejection. It's not a shooting star, it's not a bearish engulfing pattern. The exact term is called a dragonfly doji, but again, the name is not important. What's important is that you can see, right, that the sellers are in control as you saw the price, right, being rejected higher. At one point in time, right, the buyers were in control and the price was trading near these highs. And then the sellers took control and push the price down lower and back to the opening price and closing right near the lows of the day. So this to me is a bearish price rejection. Okay, if you are not sure about it, you can wait a couple of days and see and watch the price action, and you will realize that what happened next, all right, was that this market is bullish and then followed by a bearish engulfing pattern over here. So if this one made you undecisive, right, this one should have sealed the deal, because this tells you that the sellers are in control. It's a bearish engulfing pattern. The body of this candle has engulfed the body of the previous day candle, sellers closing near the lows of the day. Okay, so this, right, would serve as an entry trigger for you to go short on the next day open. So let's say you go short on the next day open, which is let's say here. Okay, short here at the opening price. Let me just change this to green again to be consistent, right? Green for our entry. As for stop loss, right, I am going to be quick about this. I'm not going to go through the entire ATR calculation because you should be a pro by now. So I would say your stop loss, right, would possibly be 1 ATR above this high. Somewhere about here is your stop loss. Okay, let's call it S. And your target can be just before the swing low. So let's say this swing low you're referencing, this could be your target. Okay, so let's call it T. The green over here, this level here is your entry. Let's call it E. Okay, so your entry price, you know where to set your stop loss, and this is your target. So now let's move on to another example. Okay, so for this one here is the chart of Aussie against the Swiss franc. This is the 8-hour time frame. So let me, again, walk you through the trading strategy, market structure. You can see that this market structure is in an uptrend. So market structure, uptrend. What about area of value? So once again, right, this is at area of support. And on top of it, if you overlay with the 50 period moving average, you can see that it tested once on the 50 MA, twice, and then a third time over here. And now we're back here again. So you can see that this again is a powerful area. It has the confluence of support and the 50 period moving average, which is respected by this market and on this time frame. What about entry trigger? We can see a bullish engulfing pattern over here. And if you don't want to go with a candlestick pattern as your entry trigger, you can use the moving average break, in this case the 5 period moving average. You can see the price also break and close above the 5 period moving average. So that's another valid entry trigger, depending which one you want to use, whether you go with a moving average break or a bullish reversal candlestick pattern. Both, right, will give you the signal to go long. So stop loss, again, simple stuff, right? We will set our stop loss 1 ATR below this low. So let's say we enter our next candle open, which is here. Stop loss 1 ATR below this low, probably somewhere here. As for target, before this area of resistance, possibly somewhere about here. Okay, so again, we have our entry, we have our stop loss, and we have our target. And in this case, right, this trade pretty much went in our favor and then collapsed and hit our stop loss. So you can see this part here it went in our favor and then collapsed and hit our stop loss. And the message behind this is to share with you that, when you trade, all the stars can align, right? And that trade can still end up being a loser. So you have to be prepared for this. You have to practice sound risk management. Don't go all in and, risk 50% of your account or 100% of your account on one trade, because these things can and do happen. So be prepared for it. Now, moving on. Next example. Okay, so another example. This one here is the trade of copper. So I want to say the May formula, but you probably get sick and tired of Rainer, May, right? Irritating me. So again, the May formula. And again, let's have a look at this, right? Market structure, no brainer. This is in an uptrend. Okay, we both get it. Area of value. So in this case, this one here, you can see the price coming slightly into this swing low, the support, fair enough. And on top of it, you also have the 50 period moving average as what I'll show you right now. So you can see over here, the market has tested the 50 MA once, twice, 3 times, and now back here for 4th time as well as having this area of support. Then entry trigger. Okay, so let's say we go with a candlestick pattern. We have a bullish hammer that is formed on this candle here. Okay, market close higher for the day. So we have our market structure, we have our area of value, we have our entry trigger. What about exits? Where is our stops and target? So let's say stop loss again, 1 ATR below this low. Let me just walk you through. Okay, so what is going to happen is that you will enter on the next day open over here. Stop loss 1 ATR below the low, let's say somewhere here. So this is S and this is E, entry. Okay, I'm not going to work out with you where to set the exact stop loss level because you should be a pro by now. I did a number of examples, so go through the earlier training if you have forgot about it. And now, what about target? What if the market moves in our favor? Where do we exit our trade? So if you recall, right, I shared with you 2 techniques: swing trading and trend following. So earlier examples has been solely focused on swing trading. So now what if we want to ride a trend? So what you can do is you can use a moving average, like the 50 period moving average, right, to trail your stop loss. So this means, right, only when the market breaks and closes below the 50 period moving average, then you exit your trade. So you can see for this example over here, the market went up higher, right, and hasn't close below your 50 period moving average. Well, in fact, it did, right? It did close below the 50 MA here at this point. Okay, but remember, your initial stop loss is actually 1 ATR below this low, which is somewhere here. So your initial stop loss is not hit. So of course, right, for me, I would adhere to the original stop loss rather than exiting the trade prematurely. And once it moves in your favor, right, you can start trailing your stop loss using the 50 period moving average. And till now, the market is still moving in your favor. So of course, this is a cherry pick example, but it's to illustrate to you how you can actually trail your stop loss to ride massive trends. So in this case, let's say what happened now is that let's say the market suddenly, right, collapse and breaks and close below this 50 period moving average, which is this blue line over here. Then you exit your trade the next day. So this is how you trail your stop loss to ride trends in the market. Now, moving on to another example. Okay, so this one here is a stock trading example, and the reason why I'm sharing this with you is to let you know, right, that the concepts, the strategies and techniques that you've learned can be applied right across different markets: forex, stocks, commodities, futures, etc. So this stock here is FCX, the ticker. So again, same concept. Market structure is uptrend. Price has retraced into this area of value, right? Previous resistance, which became support. Previous resistance now becomes support, and back here once again. Let's say our entry trigger, we go with a moving average break. So let's pull out the 5 period moving average, and you can see that this candle over here has break and close above the 5 period moving average. So you enter on the next day open. So next day open, market here. Okay, good. So on this candle, you enter on the next day open over here. Stop loss 1 ATR below this low, which is somewhere about here. And let's say this time around you want to ride a trend and you decided to ride a longer term trend. So what can you do? You can trail your stop loss using a 100 period moving average. So let's see what happens. So let's say the market moved in your favor. In this case, of course, because I cherry picked this chart, and you overlay with the 100 period moving average. So you can see over here, right, the price is still above the 100 period moving average. So only, right, when the price breaks, let's say breaks and close below this 100 period moving average, only then will you exit this trade. If not, you will hold this long position, right, till the trend, right, hits your trailing stop loss. So of course you can imagine, right, as a trend follower, in this case it's a long-term trend following a stop loss, right? You will be in this trade for a much longer period compared to someone who is trying to capture a short-term trend or someone who is trying to capture a swing. So again, something that you have to be prepared for. And finally, right, let me share with you a few examples, right, of trade that I do not want to take. Okay, now let's have a look at this chart and find out why this is a trade that, or rather this is a market that I'm not interested in trading right now. So again, using the same formula, market structure, it's up. Area of value, it's somewhere about here. Okay, around the $42 price point. Is the price at this area of value? Not quite. So let's give it 1x, right? No. Entry trigger. Do we have a valid entry trigger? At this point, we have kind of like a bearish looking candle, right? I am interested to buy. I don't want a bearish reversal candlestick pattern, so entry trigger is no as well. So if you don't have an area of value that you're trading from, if you don't have any valid entry trigger to enter a trade, you have no business trading. So this is a trade, is a no-go, and let's move on to something else. So usually it's going to be very quick, right? Once you realize that the price is not an area of value, you can skip it altogether. You don't even need to bother whether there's a valid entry trigger or not. Because if it's not at an area of value, why do you want to bother, taking such suboptimal trades? So quickly, you can move on into something else. So if you look at this chart, another example, pound against the Japanese yen, you can see this one here. Market structure is up, area of value is here. At this point, the price is kind of like in the middle of nowhere. It's not near any area of value. And I have no business, right? I have no interest wanting to trade this because, again, the price is not at an area of value. Why do I want to force a trade? Yes, it's in an uptrend, but from the looks of things, right, it's currently, seems to be wanting to make a pullback, right? And to reverse lower. So if I were to buy right now, I'm putting myself in such, unfavorable, situation. Does it make sense? Hey, what's up, my friend? So at this point, right, you have learned a lot about technical analysis. We talk about things like market structure, support resistance, entry trigger, stops, target, swing trading, trend following, etc. And to be honest, right, all this will give you a strong foundation, but we are just scratching the surface. There's a lot more that you can dive deeper, right, if you want to be proficient to master technical analysis. And if that's what you want, right, then I recommend, right, you get a copy of this book over here. It's called Price Action Trading Secrets. I'll put the link somewhere below this video, or you can go directly to this link over here, priceactiontradingsecrets.com. This is a 140-page physical color trading book where I'll share with you, right, price action trading strategies and techniques, right, that you can use to trade the financial market. So if you've enjoyed this training so far, this book here will take you towards the next level. We talk about things like support and resistance again, but at a much deeper level, how to tell when support resistance will break, how to draw support resistance, how to read candlestick patterns like a pro, different type of candlestick patterns that are worth learning. I'll share with you reversal trading strategies, breakout trading strategies, how to manage your risk so you never blow up another trading account, and much, much more. So you can see that there's a lot packed into this 140-page physical trading book. And also, right, if you get a copy of this book today, I'm going to throw in a few bonuses, right, for you. Bonus number one is a digital copy of Price Action Trading Secrets. So this book is a physical book. It will take some time to reach you, about 3 to 4 weeks. But if you want to get your hands on it immediately, the first bonus I will give you is a PDF copy of Price Action Trading Secrets. So the moment you check out, you will get the instant PDF version that you can start reading immediately without waiting for a few weeks for your book to arrive. Bonus number 2 is this position sizing calculator so you never blow up another trading account. I'll share with you how to use this calculator so you know how many shares of stock to buy, how many units of currencies to trade, so you won't, blow up your account just because of one trade going wrong. And finally, I'll share with you this webinar. It's called Part-Time Trading Secrets, how you can actually be a consistently profitable trader without quitting your full-time job. All this and more, all these bonuses will be sent to you instantly, right, when you get a copy of Price Action Trading Secrets. And here's the thing, right? I know that there's a lot of trading books out there, and so here's my 100% risk-free guarantee to you. So when you purchase Price Action Trading Secrets today, and within 60 days, right, if you find it that it's not to your liking, you don't get any value out of it, just let us know. Just email support@tradingwithrainer.com and we'll gladly refund you in full. No questions asked. And you can still keep the book and the bonuses. How's that for being fair? So if that interests you, just go down to the website, priceactiontradingsecrets.com over here. If you just click any of this blue button here, like this blue button here, or this any of the blue button here or here, you will be brought up to the bottom. You will be brought to the bottom of the page. Just fill in your details, and we will ship out the book immediately, right, to you as soon as possible. So with that said, I wish you good luck, good trading. I hope you've enjoyed this training. I will talk to you soon.
So, good evening once again, everyone. Thanks for being here tonight. I truly, truly appreciate it. And welcome to all the new folks that are here. We'd love to, well, hopefully you'll get something out of this tonight and you'll be able to take it away and make some good use of it for your trading. You know, one of the things that I credit turning my trading around was when I became a student of price action. And tonight I wanted to talk about price action and how important it is to be dedicated to the skill of reading the chart. You know, oftentimes what we do nowadays as traders, and how many of you guys would agree with this, that we too heavily rely on indicators and different things like that to tell us what should be a good trade, rather than really focusing in on what the price action is actually saying. Hey, awesome, Daryl. Kevin, it is a very volatile market right now, and I can understand that frustration. As a matter of fact, a lot of things that we kind of are lacking momentum, right? So it is a frustrating market right now. But let me show you some things that might be able to help you with that problem, okay? And just a few rules that work for me. Now, I'm not telling you this is the only way to trade, but a few rules that work for me. And I'm actually going to bring up a blank screen here so you guys can see this. And I'm going to draw a couple of things on the chart and see if this makes some sense to some of you guys and how we might be able to improve our trading. One of the things that I think a lot of us are guilty of as traders is we try to be the jack of all trades. Okay, we want to be a great intraday trader, we want to be a great swing trader, we want to take longer term, we just want to do it all, right? Every pattern, every candlestick pattern, everything in the market, that's what we want to do. Well, the market is really designed, guys. Think about it. 80+% of the market is the institutions over here. Okay. And we're, as retail traders, we're this little teeny tiny speck over here. We don't have a whole lot of opportunity to force these institutions to do anything they don't want to do. Would you guys agree with that? Our chances of moving them around to do much of anything is pretty slim, right? And what we tend to do as retail traders, and let me go back to a chart here for just a second. The first time I learned about candlestick signals, I mentioned this today in Right Way Options. I learned about candlesticks and candlestick signals. I finished up this class and I came out of this class and I felt like, and I was reading books and everything else, I thought, I got it now. I got the secret. I felt like I was bulletproof. Guess what? I got shot full of holes. I was not bulletproof with candlesticks. So I thought, well, maybe it has to be more education. Maybe I need to throw a whole bunch of indicators on here. Maybe it's indicators that is going to make a difference for me. And so I went out and I learned all kinds of skills. I learned how to even write custom code for my indicators. And guess what? I went to the market, thought I'm bulletproof. Now I got this figured out. And I got shot full of holes again. Because I was doing everything except what I should be doing, and that is focusing on the price action of the chart. I say this quite a lot, but it is absolutely true. Okay? We don't get paid. We don't get paid by indicators. An indicator has never paid anybody. We get paid when price moves. And we spend so much time. How many of you guys out there would be willing to admit that you have wasted maybe even years trying to find the perfect set of indicators that is going to make you successful in trading? And we've tried and tried and tried. We are always in a search for something new, and it doesn't work. Right? It doesn't work. So here's what I finally learned. I finally learned that if I just settle down a little bit, stop trying to be the smartest guy in the room, and I don't mean just this room, but any room, the smartest guy in the market, and just work to follow the trends of the market with some key rules, I did much better in my trading. Not only did I do much better, it actually built my career in trading. Just by slowing down, calming down, stopping all the craziness of thinking that I could predict with candlesticks or indicators or anything else, and just work to follow price action in the chart. And I went one step further. What I did is I started defining a set of rules. Would you guys agree, when you look at the market, we all learned this pattern, right? When we learn to trade. The peak and valley pattern in a chart, correct? It's the most common recognizable pattern out there. Every trading book, everything talks about the peak and valley pattern. Well, to specialize, what I did was I set a few rules. Number one, if I wanted to trade anything, I was going to stop this idea I could predict when a market is going to turn or when a stock is going to turn, and I would simply wait for the institutions to show it to me. Remember, we can only sustain trends when institutions are supporting the stock. It's the only way we can trend. We need that institutional money supporting the stock. Okay? And so the number one rule for me was trend. If I didn't have a trend, I had nothing to trade. Okay? So number one, trade a trend. Stop counter trend trading, stop predicting when the bottom is in, and just wait for the trend to develop and follow the trend. Okay? And then I specialized even further. I essentially took that trending idea and I really studied price action. And I noticed after a long period of time and after beating my head against the wall and struggling for a long period of time, that if I simply specialized into a couple of different patterns, I could study those patterns and get better and better and better at those patterns. I didn't try to be the master of everything. As a matter of fact, if you're brand new here, never seen my charts, I trade very, very simply. But you can ask anyone in hit and run candlesticks and right way options. I follow my rules. Okay? I follow my rules. Actually, it is, Joel. It's less than 20%. You're exactly right. I think it's 89 something that's institutional. 89 something percent that's institutional money. Yeah. Exactly right, Gwen. There's no medals at the end of this for being a hero, is there? For picking the bottom. There's no medal at the end of it. The only thing that's a reward out of trading is whether our account is getting bigger or not. And if our account hasn't been getting bigger, our account is telling us something. Our account is telling us that what we're doing isn't working. Einstein said if we continue to do the same things over and over expecting a different result, that was the definition of insanity. We have to change. So I changed. I changed and I started studying a couple of basic patterns in the chart. One was and actually Rick named this, he called it the PBO, the pullback opportunity. And this one is mine, the pop out of the box. Okay? There's nothing fancy about these patterns, but there are some critical factors that are important. First off, A peak and valley pattern is not a good peak and valley pattern unless the chart is trending with the direction of the market. Okay? It's easier when the market is trending up to trade directionally long. Pretty simple stuff. When the market is trading directionally down, it's easier to trade to the downside of the market because that momentum is moving us in that direction. You guys have heard that old saying, right? Rising tides lift all ships. So all I look for is trending charts. Okay, and I'm looking for basically two patterns to trade. Now the criteria for these patterns are pretty darn simple. First off, the chart has to be in a trend. Second off, I need to wait for proof that buyers are coming into the trade. Okay. Now what that means is I get a lot of questions on that. What do you mean by that? What I mean is that I actually see buyers, a buy signal of some kind, proof that buyers are stepping in. Now the closer and closer I am to trend, and the closer I am to a price support in the chart and a trend, the better the trade. Okay? As a matter of fact, if I am very, very stringent in how I do this, I can win the majority of my trades just following these patterns. Okay? And it's not that hard to learn to do, but it does take some time and study. We have all seen recently, right? Stocks that rip like this to the upside, really strong moves to the upside. And we get that terrible fear of missing out, right? So we get a little bit of a pullback in that trade. How many of you guys, after 2 or 3 days of pullback, have bought this candle right here, that pop-up, and failed to recognize that the trend is actually out here? And they pop in that candle signal, and then the stock backs up and continues to find its way to the trend. I got to tell you guys, that pattern is showing up everywhere in the market. It's showing up so much. I believe that institutions have figured that out, and they've written algorithms for their computers so that they can take advantage of people with that fear of missing out mentality, jumping in too soon. And then they just back it up, stop you out, skim money out of your account, and do it over and over and over and over. Okay? So what I'm trying to convey here is that the trajectory of the trend is important. There's not too many stocks that can just go straight up and stay going straight up very long, right? They have to rest. They have to pull back. That's what a market does. Okay? It doesn't have to be a bullish. It's whatever you see as buyers, RK. I typically describe that as, bullish engulfing, a morning star, a kicker pattern, a piercing pattern, something along those lines. But I want it responding to something. And I'm going to show you guys a chart that is just, it's one of those charts. And just the last couple of days, it started to fail. Okay, here's a chart that has just been doing exactly what I've been saying and doing it in such a concise and consistent manner. I got to ask you guys, just looking at this chart, how hard would it be to make money on this chart? But here's the problem. Here's the problem. Isn't it true, guys, that what we're doing through the day is we're speeding through charts, and the only thing we're looking for, the only thing we're looking at is this hard right edge. We want that buy signal. Boom. Give me those buyers stepping in. That's the only thing we're after. Just show me that signal. We're flipping through like crazy, but we're spending no time actually analyzing the chart. right? We're in such a blazing rush to get to that next signal that we never take the time to actually see a chart that is setting up. All we're looking for is that candle. Isn't that true? How many of you have scans out there that the only thing that you've done is you're trying so hard to write the perfect scan to just show you that candle? This is the time to trade it. Well, here's what I'm going to tell you. I'm going to tell you that by the time that candle signal comes in, you may be too late. Because the trade was setting up as we were resting after breaking through resistance, and we were resting over the trend. The trade was setting up there. And all I have to do is place a price alert and actually wait for the trade to come to me. Now, the reason I talk about this, and the reason most folks, if RWO folks would probably tell you, I'm pretty relaxed about my trading. And I'm relaxed about my trading because I never feel rushed to trade. I'm never in a rush. As a matter of fact, if I ever feel that I'm rushing, I know it's time for me to go do something else for a little while, back away. There's no need to rush in the market if we look for these patterns, if we look for those good signals. Okay? Now, a couple things that I also want to point out. When a chart is downtrending, okay? When a chart is downtrending, I don't trade those trades. Now, I know people will say, yeah, but you're missing out in here. You're missing out on that really quick moving trade where you can make bucket loads of money real fast on a change of implied volatility or something like that. But let me just tell you well, you can ask the folks in Right Way Options. Anybody in here see me trade stocks that are in a downtrend? If the market's up, do you see me trading? Do you see me even attempting to trade stocks that are in a downtrend? No, I don't do it. What I do is I require, and you can see these marks in the chart, I require a stock. This is a have to. I require the stock to break the downtrend, and then I wait for it to prove that it can hold that downtrend as support. Only when I get proof that we can hold here am I interested in a trade in the stock. Okay? So one of the things that we have to do as traders, if we want to improve ourselves as traders, is we have to stop doing the things that don't work very well. Do you guys agree? If we could just eliminate these losing trades that keep plaguing us, we lose, we lose, we lose, we win, we win. Most people in this room, if I ask you the question, what's your win-loss ratio? Most people are going to tell me, I win about 50% of my trades. Now think about it. That's just the odds of buying a trade in the market. 50-50. We can improve those odds by doing some really simple things, and that's following trend and specializing into some price action on the chart. And I'm very picky. Let me show you a trade today that it was asked of me. What do you think of Costco long? Let me show you how easy it is to figure out, guys, that this is a dangerous trade. Okay? We have a higher low here in this chart, and we certainly are showing that higher low and the possible resumption of an uptrend. But we also have a very long-term downtrend. And how many times does a stock have to reject at a trend line before we believe that trend is true? But isn't it true, guys? We're always out here. We're trying to pick these bottom points. Got to get the best entry. Got to time the perfect entry. Let me tell you, in 30 years, guys, I have rarely ever hit a perfect entry. In fact, I'm going to tell you that I don't think there is such a thing as a perfect entry and a perfect exit. We have to get over that. Okay? We've all done this, right? We're looking for that white candlestick. And how many of you have flipped through charts, hit that white candlestick, and thought, and I'm not so sure, and you flip through a whole bunch more charts and you come back and you've already missed the trade because that stock has really taken off. Right? Even when we get our signals, we oftentimes don't get the trade because we're rushing to the next trade before we even take the time to evaluate the chart. Well, this is really, really simple stuff, guys. If I evaluate this chart, where's my proof of support? Where's the only proof of support that I have right here in this for a trend? It's this first higher low, right? That first higher low. That's proof of support. In this rally here that ran up real strong, do we have any proof of support between here and there? Nope. Yeah, there's no proof of support. Now, I'm really sensitive to this, guys, because this is a mistake that plagued me for a long, long time. I repeated it so many times, I got to tell you, it was maddening to me. I repeated it so many times. I was constantly chasing stocks. And I resolved that problem very, very simply. I set a rule that says I only buy stocks at or near price support with a buy signal. How many of you guys have anticipated the entry into the trade and ended up with just an ugly loser because we guessed that it was going to bounce from this point? Bounce from a Fibonacci, bounce off of a moving average, bounce off of something. It's going to bounce here. I'm pretty sure of it. And just turn it into a losing trade. So I stopped anticipating the entry. And then I started calculating, okay, if I'm going to be a consistent trader, I have to trade by a set of rules. I buy stocks at or near price support with a buy signal. That means when the stock is stretched up here, testing a price resistance level, this is the exact wrong time to enter the trade, right? I need to be buying it down here, not up here. And I'm telling you guys, that caused me so many problems for so long. I would buy the stock would pull back like it normally does, and I get stopped out. Okay? Just continuously walking right into a trap to get beat up. So the easy thing to do on these guys, it's real simple. You can try to time these and catch these trades right here, and I don't have a problem with that. But once we start approaching a price resistance of a downtrend, this should not even be any part of your trading. Stay away from it. We don't buy stocks at or near price resistance. Because here's what I know to be true, guys. If the majority of the market is being pushed by institutional trading, all I have to do is take a chart that is becoming interesting because we may break the downtrend, is just to simply wait for the next entry into the trade. And so for me, that's that chart breaking out. Show me you can do it. And then prove to me that you can hold support. And then show me a buy signal. If that signal occurs somewhere near trend and price support, the best trade I can find. Okay? If you're willing to be patient and wait for those trades, they work most of the time. I'm going to switch over to a weekly chart here, guys, and I want to show you a price pattern that Right Way Options is in right now. There's 3M. This was our alert to bring us into 3M. Now these are weeks, okay? Weeks in that trade. I want you to see that that is the exact same pattern that I just talked about on the daily. Wait for the downtrend to break. Wait for buyers to prove that is support. And what I want you to notice is that we have taken no heat on this trade, and we're 4 weeks into it now. No heat. Let me show you another one. This one I've already closed. This is Altria. Mo. Wait for the downtrend. Downtrend, we push up here and then we consolidate over, and then there's those buyers. Look at right there. Pop. No heat on that trade. How many weeks? Isn't that the dream trade, guys? I mean, honestly, how many of these trades do you need to make a lot of money in the market? Okay. So if we move to a daily chart or even to a 5-minute or a short-term chart, the same patterns apply. Okay, and I get questions all the time because we see markets or we see stocks shooting up, and the first thing we just get a bunch of comments that come into the room. What do you think of this chart? What do you think of this chart? What do you think of this chart? And so often it's a chase because we're afraid we're going to miss out on the position. And we chase into the trade rather than simply waiting for the next entry. So many times, guys, if we just wait for the trade that gives us a low risk entry, we can trade these charts over and over and over and over and over again that are trending. Have you ever asked yourself, with so many trends all around us, how could I have lost money? How could I be losing money when this is going on all around us? And one of the reasons, and I think Lee would agree with this, one of the reasons is because we're always in a rush. We're always chasing something, rather than waiting for the trade to actually come to us. See, the only way a stock can do this, guys, is institutions are showing their hand. Would you guys agree when we see trends that are this smooth and this consistent, institutions are showing us that they're supporting that chart? Right? They're giving us the information. And all we have to do is look at that chart and look for the next entry into that trend. And we can trade these charts or hold these charts long periods of time or trade them over and over and over again. Okay? Now here's the thing that I think is important, guys, and this is the thing that gave me a lot of hope, and hopefully this gives you a lot of hope. In trading like this, do you have to be any kind of a super duper genius to do this? You really don't, right? We just have to look for a trending chart, mark it up, and wait for the next entry into the trade. Now, we're looking at Microsoft here. This is a weekly chart, so I'm not looking at the daily here. Anybody think there's an opportunity coming here in Microsoft right now? Huh. How about that? Even when a chart has gone up and gone up and gone up and gone up and gone up for years, it's still presenting us with opportunities for a trade. Now, because this chart hasn't quite made it over here to trend, notice that the longer we consolidate in here, the more we rest and hold that price support, and we slide over here toward this trend, the better this chart becomes. Because isn't it true, guys, when we see that price action move like that, that resting period in here, what this is an agreement between the buyers and the sellers. Sellers are saying, shouldn't be any more high, shouldn't be higher than this right now. Buyers are saying, shouldn't be any lower than this right now. So we're pretty much in agreement on price. If we take note of the trend, I want you to just note in this trend that I've drawn, do you think that pattern worked again right there? There's that downtrend break. There's the pullback to prove support. Bam, there's the trade. Easy entry. Easy money. And if we wait for this one, it could be just as easy. Okay? You know, Jeff, you're exactly right. As a matter of fact, that somebody that's almost 103 years old, Charlie Munger. Charlie Munger says the real money isn't in the buying and the selling. The money is in the waiting. That's where the money is made, is being patient to wait for the trade. Okay. Now, by the way, guys, just because I'm showing you a longer term chart, I actually did this a couple of weeks ago. It was a slow day. Market was choppy. We went to a 5-minute chart in the Qs. And I did this exact same strategy, trading the 5-minute Qs, and made money with it. Right in front of everybody, a live option trade right in front of everybody. By simply looking at the chart, stock pops and gaps up, pulls back, holds. There's a possible buy entry that occurred right in here. Moves on up and holds. There's a possible buy entry that occurred right in here. There's our trend. There's a possible buy entry that occurs right here. We get a little carried away in that price move up and we take a longer rest. Possible buy entry right here in the trade. Okay. Yes, we want to buy at or near price support in a trending stock that's reacting to support and trend. Support and trend. Let me show you guys a stock that came up in the room the other day, and we had a discussion on this. MU popped up here on that day, and I just had a bunch of folks asking me, should we buy MU? And I said, well, let's think about this, guys. Where's our stop loss on that trade? If we chase this trade after that big move, our stop loss needs to be down here, because that's the last proof of price support. We tried to sell off, buyers picked it up right there. That's our last proof of price support. So we have to take a pretty big risk on that trade. Then I pointed out that if I were going to take that risk on this trade, keep in mind that I was buying it at price resistance. I wasn't buying it at price support. And I warned on this to just wait and see if the next entry can show up. If we could hold, and you can see I placed a price alert here. The stock started to pull back, and I said, let's see if it can hold this trend. I placed a price alert on that chart. The stock failed today. No trade. Didn't cost me any money. Not a penny. To wait for a trade. Okay, chasing that entry here would have cost you a bundle, right? Barry's pointing out 10-point pullback would have cost you a bundle. Imagine what that would have done in an option trade. That's a chase. That's that fear of missing out trade, and we're not buying a technically correct pattern. We want that higher low, that proof of support. Okay? Now, another thing that I find that people struggle with a lot is we're chasing that flavor of the day. Okay? It's in the news. Everybody's talking about it. We're chasing around, oh, it's got to be this chart. It's got to be this chart. It's got to be this chart. Often those charts are very, very volatile. If they're in the news, if they're floating around, they're usually pretty dangerous charts. We want to look for concise price action. By the way, guys, here's that pattern again. Break the downtrend, hold support. Bam, there's the easy entry. There's the follow-through trade right there. There's another trade, another trade, another trade as we move up in this sharp trend. Then we slow it down. We rest for a little while. Boom, there's another trade. And we can just trade those same charts over and over again. What I want you to notice in this price action back here, would you guys see, looking at these price candles in here, would you guys see this is a much easier trade to take here with much less price volatility than what we see in these candles up here? Look at the depth or the distance in those candles. The easy trades we're often not looking for because we're chasing around the flavor of the day. Something that's in the news, something, oh my gosh, this is popping. Social media is lit up about it. If social media is lit up about it, we should be running from it. Because anytime we trade that really high implied volatility, let me ask you guys, if the stock is really, really volatile, are your odds of a win increased or decreased? Even if you're really good at technical analysis, are your odds increased or decreased by chasing around highly volatile stocks? Yeah, you're going to win less of them. Volatility tells us that, right? So wouldn't it be better not to chase those around? Wouldn't it be better to look for those charts that have concise price action? What was that chart today, guys? I can't remember. We ran across it, and I made a point of just made a point of how beautiful that chart was and wondering why. None of us were in it. If you guys, somebody remembers, was it VIPS? Look at that chart. Is there anything hard about trading that daily chart? And look at this beautiful pattern. Here's the pop out of the box. Consolidate over, hold trend, and then there you go. Buyer step into this position, pushing it up, and it's seen no pullback since. By the way, notice that this doesn't require, incredible chart there. Thank you. This doesn't require any fancy indicators, does it? It's really, really simple. Institutions are showing us their hand here. They're just really showing us everything that we want to see. We break the downtrend. We hold it as support. No good buy signal there. That gapped away. No trade. How about that entry right there? You win on that trade. Now let's just wait for the next entry. Anybody think you might have been able to catch an entry right over here? What about an entry right in here? Or here, or here, or here, or here? But we're so involved in the chase, the rush, looking for the white candle, we miss all of these trends all around us. Now I go through an exercise with folks in Right Way Options. And let's just take this chart for example. And one of the things I used to do, and this is, seriously, I am a nut job when it comes to price action. I've told people in the room this, that I literally have had dreams where I'm in the chart. I think about charts and price action so much that honestly, I'm a big chart nerd. And I'm not ashamed to admit that. Okay? Really simple. How to overcome the fear of a stock that you say is topping out. How do you know it's topping out? How do you know? You don't. We only find out when the trend is broken. When the trend breaks, it's over. Whether it's a long-term weekly chart or a short-term chart like this in Discovery, we only know that the trend is broken when the trend actually breaks. Stay with the trend until the trend breaks. Okay. Bert, do I ever place a buy stop limit or a buy stop order on the entry? Yeah, I used to do, actually that's what I did for years and years and years. When I worked full time, I couldn't watch the market at all. That was even back before cell phones and online brokerages were very, very new. I actually placed entry orders the night before. So I would plan my trades about this time at night. Set an order. If the stock crosses up through here, buy that chart and drop a stop loss in under here. I made it as mechanical as possible just to follow the trend. Okay? So that thing where we get ourselves, I hear this all the time, and it's pretty normal, guys. I hear this, well, it's so overbought. It's gone up for so long, it has to pull back. Who says? Who wrote a rule on it? Let me show you guys a trade. Pull this back. This was my entry into BDX. This was my exit in BDX. How many years did that trend? Who says? There's no rule out there that says a stock has gone up too much, it has to pull back. There's nothing out there that says a stock can't just, if institutions are supporting it, it's going to continue to go up. Okay. Honestly, I'm getting questions about indicators, T-lines, and stuff like that. Guys, 99% of all the trades that I make that people get from me in Right Way Options come from this chart with no indicators in the price action, just some drawings on the chart. That's how I found Microsoft was setting up. I don't need an indicator to tell me that price action is showing me a potential trade. Yep. I call this a naked chart, and that's what I use for almost all of the trading I do. Now, I teach a strategy called the 3-8 trap, and it's just using the 3 exponential moving average and 8 exponential moving average and something I call the trendinator. And all that is a trend following tool. It helps people see the trend. Okay? It helps them visualize the trend. If I look at this right here on the weekly chart, can anybody follow this indicator pretty simply and make money? Let's go back to that discovery. And go to the daily chart. Can you make money with that indicator right there? It doesn't have to be fancy, guys. And let me tell you this, even though I teach the 3-8 trap, one of the first things I say in the 3-8 trap class that I teach, the trade has nothing to do, the entry has nothing to do with the 3, the 8, or the trendinator. Those are just visual clues to help us find the entry points. Everything else, we have to study the price action of the chart and look for those entry points. Just follow the trend. Okay? If we look at a chart like Cisco, I had questions on this today. Is Cisco a buy? It was moving up earlier today. Now imagine had you tried to chase this trade. The last proof of support was here. Here's our stop loss. Who wants to take that kind of risk in this trade? Anybody? I mean, I don't. But isn't it true? We do that knee-jerk reaction all the time. We see that move and we just jump. We don't think about it. We just jump. Oh my gosh, I'm missing out. Let's pull this back and take a bigger look at this chart. Isn't it interesting that this is a huge breakout of Cisco? What usually happens after a big breakout? Stock pulls back or it rests, right? What it's going to do most likely is it's going to find out. It's going to seek this out and find out, is this really support? We don't know that yet, right? We broke it as resistance, but we don't know if it's support yet. And if I look at the bigger trend, what do you guys think the chances after such a steep run up here? I mean, almost vertical run up. How many of you want to guess that there's a high probability that this chart will rest, consolidate, and pull back and move all the way over to that trend before it goes again? It's honestly, guys, it's a high probability. It doesn't work that way every single time, but it is a high probability that that will occur. It's either that or the stock will fail and come back to trend. Okay, we lose support and come back to trend. Okay. So we want to be looking at correct chart patterns. We want to be looking at those high quality chart patterns that could set up. When we look at a price pattern like this and the stock is pulling back, here's that pattern I told you guys. We shoot up, we pop a buy signal in here. We don't recognize that we're far away from the trend, that we're well above support. There's actually no support under that price action. It's floating in midair. We chase into this position, and then we get clubbed. Comes right back to support and trend. Guys, I can show you that pattern over and over and over in the charts. Over and over and over in the charts. Okay? These patterns are very, very important. When we look at these downtrends that break right here, we prove to hold after we break out and hold the support. There's an easy winning trade. Okay. Now, I was going to show you that exercise that I do with Right Way Options folks every once in a while. And I highly recommend people do this. Let's take a look at that Discovery Channel chart, and let's pull this back, because one of the things that used to cause me all kinds of grief is I would think, how in the world could I miss a chart that entire time and never get into this trade? So what I would do is I would back up the chart like this. I know this is going to be a bullish chart. And I would start moving that chart forward one day at a time. Okay? Just one day at a time. What's interesting, guys, if you do this with me and we go through and we talk about support, resistance, trend, you guys are going to see the entries. And I know you will, because most people, if we actually study and look at the price action of the chart, it becomes very obvious where the entry comes in. Okay, there's that big shoot up there. We broke through resistance. What do you guys think? There's a pretty good probability that this rests or pulls back. By the way, could you have had an entry in here? Break the downtrend, hold it as support, look for your entry into the trade. Repeats over and over and over in the market. So now we're going to just move this forward a day at a time, and let's see if we can pick out an entry into this trade that looks like it's going to make sense to us. Anybody think that could be an entry? Still pretty stretched away, right? We're a little bit away from here. It could be an entry. It could actually win, but we're pretty stretched away from this current trend. Might be a little bit too early. We might be catching that entry signal and just have to hold it while it rests over the trend, right? Look at that. Contact trend. Not the best of entries into this trade, so it's still a wait for me. I'm not in this trade. I'm not going to chase it. I'm not going to rush. Either the chart does what I want it to do, or I'm not going to trade it. See, I don't have to catch every trade. I just have to catch enough of them to make good money in the position, okay? And if we study this chart and study this price action over and over, how about this signal right in here? Anybody think that could be a pretty decent setup? Definite maybe. One thing that I would say is that the price action that was really volatile in here, big long candles, wide candles, didn't it kind of get concise right here? We pushed up and then we rested in a really nice light pattern. So even if I'm wrong on this trade, I don't have to risk much money because my stop loss goes in here. Make sense? I don't have to risk a lot. So that's a trade right there that I might take. Winner, winner, chicken dinner. Wait for the next price pattern entry. We got really volatile there. Really volatile. Who wants to take that trade right there? It's pretty easy to see, isn't it? Not that hard to identify. This volatile price action calmed itself down so much that we had two little tiny dojis showing up in there as we rested. Winner, winner. See, guys, this isn't hard. We make it hard because we try to throw all of these different aspects into the trade. We try to think we can pick the bottoms. We try to think we can pick the tops. We can get the perfect entries. We're always chasing rather than waiting. Okay? I take profits based on the rules of the trade that I put on. Okay? I have goals that I trade for. Particularly on short-term trades, I trade for goals. When that goal is achieved, I close the trade. It doesn't matter to me what happens after that point. Most folks in RWO will tell you that when the stock is moving, that's when I'm selling. Okay? Generally based on a percent gain, or there's a resistance up there that's coming. I will front run that resistance by closing the trade as it's approaching that resistance. It's all very mechanical what I do. And here's the thing is I don't care what happens after I close the trade. We spend way too much time as traders, even when we win. How many of you guys beat yourselves up? We beat ourselves up when we lose trades. We beat ourselves up when we win trades. How can that be any fun? Who wants to be in that kind of a business? Our job here is to make money. Not to be perfectly right, not to get the perfect entry and exit. It's to make money. I don't care what happens to a trade after I exit. No, if the overall market is bearish, I'm trading bearish charts. If the overall market is bearish, I'm going to be predominantly short. That's right. Very using my words. Yeah. We lose money on a trade, we suck as a trader. We win money on a trade, then we look back, oh, it kept going up. Man, I suck as a trader. Okay. Price action. It gives us clues for entry to a trade. Anybody think this chart could be setting up right over here? See, you guys can even spot it when we go through and study the chart. Now what you have to do is develop the skill to do that consistently. Okay? Develop the skill to do that consistently. When I do directional long calls and long puts, I trade somewhere between 70 and 80 deltas. Period. Explanation point. You can argue with me all you want. Yeah, but I want this cheaper. I don't care. You can do that if you want. I trade somewhere between 70 and 80 deltas. I don't do anything else. I don't do anything fancy, try to negotiate with the market or do any of that. I don't care about any of that. I want the simple trade, and I want to make nice money when I do it. Okay? And by the way, guys, I lose money just like everyone else. Lost money on Disney today. I lose money like everyone else. A pattern sets up, pattern fails. No big deal. It happens. You're going to lose some money. But if we follow the overall trend of the market, if we stay with good quality charts, we can repeat trades over and over, trade stocks over and over, and never have to do much of anything else. Got a member of the room, Bob C. He was really struggling as a trader when he came to Right Way Options. We spent some time together in coaching and things like that. And Bob C. that next year in BABA, just trading BABA alone, made $100,000. One stock. Bob C., when he comes into the room, he's never looking at a whole bunch of stocks. He just trades a few stocks, and he just repeats them over and over and over. Yeah, we call him Baba C. Because he has that thing wired. Yeah. Okay. So take the time, guys, to study the price action of the charts. Take the time to look at the quality of the price action of the chart. Okay? Take the time to study the price patterns. Where are your odds going to be improved? Okay? Let's take, for example, I'm going to go to this blank screen again and say if we have a trend that's here, okay, and that price action of that chart, I need to change the color because that's kind of hard to see. Price action of that chart pulls back, moves up, pulls back, and we see a good buy signal right in here. Can we have some confidence in this chart? Because we're holding a price support and we're also holding trend. Okay? But what if we have that chart where the trend is here, the stock rallies strongly, pulls back, and the buy signal shows here? Our last price support is all the way down here. Our trend is all the way over here. Can we have a lot of confidence in this entry signal here? It's not responding to anything, right? It's kind of floating in midair. These are trades that I usually just avoid. It may prove to be a trade that moves on up, and I don't care, because too many of those trades lose, so I don't take them. Do more of what works and less of what doesn't, and just keep repeating that. Okay? You don't have to trade everything in the market. You don't have to chase the flavor of the day. Build yourself a watch list of good quality trending stocks and then just wait for the next entry. You guys will find that your trading improves. You make more money. You'll actually enjoy your trading a lot more because it doesn't require all of that emotion. How many people in here would say that by the end of the trading day, because you're in such a rush all day long, that at the end of the trading day, you're just absolutely mentally spent. You're wiped out. Yep, just burned, right? By the end of the week, you're just toast. I know that because that used to be me. Can you guys see doing this? You don't have to feel all of that emotional angst in a trade. If we just hold to a set of rules and follow it. And here's the thing, people will ask me this question, why does this work? Why you show this, it looks so simple. Why does it work? It works because all we're doing is following institutional support. It works because institutions are showing us that they're supporting Discovery Channel here. Bill, you can resolve some of that by just going through your charts and studying the quality of the trend. Okay? If the price action is all choppy, full of wicks and tails, it's messy, you may be following the wrong chart. If you see a chart that's getting concise, price action is easy to read, it's not that difficult to do. Now we've got something that all we have to do is wait for the next entry in the trade. Okay. Honestly, George, this is the chart I look at most of the time. I teach a strategy called the 3-8 trap. The 3-8 trap is nothing more than a trend following tool to help you identify these entries, to see when the trade could be coming to you. Okay? But the trade has nothing to do with the indicators. The trade has everything to do with what the price action is doing. I do both. I'm an option trader, I'm a stock trader, and I do long-term trades as well. I'm currently in a trade on space that I'm up about 2,500%. Okay? I do this stuff all the time. Long-term trades, short-term trades, it really doesn't matter. Just wait for the entry into the trade. Let me show you a trade here, and I trade stocks too. Just because I trade options doesn't mean I won't trade a stock. We all know NIO, right? Told everyone in Right Way Options. You guys in Right Way Options can confirm this. On this day, the stock popped up and triggered my alert. It ended up pulling back by the end of the day. Okay, but it didn't change anything. I told everyone by taking this trade we might be a little bit early on the position. NIO had open interest, or not open interest, but implied volatility of like 150% right here. So I chose to buy the stock instead of the option. The cost, the extrinsic value on the options was just ridiculous. So I chose to buy the stock. Bought 1,000 shares. Stock moved up. Then we got this nice little pullback. You guys see the buy signal right there? RWO folks that watch me do this, would you confirm I didn't hesitate for a second? When I saw that candle pattern, I bought another 1,000 shares. Okay, I closed this trade out somewhere up here. Kept moving up, I didn't care. I made $20,000. One trade. Guys, I don't need a ton of these to make really good money. If I just wait for the right entry signals, I get a higher winning percentage on those trades. I don't have to stress so much. Okay? Follow-up buy was not when I hit the trend line. The follow-up buy is when I saw buyers. Buyers right here were reacting and pushing that stock back up. So I made the next entry into the trade. They were reacting right here. I could see them. You can see them. We bought before this candle was even past here, I think. Right about in there, we bought. You know, George, people ask me for my scan criteria as if you can run a scan and create all of the factors that's going to give you the perfect entry signal. Let me just save you some time. I spent years doing this. You're never going to find the perfect entry signal with the scan, because the conditions change. How many days is it going to consolidate here before that occurs? 3, 10, 15, 14? Okay. I use the simplest scans that you can potentially have. All I want is the trending chart. And then everything else that I do is analyzing that price action for my trade. I want simple scans. I don't want the computer to tell me when it's time to trade. I want me to tell me when it's time to trade. I want me to analyze the price action of the chart. I am the trader. I am the CEO. I am responsible. I want to do that work because that's my job. Isn't it true, guys? We try to assign scans or indicators or something like that so that we can lay off that responsibility. Now I don't have to do the work of actually evaluating the price action of that chart. Let something else do it, then it's not on me. But it is on me. It's always on me. I am 110% responsible for every decision I make. I want to make that decision. So I use a simple scan that gets me in the neighborhood of the trade. And believe me, I love my scans, and I love that I use this LTA scanner. It's a fantastic tool. Saves me tons and tons of time. Okay? But I use the simplest scans possible. To just get me in the neighborhood of a trade, and then it's my job from that point on to evaluate the entry. Okay? You see these pink lines all over the charts. These are price alerts. When I see the trade setting up, that's when I put the price alert on. Not after the move is made. And that's what most people are scanning for. They're scanning for the fact that white candle, the move has already happened. They're already taking more risk in the trade than I probably will on a position because I actually make the trade come to me. I use the LTA scanner. Okay. That's here. Let me show it to you. This is the live trading alert scanner. If you guys have never seen this, go over to the live trading alerts, livetradingalerts.com and check it out. These pre-programmed scans in here are basically all I run. They're the simplest scan. I don't make any adjustments. I don't change anything. I just use those simple scans. That's all I do. I take my trending watch list, and I always run my scans against my trending watch list. There's my optional watch list. Every Sunday, I change that watch list for those stocks that are trending. Okay. After that, scanner just pops up trades. You know, RK, people will ask me questions all the time. You know, the what if scenarios. We can play what if forever. Okay? I cannot tell you what a stock is going to do. I cannot tell you when a stock is going to be a buy until the price action shows us. I can't predict when it's coming. I can't tell you if it's going to be at this price or this price 10 days now or 2 days from now. Can't tell you. I can tell you this. I know what it is when I see it, and I'm willing to wait for it. Don't play the what if game. What if game is an endless loop. It's like watching that dog out in the front yard running in a circle chasing its tail. It's fun to watch, but it's not very productive. Don't get into the what if games. Plan your trade and trade your plan. When the trade comes together, I plan my trade and then I just simply trade my plan. Okay? If I couldn't watch the markets, real simple. Real simple. I would look at the chart and I would actually plan the trade the night before. If the stock crosses above here, buy the entry, stop loss goes here. I'd come back the next night, look at the chart, and it literally was in the evenings when I got home from work. I'd look at the chart, adjust the trade if I needed to. If the trade never triggered, the trades were always good for the day. The entry signal was good for the day. If it didn't trigger, I had to evaluate the chart again, make that decision, do I enter the trade again for tomorrow? I just waited for the trade. Okay? I just wait for the trade. If it gaps up, I wasn't in the trade because I used a stop limit order. Okay? Stop limit order says, pay this much, no more than this. Okay? Stop limit order with a stop loss. I'm telling you, changed my life. Because I could plan those trades ahead of time and make my system mechanical. We scanned, I told you guys about the 3/8 trap. Let me do something here real quick. Guys, you guys have been in here an hour and 20 minutes. I don't want to keep you much longer. But let me show you guys this. Well, here. I'm going to go over here to this chart. I'm going to remove all price. Let me give you a 10-second class on the 3/8 trap. Number one, stock has to be trending. Number two, we're looking for the price action where the 3 stays above the 8. By the way, these dots, this is a 17 EMA. Okay? It's a 3 EMA, 8 EMA, 17 EMA. We're looking for a buy signal that occurs when the 3 pulls back, compresses in on that 8, and we're waiting for the buy signal to occur. Okay? Now I want you to look at this chart. How many opportunities did this provide us with potential winning trades? Okay, those are the upsides. There's an upside. There's an upside. Over and over and over. Okay? Let's take a look at that discovery. Where's the winning trades in here, guys? You already know the pattern. We're looking for buy signals to occur here, 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 here. There you go. That's it. Now, how much scanning capability do you need to do that? It's simple, guys. Follow the trend. Val, it's pulling back. Okay, it's pulling back. So what are we going to be doing? Are we going to predict that it's going to be a buy here, or are we going to wait and find out if it's going to be a buy here? That's right. We wait for the entry. I can't tell you if that occurs tomorrow or occurs clear over here, but I can tell you I can wait for it. Okay. Take a look at just the NASDAQ here, guys. Daily chart. Can you guys make money with that chart? As the market has been. Entry signal, entry signal, entry signal, entry signal, not an entry signal because the 3 crossed below the 8. Entry signal, not an entry signal because the 3 crossed below the 8. So, winning trade, winning trade, winning trade, no trade, winning trade, no trade. Just follow the pattern. If the stock gap's away, don't chase the trade, wait for the next entry. It's not that hard, guys. We make it hard because we try, we so desperately just want to hit or predict, we so desperately just want to get the perfect entry, the perfect exit. Just show me the 3 stocks today that are going to make me money. That's not the way the market works. We actually have to put in some effort here. KR is something that I've been bringing up here recently. Okay, let's look at this chart. You guys see the numbers here? And if you've missed the trade, you've missed it. Okay, no problem. What do? We wait for the next entry. Let's go over here. We don't even have to look at price. Where's the next entry? When this rests and pulls back and holds, it shows us buyers. Just follow the trend. Guys, this works because we're just following price action. People will ask, well, how many people can do this and make this successful? And honestly, everyone. What criteria do I use to make my weekend list? First, I only look at stocks that my trades that I want to trade. No sense of me wasting time on charts that I'm not interested in. No sense of me wasting time on charts. If I want to trade options, don't have to know the options. How many times have you guys looked at a great chart, go to find the options stink? Okay, or it doesn't even trade options, you just wasted your time. Okay? So I filter it out. I filter it out to make sure that if it's options, I have enough options to filter it out. If it's going to be a stock trading list, then it doesn't. And then guess what, guys? I just do the work. I look at the charts and find out whether there's a quality trend there or not. That's it. I do the work. Okay. Yeah, it's work, right? It's our job. We have to work at it. And it's so easy. Can you guys see how this can just free things up for you? You don't have to be stressed out. You don't have to be guessing and gambling all the time. if you're picky and wait for the best trades, not every trade, we don't need too many winning trades every month to make a lot of money. Be picky. Make the trade. Do exactly what you want it to do, or don't trade it. You'll enjoy your trading more. You'll make more money, and you'll just have you'll gain confidence in your trading. Okay? You'll gain confidence in your trading because it's so much easier to do. There's enough room for everybody doing this because it's just simple trend following, and all we're doing is following institutions. Institutions have geared the market to have every advantage over us except a couple places. Okay? And those places are, if they show us where they want to go and we follow, there ain't a thing they can do about it. Nothing. They can't do anything about it. Okay? The other thing that we have an advantage over them is we can be nimble. When the trend breaks, when the pattern is volatile or whatever, we can choose not to trade it. Find a trending chart. Wait for the next entry into the trade. A couple years ago, guys, I did this as kind of just a thing for just showing folks that it could be done. I just took Coca-Cola and I just traded Coca-Cola. Very simple, boring stock. Okay, it was trending and I just traded it over and over and over with a small number of contracts. I didn't even get crazy with it. I made over $25,000 that year just trading Coke. Nothing else, just Coke. It doesn't take tons and tons of charts to do this. You don't have to search and overanalyze and all this stuff. Just build a quality watch list of stocks that fit you personally, that are trending, and wait for the next entry. Okay? Study that price action. Spend more time. You know, I say this every once in a while, and I believe this to be true. You guys want the holy grail of trading? You've been looking at it your whole trading career, but you haven't studied it. The holy grail in trading is price action. If you can learn to read the price action of the chart, that is the holy grail. When price moves, we make money. And we do everything possible. We waste so much time doing everything but studying price action. If we just study price action, study the chart, we can start making money. All right? Guys, thank you so much for being here tonight. I hope you got something out of this. It is recorded. When I get the chance, I'll get this rendered and we'll get it posted to the website. If this kind of stuff is interesting to you, if there's something that you think we could help you with, we'd love to have you take a trial, be part of our community. Take a look at us, see what we can do. Okay? Hit and Run Candlesticks, that's Rick right there. And myself. I've been at this since 5 a.m. this morning. I do this day after day after day. We both have a passion to help you become better traders. Okay? Between Rick and I, we both do things a little bit differently. Everybody's their own kind of trader. Okay? But if we can help you with this, if we can help you turn your trading around, please take a look at us. Try it. Give us a shot. Take a trial. They're cheap. Take a trial. And see if we can help you improve your trading. Okay? It's worth a shot, right? If it's not working, if you're looking at your account and saying, that's the perfect critic for for your trading, right? Is your account growing or not? If it is, keep doing what you're doing. If it's not, it's telling us there's a problem we got to fix, right? Be willing to change. Okay? Be willing to change. David, yes, there will be an open house next week. So you can come and join us for 3 days on Monday, Tuesday, and Wednesday, 29th, 30th, and 31st of next week. Okay? You'll want to come check that out. And I really think, guys, you'll want to come and check it out. Maybe consider membership, those kind of things, because we're going to be giving away a $3,000 computer here soon. You guys might want to check that out. And not a crummy, these are great computers. Great computers. And you can modify it and do whatever you want. Okay? Next Monday, Tuesday, and Wednesday. Maybe it's when the open house is. 29th, 30th, and 31st. Okay? Thanks for being here, guys. I truly, truly appreciate it. You guys are awesome for sticking around. Thanks so much. For Hit and Run Candlesticks, folks, and Right Way Options, folks, I'll see you bright and early in the morning. I'll be right back here at my desk, 5 a.m., putting out the morning market prep video. Everyone, take care. I wish you all the best in your trading. Good night, everyone.
Welcome to Your Channel Name, where we uncover the hidden marvels of our planet. Today, we embark on an extraordinary journey to explore some of the most fascinating and remote corners of the Earth. From the icy expanses of the Arctic to the lush depths of the Amazon rainforest and the fiery realms of active volcanoes, we will delve into the secrets that these incredible places hold. Here, the wonders of nature come to life, revealing secrets millions of years in the making. Each ecosystem, with its unique characteristics, tells a story of adaptation, survival, and the intricate balance of life. In the Arctic, life has evolved to survive Earth's harshest conditions. Polar bears and Arctic foxes thrive in freezing temperatures. The Arctic is a land of extremes, where the sun doesn't set for months in the summer and doesn't rise for months in the winter. Despite these challenges, a diverse array of wildlife has adapted to this environment, showcasing the resilience of life. Deep within the Amazon, a complex web of life thrives in vibrant green silence, producing a significant portion of the world's oxygen. The Amazon rainforest, often referred to as the lungs of the Earth, is a vast and mysterious place. Its dense canopy sustains countless species, from insects to mammals, each playing a crucial role in maintaining the delicate balance of this ecosystem. Its dense canopy sustains countless species, from insects to mammals. The Amazon is not just a forest, it's a living, breathing entity that supports an incredible diversity of life. The interplay between the flora and fauna here is a testament to the complexity and beauty of nature. Volcanoes reshape the earth with fire and ash, creating and destroying landscapes over centuries. These fiery giants are a reminder of the earth's dynamic nature. The molten lava that flows from their peaks can obliterate everything in its path, yet it also gives birth to new land, fertile soil, and a unique ecosystem. Witness the raw power of nature as these fiery sculptures form. The process of volcanic activity is both destructive and creative, illustrating the dual nature of our planet's geological process. Thanks for watching. Subscribe to explore more wonders of the world and discover nature's incredible story. Join us as we continue to uncover the mysteries of our planet, one breathtaking adventure at a time. See you next time. In the depths of the ocean, mysterious creatures lurk in the darkness, adapting to extreme pressures. From bioluminescent jellyfish to giant squids, the ocean's depths are a frontier of discovery. The deep sea is one of the least explored places on our planet, a realm where sunlight never penetrates and the pressure is immense. Here, life has evolved in extraordinary ways, revealing some of the most fascinating adaptations in the natural world. Imagine a place where creatures create their own light, a phenomenon known as bioluminescence. This magical glow is used for communication, hunting, and even camouflage. Among these luminescent wonders are jellyfish that light up like stars in the night sky, and anglerfish that use their glowing lures to attract unsuspecting prey. The deep ocean is also home to the elusive giant squid, a creature of legend that can grow up to 43 feet long. With eyes the size of dinner plates, these squids navigate the dark depths with ease, capturing their prey with powerful tentacles. The abyss is a testament to life's resilience and ingenuity, showcasing how organisms can thrive in the most extreme conditions. Thank you for joining us on this unbelievable adventure. Make sure to subscribe for more explorations into the hidden corners of our world. Until next time, keep exploring. High in the mountains, life clings to the rocky slopes. Mountain goats and snow leopards navigate the treacherous terrain, showcasing nature's resilience. But beyond these familiar faces, the mountains hold secrets of their own. In these towering heights, the air is thin, temperatures plummet, and the landscape can change in an instant. Yet life finds a way. Tiny alpine flowers bloom in the crevices of rocks, painting the rugged landscape with bursts of color. These hardy plants have adapted to withstand the harshest conditions, their roots anchoring them firmly against the relentless winds. Among the peaks we find the elusive snow leopard, a master of stealth and agility. These magnificent creatures are perfectly adapted to their environment, with thick fur to keep them warm and powerful limbs to scale steep cliffs with ease. Their keen eyesight and camouflage coat make them nearly invisible against the snowy backdrop. Mountain goats, with their incredible climbing skills, defy gravity as they traverse sheer cliffs in search of food. Their specialized hooves provide a firm grip on the rocky surface, allowing them to navigate the mountains with astonishing agility. The mountains are not just a home for these remarkable animals, they also play a crucial role in our planet's ecosystem. They act as water towers, capturing moisture from the air and providing fresh water to rivers and valleys below. The delicate balance of life in the mountains is a testament to nature's ability to adapt and thrive in the most challenging environments. Thank you for joining us on this journey to the heights of the mountains. Make sure to subscribe for more explorations into the hidden corners of our world. Until next time, keep wondering, keep exploring. Deserts, though seemingly barren, are teeming with life. From the vast expanse of the Sahara to the rugged terrain of the Mojave, these arid landscapes are a testament to nature's ingenuity. Creatures here have evolved remarkable adaptations to survive with minimal water and extreme temperatures. Take the camel, often referred to as the ship of the desert. These resilient animals can travel for days without water, storing fat in their humps to sustain them during long journeys. Their thick eyelashes and nostrils that close protect them from sandstorms, while their wide, padded feet allow them to traverse the hot, shifting sands with ease. Beneath the sand, scorpions lie in wait, emerging under the cover of darkness to hunt. These nocturnal predators have adapted to the harsh desert environment with a tough exoskeleton that minimizes water loss and specialized pincers to capture prey. Despite their fearsome reputation, scorpions play a vital role in the desert ecosystem, controlling insect populations. Then there are the cacti, the silent sentinels of the desert. These plants have mastered the art of water conservation, storing it within their thick, fleshy stems. Their spines not only deter herbivores but also provide shade, reducing water loss through evaporation. Cacti bloom with vibrant flowers, attracting pollinators and adding bursts of color to the arid landscape. The desert's extreme conditions have given rise to some of nature's most extraordinary adaptations, proving that life can thrive even in the harshest environments. These resilient creatures remind us of the incredible diversity and adaptability of life on Earth. Thank you for joining us on this journey through the secrets of the desert. Make sure to subscribe for more explorations into the hidden corners of our world. Until next time, keep wondering, keep exploring. In the vast savannas, the circle of life is on full display. Predators and prey engage in a timeless dance, from the majestic lions to the swift gazelles. The savanna is a testament to nature's balance and beauty, but beyond the iconic images of the hunt, there's a delicate ecosystem at work. The tall grasses sway gently in the breeze, providing both food and shelter for countless species. Elephants roam these plains, their massive size balanced by their gentle nature. Using their trunks, they pull down branches and uproot grasses, playing a crucial role in shaping the landscape. Nearby, a group of giraffes grazes on the acacia trees, their long necks reaching for the tender leaves that other herbivores can't access. Their presence ensures the trees don't grow too tall, maintaining the savanna's characteristic open canopy. As the sun sets, the savanna comes alive with the sounds of the night. Hyenas laugh in the distance, while the deep resonant calls of the lions echo across the plains. Nocturnal creatures like the aardvark and the bush baby emerge, each playing their part in this intricate web of life. The savanna is more than just a stage for dramatic chases and battles. It's a living, breathing entity where each species, no matter how big or small, contributes to the harmony of the whole. It's a reminder of the delicate balance that sustains life on Earth and the beauty that arises from it. Thank you for joining us on this journey through the wonders of the savannah. Make sure to subscribe for more explorations into the hidden corners of our world. Until next time, keep wondering, keep exploring,